Now, by this, or for our own markets, you pull up the GIF Nifty, it'll give you an idea of how our own markets are likely to start off, and that will give you an idea. And after 8 days of losses, the implied open currently in the negative, a 15-point downtick is what the implied open is suggesting at the start of a new series. 8 days of losses for the Nifty. The last time we saw something like this was between February the 18th and the 4th of March of this year, when the Nifty had declined for 10 sessions in a row. But the big event of the day is, of course, the RBI monetary policy, and the Reserve Bank of India's MPC will be announcing its interest rate decisions today. Ritu is here with all the key expectations. Ritu.
From tariff tensions to GST cuts, a stronger than expected growth print, and even the potential fallout of H-1B visa restrictions on service exports, there's plenty that's weighing on the Monetary Policy Committee's mind as it gears up for its rate decision. According to a CNBC-TV18 poll, though, the RBI is expected to keep the repo rate unchanged at 5.5% in this policy, despite having the headroom to cut because of the lower inflation, and a very small majority is expecting a 25 basis point cut. Now, with the RBI having already front-loaded rate cuts, ensuring ample liquidity, the majority of the respondents we spoke to believe that the MPC may prefer to pause at this stage and assess the full impact of US tariffs and GST cuts before it takes any further action. On the terminal policy rate, 40% see it settling at 5.25%, another 30% at 5%, and the rest expected at the current levels. Now, the majority anticipates that the easing cycle is going to conclude as early as October itself. The stance of the policy, that is also unlikely to be tinkered with at this juncture. As for the macro forecast, 40% expect the growth forecast to be left unchanged, while the rest are expecting a 20 to 30 basis point upward revision, which will reflect the stronger than expected Q1 data. The inflation forecast is expected to be lowered, on the other hand, to about 2.5 to 2.7%, helped by lower food prices and, of course, the GST rate rationalization. Now, beyond the action itself, the language of the policy is going to be very important this time. A dovish tilt is what is expected, which could hint at future rate moves. Now, on the rupee specifically, economists don't really expect an explicit mention of levels, but the RBI is likely to stress that it will not tolerate volatility, stepping in only to smoothen the moves. Now, Forex intervention will have liquidity implications, and therefore the MPC is going to have to weigh that carefully. What else to watch out for in this policy? Well, targeted support for exporters, especially the MSMEs, any sector-specific easing where tariff pressures could bite, possible external benchmark-linked rate extension to NBFCs apart from banks, assurance of ample liquidity, and a clear forward guidance.
Ritu, thanks a lot for that. All eyes, of course, will be on RBI Governor Sanjay Malhotra later in the day. Let's also now go across to Lata, who is joining in for an editor's take on the policy.
The markets want to hear a dovish RBI, not necessarily a cut. The problem for RBI will be, how do you communicate dovishness when you have to willy-nilly hike the forecast of GDP? The GDP forecast at 6.5 with the Q1 GDP coming in at 7.8. They have to raise the GDP forecast, and then to communicate dovishness is tough. Now, the market will first and foremost watch for the CPI forecasts, which also have to be lowered. They are standing at 3.1. The poll that we did said that the market has to come, that RBI has to bring it down closer to 2.5. Plus Q1 next year, the forecast is at 4.9. Will they bring it as close to 4 is what the market will watch out for. Those are the two numbers which are very crucial. But the market will also look at the monetary policy review, the MPR, which gives the full year forecast for next year. They will watch if that is close to 4. All these are things which will give market an idea whether RBI wants to be dovish. But above all, they will have to look for the language around growth. The RBI will raise the forecast, but the market will want to hear whether the RBI says that it will stand ready to help if growth falters. Those are the kinds of phrases that the market will want to hear. Of course, more than anything else, the market wants to hear the word OMO. But there, of course, it's very tough for the Reserve Bank to oblige. A rate cut will be good for stocks and consumer good companies. It will be bad for bonds because it will mean no more cut. It will also be bad for banks.
Lata, thank you for that update. The RBI monetary policy decision one of the few major triggers that you have for today's session. But to list out the other major triggers of the day, our research team is joining in with the trade setup, the stocks that are likely to be in the news, and of course the setup on the F&O side of things as well. First up, Gaurav is here to get us all the market cues we need to watch out for. Gaurav, good morning. What are you watching out for today?
Nifty yesterday, Nifty slipped a little bit, but it defended at 24,600 level. And in fact, if we look at the option data, there's a high interest in put option data for 24,600. So definitely we'll be watching out if Nifty will be able to defend this level. But apart from that, we've got China market and Hong Kong market where they have national holidays, so these markets are closed. From US market, we are seeing some kind of news flow coming up in terms of the shutdown of the government. In fact, Vice President J.D. Vance, he has highlighted this, and at the same time, Trump trade chief expects US to ink more deals during the Asia trip. So definitely there are some cues which are coming up from the US market as well. In fact, when we look at NASDAQ, actually it ended, it ended in red, but S&P and Dow Jones both ended in green in the last session. From the Indian point of view, we have got RBI policy today, so definitely watching out on Nifty, banks, and specifically all the banking stocks. Apart from that, India and European FTA, that comes into force from today. Remember, 100 billions worth of investment is going to come in the next 15 years because of this FTA. Other than that, there are some reforms which will be applicable from tomorrow. First is that NCPI, who is going to stop UPI P2P collection request. New online gaming regulations, they are also set to be implemented from today. And next is that RBI's project finance norm. So definitely these announcements were there earlier, but they will be implemented from here on. And that is the reason why we will be watching out on companies who will get impacted, how the impact is going to be, and how the commentary is going to be. Lastly, let's also not forget that Jain Resources, this will get listed. Remember, last day we saw 4 IPOs coming up with the new listing. So let's see how it works out for Jain Resources today.
Gaurav, thank you for that update. Over to Upasna, who lists out the stocks you need to watch out for today. Upasna, good morning. What's on your list?
Good morning, Hormaz. First up, let me start with Lupin. The company has received US FDA approval for Rivaroxaban ban for oral suspension. Next up is SKF India. The company appoints Sailesh Kumar as the MD for the term of 5 years with effect from 1st of October. RITES is the other one on our radar. The company signs MOU with Etihad Rail to further augment business collaboration. Next up is Oil India. The company has signed an MOU with GAIL to enhance collaboration across natural gas value chain. Next up is Nestle. Even this stock is on our radar as the company signs MOU with Ministry of Food Processing Industries at the World Food India Summit. Arvind Fashion also in focus as the Sailesh Kumar Chaturvedi, which is the managing editor and CEO of the company, has given the resignation. Time Technoplast, the company has obtained BIS certification to manufacture and sell polythene pipes for gas distribution and achieving its planned Q2 FY26 milestone is what the company has indicated. HUDCO also in focus on the back of Q2 update. The company says that there's strong disbursement and sanction for H1 FY26. And if we look at the Q2 disbursement number, it has seen a growth uptick of nearly about as high as 44% on a one-year basis. And lastly, rate gain also in focus as the arm acquires US-based company Sojin for $250 million. So all in all, we'll be closely watching out for all these stocks today.
Of course, Upasna, thank you for that. And aside of all of this, keep an eye out on auto names as well, the auto sales numbers that will be coming out all through the day. Lastly, Mangalam joins in with cues from the F&O space. Mangalam, good morning. The start of a new series. What is the historical data indicating on the road ahead?
Well, it's the start of a new series, so let's look back at what September series was like. We saw about 110 points on the upside on the Nifty this time around in September. And it was a fairly volatile series. Between the highs and the low, there was a 1,200-point move that we saw. And prior to that September series as well, for the 2 series, we saw a loss of 1,100 points on the Nifty. So it's all things happening. October historically has seen big moves, but more on the downside than the upside. So 5 out of the last 5 Octobers, 3 have actually seen big gashes. And last October itself, we saw a near 2,000-point decline on the Nifty itself. And keeping that in mind, you know, the conviction on the short side is a lot more this time around. The FIIs or the overall rollovers have been 83% versus last 3-month average rollovers at 80%. More short positions have been rolled over. And the open interest on the Nifty as well is at 1.17 crore shares. This is at the start of the series. This compares with 1.55 crores that we've seen as a 3-series average. So on the heavier side, Rollovers are higher. Where are the rollovers high? They're on the short side. FIIs, remember, started the September series with a record low position of 8%. And guess what? October, they've gone a notch lower. Just 6% long exposure is what we've seen. So at the start of a series, it's the lowest long exposure that the FIs have. On a net basis as well, the exposure is closer to nearly 2 lakh contracts on the short side. And the clients on the other side are fairly positive. Their long exposure is at 74%, net contracts at nearly 1.25 lakh. What this means is that, in September, the shorts did not get a lot of follow through. And every time the FIs start on the adverse side from the long positioning, the next few series, we see big up moves coming by. So April 2023, they started 9% long. The next 4 series, we saw a 2,600 point move on the Nifty. November 2023, we saw an 11% long exposure. Over the next 2 series, the Nifty gained about 2,900 points. And even as recent as Feb 2025, the FI started their series with 11% long exposure. Over the next 5 series, we saw a 2,300 point move. For perspective, the September series, FI started with 8%. We've seen 110 points move on the Nifty already. Let's see where it goes from here. And for us to see where the Nifty goes from here, we have key triggers for the October series. The RBI policy outcome, the second quarter results that will come by. We'll also watch out for developments around US and India trade talk, which is underway, and festive season sales. Remember, this October, we have both Dussehra and Diwali and a GST cut. How does all of that impact the overall performance is something we'll watch.
Most important thing to watch out for. Mangalam, thank you for that update. Take a short break. Just as we do that, listen in to what Kevin Sneeder, the president of the Asia Pacific ex-Japan at Goldman Sachs, had to say on his outlook for the Indian economy and why he's bullish on India for the long term.
India still has some challenges and hurdles to overcome. From an economic growth point of view, the headlines look good, roughly 7% this year. Let's look at the fundamentals in India. And those fundamentals hinge on the financialization, it's a horrible word, but these pools of capital that are forming, the technology revolution, which India has really been a part of. Question as to how far it will do so in the AI space, but nevertheless, the software sector in particular, technology has really been a big underpinning. And the third part of it is stability. It's very important that stability and consistency of policy continues. So we're looking at that. Our investors have a healthy optimism around India over the long term, but there has been some wobbling in the short term, and we've certainly seen foreign investment flows recede in the last few months after really 6 years of steady increase. So a bit of a caution in the near term, but longer term, and the reason we've made that commitment in the form of more physical space is because we remain very convinced about the long run potential.
Welcome back. Now, India's trade and economic partnership agreement with the European Free Trade Association is slated to come into force starting today. The EFTA bloc comprises of Switzerland, Iceland, Norway and Liechtenstein. Now, under this agreement, New Delhi has received an investment commitment of $100 billion in 15 years from the group, while allowing several products such as Swiss watches, chocolates and cut and polished diamonds at lower or zero duties. Now, my colleague Parikshit spoke to the Norway ambassador to India on the trade pact. Listen into what he had to say.
Well, I said India is the biggest market in the world. It will be the biggest consumer market. We are smaller markets comparatively. So of course, it's a disparity in one way. But all EFTA countries, they have very clear technologies, cutting-edge technologies in different areas. That means that there is complementarity between India and the EFTA countries. And for Norway, they are particularly in the field of energy and green energy in the maritime space.
Well, now the Dow futures may be down 150 points currently, but the main session on Wall Street yesterday was a positive one. The indices ended higher after a very choppy session. The indices recovered from the lows of the day. They ended higher because of a US government shutdown that is now almost imminent. The Dow Jones registered a record closing high. The S&P 500 also registering a positive September in comparison to the historical previous trends, the best September in 15 years for the S&P 500. CNBC's Mackenzie Sigalos gets us a wrap of all the action on Wall Street.
U.S. markets up across the major indexes in Tuesday trading, managing to end September with monthly gains. The Dow, which closed at another record high, added 82. The S&P 500 gained 27. And then that tech-heavy NASDAQ was up 69 points. Americans are feeling more pessimistic about the U.S. economy right now. The Conference Board's Consumer Confidence Index released on Tuesday showed a drop of 3.6 points for September, hitting a 5-month low. And then for the 9th month in a row, consumers said that they think fewer jobs are available. The survey also showed more pessimism about finances, as consumers' views on the current financial situation had the biggest 1-month drop since July 2022. And President Trump announced Tuesday the creation of Trump RX, a federally run direct-to-consumer website for Americans to buy prescription drugs. He also announced that Pfizer will offer all its prescription drugs to Medicaid at a reduced cost, which comes in exchange for tariff relief. Pfizer will also offer some of its drugs on the Trump RX website at a reduced rate. That's what's happening here in the U.S. Back to you in Mumbai.
Mackenzie Sigalos, thank you for that update. Let's also now listen in to Elise Ozenbaugh of JP Morgan Wealth Management, who gives her views on what could happen to the U.S. market and the economy once the government shuts down.
We've seen multiple government shutdowns since the early 80s, and what we found is that, one, they vary in length, but the length itself doesn't have all that much weight in terms of how markets perform. On average, stocks actually tend to rise. You actually see a modest decline in treasury yields. I think this time around, what we have to be mindful of is kind of the absence of some of that economic data should we get the shutdown and not receive things like the payrolls report this Friday, because it could just add further confusion and a lack of clarity to an already muddled macro picture.
Take a short break. On the other side, cues from the commodities market. Stay tuned. Welcome back. Now, US President Donald Trump, while speaking to the press, said that Hamas has 3 to 4 days to respond to his 20-point peace plan. Listen to what he had to say.
Well, we're going to do about 3 or 4 days. We'll see how it is. All of the Arab countries are signed up. The Muslim countries are all signed up. Israel's all signed up. We're just waiting for Hamas. And Hamas is either going to be doing it or not. And if it's not, it's going to be a very sad end.
And Manisha Gupta now joins in with all the updates from the commodity space. Manisha, good morning. All eyes on oil prices.
It is, yes, and the way that we've seen the movements come in here have been quite big as well. So when you're looking at the crude oil prices right now, we have seen a bit of gain, a decline. There are two things to watch out for. One, of course, the October 5 OPEC Plus meeting, which is considering a production increase now for the month of October at 137,000 barrels per day. But for the month of November, it could be anywhere between 274 to 400,000 barrels per day. The exact number is what will move the crude prices going forward from here. Having said that, as you were talking about Trump securing Israel backing for a Gaza peace plan, but we are yet to hear from Hamas, and there is a bit of an uncertainty coming in from there. The markets will also watch out for the U.S. government shutdown minutes away from now, and that seems to be keeping volumes very, very low in the Asian markets right now. That's about crude, but when you look at the metal prices, we are looking at some gains coming back here. So gold prices did see some profit taking overnight, but we are back with some more gains. Remember, the previous quarter has seen gold gain by 17%, silver by 30%, and that's trading on a firmer note even right now. Copper prices, the supply disruptions have kept the prices at 2-month highs here as well, and copper has gained 11.5% in the previous quarter, 7% up for the month of September as well. So it clearly is metals where the volume is still coming in, prices volatile, and mostly on the green side.
Manisha, thank you for that update. With that, we call time on this edition of Power Breakfast. From me and the team that put this show together, thank you so much for watching. Bazaar Morning Call on the other side, set you up for the day's trade.
Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We are coming to you live from the CNBC-TV18 Motilal Oswal studios. And as you can see, we're all dressed up in nice Indian attire. Wish all of you, your families, a very happy Dussehra as we look forward to celebrating this happy occasion. I'm Prashant, with me, my colleagues Nigel and Survi. Guys, morning. Happy Dussehra.
Hi, morning. Happy Navami, happy Dussehra, and happy festivities to both of you, to our teams, and of course to all the viewers. May this be the start of a very positive, healthy, and a very prosperous festive season as we get up to Diwali.
Absolutely. Let's just take it from the top then, right? In terms of what you need to know, there is the clock ticking right at the bottom of the screen. RBI policy is the big one. So market expects the RBI to deliver a dovish pause today. That is the first point that I want to start with on your screen. Markets expecting the RBI to deliver a dovish pause. How will they do it is the question, right? The government's already done a fair bit in terms of trying to stimulate demand, etc. Now you've got the RBI. RBI has already delivered 125 basis points in terms of interest rate cuts. They've done a fair bit for liquidity, etc. But what now is the question. So, by the way, there is a fair chance, I think, that you can get a cut as well, 25 basis point cut. Or, I mean, the majority, though, is still in the favor that you'll get a pause. And then the remarks perhaps will be dovish. I mean, supportive for growth, ready to do more, etc., etc. So RBI governor's remarks and the Q&A will be important. The decision, of course, comes in at 10 a.m. in the morning. More on this with Lata, our colleagues Ritu, etc. in a little bit from now. US equities were higher, so S&P 500 about 0.4 up, Nasdaq about 0.3% in the green. Macro markets quiet, 10-year yield and the dollar index absolutely flat. Pfizer saw a very large move, 6%. This are basically after they got a 3-year reprieve from tariffs, Trump's tariffs, after they basically said that they're going to cut prices on some drugs for US buyers. More on this with Ekta a little later, but I think this is important, maybe some implications for Indian pharma companies as well. And of course, today, the focus later out of the US will be on the impending US government shutdown. And Trump essentially was on record saying that, the shutdown could do a lot of good things. Well, we'll see if a last-minute deal is struck or, this really we go into a shutdown. We've had these many times in the past over the years as well. Chinese markets, onshore markets are closed from today to the 8th of October for the Golden Week. So it's a fairly long stretch, so you won't have cues from there. Oil prices were down a little bit, 1.5%. $67 a barrel is where we finally left off at. Now to the markets, right? So 2 days now, we've been sort of pointing out that, we are oversold and extremely oversold by some matrices. And they started from the top about, 7-8 days back. But bounces are not lasting. They're still not lasting. So we'll have to see. There's a fair bit of FII selling, etc. as well, which I think is at play. So we'll have to watch this. The levels don't change very much. The resistance and the supports on your screen for the Nifty. So the immediate support for the Nifty is in the zone of 24,400 to 24,330, which is the prior support. It's a level we put out for. There's a trend line supported about 24,500 as well, but it's a minor one. The big one is that zone. And the resistance is 24,788. That is nothing but the upper end of the daily Bollinger Band. And the 40-hourly exponential is 24,829. So that's the range in terms of resistance. By the way, interesting, the Bollinger is lower than the hourly average. But that is the resistance zone. Nifty and Nifty Bank are seeing slightly more divergent trends over the last couple of days. 2 days in a row now, Nifty Bank has managed positive closes. Here, the immediate resistance is the 40-hourly, 54,797, and then 55,215. The support is the low of 54,226. We'll see if there is enough in the tank as we go into a market holiday tomorrow as well to maybe execute a bit of a bounce, which the markets failed to do so for 2 days in a row. Now, GIFT Nifty gives you a quick sense of how we like it to start, 20-odd points lower. Typically on RBI days, I mean, there is a fair bit of action concentrated around that 10 a.m. And of course, once the policy the statement and the Q&A, etc., starts as well. So it's in that sense a bit of stretched out, even if the market wants to do in terms of reaction. F&O setup, how are the stats looking? Nigel is here with exactly that. Nigel, morning.
Well, towards the end of the September series, the bulls were definitely singing "Wake Me Up," after September ends, because the way the markets cracked close to around 800 points or thereabouts, that gave the bulls a very, very, uncomfortable feeling. The question is, we are moving to those extreme levels, and normally when we reach those extreme levels, we do see a bounce. Are we there yet? Let's pull up a few data points. The big headline is the Nifty is on an 8-session losing streak, which is clearly making the bulls very uncomfortable, and the bears will be very pleased to look at that headline. However, if you look at what history suggests, the 21 instances that we have seen, the 8-session losing streak, well, 65% probability in the next 20 sessions actually we bounce back, and the average returns have been close to around 3%. I'll tell you what, the bulls would love this outcome if this is what history suggests, and hopefully this time around from a bullish perspective, it plays out again. So 8-session losing streak may not be such a bad omen. The next point is the FI net short positions. At the start of a series, it's at around 94%. No mistake out there, 94%, it's the highest ever. In absolute terms, it's around 1.76 lakh contracts. So the FIs are aggressively net short. Now, we've seen a bit of a pullback, but actually the VIX has still been at very, very suppressed levels. Earlier in the series, it went down to sub 9. And even right now, given the kind of volatility we have seen, the VIX is not indicating any kind of panic or any kind of sharp pullback. At least as of now, at 11, it's pretty much in line. Moving to the next data point then, the margin trading funding. That was at around 65 to around 70,000 crores or thereabouts earlier this year. Now that's moving to the record high as well. So there is some margin trading that's happening out there. Sometimes from the broader markets, it gives you a bit of an uncomfortable feeling. However, the other way of looking at it is it's par for the course with the kind of wealth that a lot of these HNIs have created. Some margin trading is what we are seeing. What's helped us in the last few trading sessions, last couple of trading sessions, the reason that we haven't fallen off the cliff is the DI buying has offset the FI selling. That could be an element out there of expiry related factor as well that did play out. But institutions were net buyers, so you like that. Moving to the levels then, I was looking at the options data, looking at the technical levels as well. The problem is on a day-to-day basis, the Nifty has been making lower highs. So the first level you're looking at is you want the Nifty to actually at least break that jinx and start making higher highs. So that's the level you're looking at, important level to track. On the downside, this 24,500 mark, that's the near-term level. So that's a 250-point band that you're looking at. We'll have to see whether or not the Nifty goes ahead and breaks any of these levels. The Nifty Bank, that's been actually trying to pull back. Last couple of trading sessions ending in the green. Very close to the 20-day MA, you wanted to get past this mark. That's an important cue from a bullish perspective. Moving to stocks that I'm looking at, all of September I was highlighting RBL Bank. RBL Bank was the one that we're looking at. Saman Capital, that's still in the F&O band. We saw a large fund-based buying. It's in the F&O band. And there is some optimism with regard to the fundraise. So we continue to remain that. And RBL Bank was the outperformer for September. Periodically, it's been in and out of the F&O band. The street is sensing something. We'll have to see whether what they're sensing, the outcome, is as much as they expected. So that's a stock you continue to keep on your radar. And finally, RateGain, they have gone shopping this time around. They've gone ahead and they bought Surgen for around $250 million approximately. Effectively, in the next 2 years, their revenues double and EBITDA could go up around 70%. So it's that time to go shopping. We'll keep an eye out on this stock. Finally, the cues that we're looking at, earnings season, festive season as well, US data, the US tariff situation as well. All of these will be in our radar. And for today, the RBI policy, the outcome will be crucial. So we're moving to those extremes. Are we there yet? If yes, expect some bit of a relief rally.
And through all the news and noise and the tariff issues throughout the month of September, the Nifty was unchanged in those 30 calendar, days. We started September at 24,625. We ended September at 24,611. So back to square one, essentially. Let's see if this, changes now and if October provides a more, sort of a directional cue. As far as the implied open is concerned, let's pull that up because Asian markets, Hong Kong is shut, China is shut. The others are fairly mixed, so not, too clear in terms of direction as this whole deadline issue, the US government shutdown issue continues to prevail. Let's pull up the implied open and, see what indication is. 22 lower, that's what the GIFT Nifty is suggesting as of now. So let's straight away get to the equity call. Jonathan Garner of Morgan Stanley says that their Asia EM coverage markets have traded close to June 2026 bull case targets almost entirely due to multiple expansion. He says they doubt this is sustainable unless there is a significant re-acceleration in global growth from here on. He says that economics team continues to see growth risks ahead, particularly in trade-dependent economies. He says earnings estimates revisions since April have been flat to down, unlike in the US, with a slight tick into the positive recently for China. So that's the overall EM landscape as per Morgan Stanley. Of course, they continue to be positive on India. We have John Stoltzfus, MD and Chief Investment Strategist at Oppenheimer Asset Management, joining in. John, thank you so much for being with us. Like I was recapping here, for us in India, if you look at the index, it's as if nothing moved, and yet so much happened in September, right? But we still don't have a hint of any meaningful pickup in foreign purchases of Indian equities. What do you make of the environment here? Do you expect more rate cuts from the RBI? Will that, create more excitement in foreign investors at all?
Well, I think it was great to be on the show. First, let me say, I think if you get a cut in the RBI, that'll be a good feeling for the market. Lower interest rates are always an opportunity to see a boost. I think what we've got here is on a global basis, all the markets are showing very much traders rotating and rebalancing almost on a day-to-day basis. Valuation, of course, plays a role. Whether the dollar is in a strong day or in a lower day makes an issue too, as well as the fact that I think that on a global basis right now, the focus is really in emerging markets as a result of valuation has been outside of India for a while in terms of foreign investors. But I do believe that from an intermediate to long-term perspective, which is what at Oppenheimer, my group, works on as a strategy group, this is a major economy that is going to play a role in what we've said for quite a while whenever we're on the show, is a diversification away from one country's centricity in terms of the global supply chain. And we do believe that is a process that has been taking place since 2016. So it's, we're 9 years into that process, and it's been accelerated, of course, post-COVID. So we would have to say that a lot of the issues here, I think there's, of course, issues related to it happens both in Europe and also with India, is the purchase of Russia gasoline.
Yeah.
You're bound to find some U.S. investors who will pull back and put emphasis in other areas.
Yeah, sure. And then, of course, there is this whole business of the shutdown. I mean, we've been down this road before. We all know that it's what? I think it's 8 o'clock roughly here. I think another hour and a half to midnight in Washington, D.C. I mean, will it be any material event for the market at all? Or do you think they'll eventually get down to a resolution?
I would have to think that it's going to get down to a resolution, that we may see near term a shutdown that will be likely resolved over the weekend. I think the Yom Kippur holiday could very well, if they don't make an agreement tonight, over the course of the next 2 days or so, you may see a hold off until the weekend. But then we would likely see both sides of the aisle gather in Washington and try to work it out. In our view, the market, I mean, if you look at the performance of the S&P 500 today, there was a little bit of a dance around the S&P 500 and the other major indices. The smalls and the mids were taking it harder for a while. And then by the end of the day, broadly, you could say that most of the important indices, equity indices in the U.S., were showing basically flat with either with a modest upside, with upside bias. So we'd have to say past performance would suggest that it's, as long as the shutdown is not a long, involved deal, we think that the market will likely handle it not with complacency, but with a watchful eye. You've seen the VIX came up a little bit today earlier in the States, and we would think but still nowhere near where it was in April. I think the VIX in the U.S. is down today, even with a little bit of a blip up, was about 69% below of where it was in April. So really cooler heads are prevailing in our market right now.
Yeah, absolutely. By the way, lovely backdrop there, John. The buildings and the thing. It's a real backdrop, right? It's a glass behind you. Or is that a...
That is actually a photograph, but I would say this is a photograph that was taken during COVID at a time when people thought it was the end of the world. And we can say now it wasn't the end of the world.
As they say, right, nothing ever really is the end of the world in that sense. It feels like it many times in the past. But yeah, that really did for a while there. John, we had more questions, but really compressed on time. Hope you come back and we'll talk more. Thank you very much for joining us. Good speaking with you here on CNBC-TV18. Well, the big talking point today is the Reserve Bank of India and what they will do. Lata is here with the editor's take on what markets are watching and waiting for. Lata, over to you. Morning.
Well, first up, what the market wants, the bond markets, they don't necessarily want a cut, but they do want an RBI that sounds dovish. In the very least, a dovish pause. So there's an expectation of a cut. Now, the challenge for Reserve Bank will be, how do you communicate dovishness when you willy-nilly have to raise the growth forecast? You know, their growth forecast is 6.5. The first quarter came in at 7.8. If you average it out, at least 6.7, they will have to say. It's very difficult to communicate both. I'm raising the growth forecast, but growth needs help. What will the market watch out for? They will watch out for the CPI numbers. The RBI CPI for the current year average stands at 3.1. The street is standing at 2.5. Likewise, year-ahead CPI for the RBI, that is, June quarter CPI stands at 4.9. That's their forecast. But that's pre-GST, pre the undershooting of food inflation. So how much do they bring it down? Do they bring it down to 4? Then there is a hope that there is dovishness that's coming. But I think the market will be more happy if the growth language is tweaked in such a way that if growth needs help, we stand prepared. That's what the market wants. Of course, the bond markets also want some mention of the word OMO, which I find very difficult because the CRR cut has poured in, or will eventually put in over 1 lakh crore into the market. An OMO language is difficult, but that will, of course, make the market very happy. Everyone in the market are expecting a cut, but not necessarily today. Maybe later.
Maybe a dovish pause.
Yeah. What are you going with, Lata?
I'm going with a cut.
A cut.
I'm going with a cut now and a dovish cut. Dovish cut for another cut. I think between August and now, things have drastically changed. I mean, it's H1B and tariff and a fear that more can come. Every day there is either a furniture or a pharmaceutical or
movies.
Movies thrown at you. Who is to say that, things... The market, the sentiment of in India Inc. is at such a low ebb to hire even one more person.
Absolutely.
So maybe it'll help.
And I go with the governor in house.
Governor. Absolutely. And I think it's a close call. And as Lata said, it's a dovish pause or it's a cut and a dovish cut at that. We'll wait and watch. 10 o'clock is when the decision will come, Lata. We'll leave you to it. We'll take a quick commercial break here. Let me just quickly run you through the interactions which are lined up. In 8:35, we have Vikas Singh of ICICI Securities who will join in with the spotlight on metals. 8:45, special interaction with Alok Gupta, Allied Blenders coming up. 9:20, Nilesha, MD at Kotak Mahindra of AMC. 9:35, we'll be speaking with the management of PG Electroplast, ACs and what they're doing. And of course, our coverage of the RBI monetary policies kicks off at 9:40, 9:45. We'll do a bit of preview, and then of course 10 o'clock is the decision which is lined up.
Well, we'll slip into a short break. Come back, we'll highlight all the top stocks that we're looking at, give you a sneak peek into the list. Hutco, IRDA, RateGain, Allied Blenders, Nugent Software, all of them will be reacting to positive news flow. Dynamic Tech, Time Techno, Precall, Atlanta, and Seagull, all of them reacting to positive news flow. Slip into the break, come back, we get into further detail in the other side.
Welcome back. So, like we've been telling you, cues across Asia are fairly muted. Everyone's wondering what happens the next hour and a half when the supposed U.S. government shutdown is expected to kick in. Midnight U.S. time. I think it's going to be Washington time. We'll see. For now, the implied open is telling us that we will probably start about 20 to 25 points lower. That's the indication, and then we'll take it from there. Still about 22 points down. So let's straight away get to the stocks that we need to keep in focus. Our team is standing by with today's list. Guys, hi and happy festivities to all of you. Going to kick it off with Gaurav. You're watching out for Hudco and IRDA. What's the news?
Well, yes, banks and NBFCs definitely are in focus because of the RBI MPC meet. But for Hudco and IRDA, there is one more reason, is the business update. When we look at Hudco, a strong business update is what we are seeing because the sanctions has been one of the highest for first half of FY26. It came in at around 92,709 crores, which is up more than 21% on a year-on-year basis. Now, this, remember, if we have to put it in the context for FY25, the sanctions were at 1.27 lakh crores. So definitely a very strong number for Hudco. When it comes to disbursement, that is also up almost by 19% on a year-on-year basis for first half of FY26. Now, given these numbers, it seems that Hudco is on track to achieve that 50,000 crores of disbursement that they were aiming for FY26, because for the first half itself, it is at 25,000 crores. When it comes to IRDA, here also we saw a strong set of numbers. Sanctions increased almost by 85% on a year-on-year basis for the first half of FY26. Disbursements that increased almost by 53%, and as a result, when we look at loan book, that is also up more than 30%. So definitely both the companies came up with strong numbers. Let's see how ROAs are going to be for these companies during the results. But as of now, good set of numbers in the quarterly updates for these companies.
50% growth in disbursements. Thanks very much, Gaurav, for that. Well, let's just talk about RateGain, Allied Blenders, and NewGen. RateGain is the first one, and it's a big acquisition. They raised money a couple of years ago and been sitting on that money, and they finally deployed it. Vinny is here with details. Vinny, over to you.
Hi, yes. Good morning, Prashant. So, important and a big acquisition that's come in for RateGain, like you mentioned. Now, this is an acquisition of Surgeon, which is going to help them furthermore strengthen their AI-led capabilities, which they've been focusing on for a while. Now, obviously, this transaction is valued at $250 million. Internal cash is what they have, as well as they'll be raising some debt. So there is going to be a component of debt also, which they'll be funding this acquisition through. Now, obviously, this is a very big acquisition because if you look at Surgeon's overall revenues for calendar year 24 was $172 million, while RateGain's FY25 revenue was around $127 million. So big acquisition there. Though EBITDA for Surgeon is at around 12%, the EBITDA margins for RateGain is at 22%. But nonetheless, a very big acquisition in the right step for the company, and we could expect green here. Other than that, we have Allied Blenders. Mild green is what we're expecting here. The company has commissioned PET bottles manufacturing facility in Telangana. This is the backward integration that the company has been focusing on. This facility will have an annual capacity of 600 million bottles. Lastly, we have NewGen Software that's going to be in focus as well. We have a few orders that have actually come in for NewGen Software. Now, the first one is from Wipro Financial Outsourcing Services, and this is going to be for software license implementation as well as maintenance services. The value of this order is around 2.9 million pounds. The other one is a master service agreement with a leading bank in Caribbean region, where it's around a value of around $1.63 million. The other one is, again, a support for loan management services for $5.6 million from eProcess International in Ghana. And the last order is from an international business proposal, which is coming from 1.73 million Kuwaiti dinars in Kuwait. And a lot of order wins. NewGen could see a positive up move again as well.
Okay, all right, got it. Vinny, we'll keep NewGen on our radar as well. We have Ria joining in. She's also watching out for a couple of names. Which ones are these, Ria?
Well, yes, Surbhi. The first one is Dynamatic Technologies. They recently hosted the senior leadership of Airbus at their Bangalore facility for the door inspection of the A220 doors. Now, the company had signed this contract last year in February, and currently the project has been industrialized and all 8 doors remain ahead of schedule. The next stock is Time Techno. They have received the BIS certification for PE pipes for gas distribution networks. Now, these polyethylene pipes offer significant advantages, including lightweight design, high durability, as well as extended service life, and the company is expecting around a 30% growth in this segment. Also watch out for Pricol. They have an exclusive MOU with BOE Vatronics. This is being done to establish an exclusive collaboration between the two companies for localization of the optical bonding of LCD and TFT displays in India for two-wheelers, three-wheelers, as well as commercial and off-road vehicles. Also watch out for Atlanta. They have entered into an agreement with IRCON for a project for which the total value is rupees 2,485 crores. Now this is being done to undertake the contract pertaining to the construction of the Bandara Gadchiroli access controlled expressway in Maharashtra. But remember, the market cap for Atlanta is just about rupees 315 crores, but nonetheless this will be a big order for them. The last stock that we're watching out for is Seagull Limited. They have received an LOI for a rupees 225 crore development work from HP SIDC, and this is for the development of a bulk drug park at Una district in HP, and the execution period for this is around 18 months.
Okay, all right. Thanks a lot for that, Riya. Quick recap of all the stocks we just discussed. All of them have positive news flow today. Hutco, IRDA, RateGain, Allied Blenders, Newgen Software, Dynamatic Tech, Time Techno, Bricol, Atlanta, and Seagull. All of them react to positive news flow. No stocks from our top 10 list should be opening up in the red. But let's hop across to Manisha Gupta. She's joining in to help us out with all the commodity action overnight. Manisha?
Nigel, thank you for that. Well, all my headlines start with this expectation of shutdown in the government in U.S. And for the crude oil prices, it also has to do with the two hurricanes threatening the East Coast right now. So after that decline, 2 days of decline, we've seen a rebound come in for the crude oil prices. The decline in U.S. inventories by 3.7 million barrels also seems to be supportive. But all eyes would be on also the OPEC Plus meeting on 5th of October, where they are going to decide about the November output. October, remember, has been 137,000 barrels per day. November could see a surge to almost 270 to 411,000 barrels per day. So that number is what the street really seems to be waiting for right now. In the meanwhile, we also have seen the U.S. President's statements about Israel backing for Gaza peace plan, but there are uncertainties there as well. So just too much floating around, and that seems to be bothering the markets. Having said that, after that knee-jerk reaction yesterday, you are looking at a rebound come back in case of precious metal prices. So gold is trading on a firmer note, $10 away from its all-time highs yet again. Remember, we've seen 17% of gains come in for gold prices for the third quarter. Silver, as always, as we've seen in the near term, outperforming with 30% of gains in the third quarter. The markets have been firm, of course, because of the buying resumption of interest rate cuts and flows in the ETF holdings that we've seen. Most importantly, it is going to be about the U.S. economic uncertainty that seems to be keeping the prices higher.
Okay, all right. Manisha, thank you very much for that. So gold is shining. We'll take a break. We're back. Amnish Agarwal of PL Capital with some fundamental stock conversation coming up in just a bit. We also, by the way, will be talking metals with Vikash Singh of ICICI Securities. So a bunch of stocks there in focus as well. Welcome back. One of the big losers yesterday in trade was KPIT. The KPIT stock sold off almost 11-12% at one point and ended about 9% lower, just under 1,100 rupees. Kishore Patil is co-founder and managing director and CEO at KPIT Tech. He's joining us. Mr. Patil, really appreciate you sort of speaking with us. Unscheduled, sir, and usually we get to speak to you on around the time of the quarterly release. But the quarter is now behind us. So is the market worried about perhaps some kind of some news flow on the back of which it sold off? Because volumes were very large and there was some really concentrated selling. Has something changed, sir?
No, there is nothing actually from that perspective. So this must be some individual investor making a call. We have no idea about who the investor is. Of course, not a promoter or any people we know of. So I think this is something which we saw it also in the market yesterday. So it has nothing to do with anything. I think as we have been saying, we have given a detailed view about the market, where we are and what will happen in future. So I think we stick with what we have given in the writing. I think this is just something which an individual player has done, and then there was a more supply in the market which has impacted the price.
Right. Is that a generic comment, sir, or you know for a fact that there has been a large individual entity which is checked out?
This is general. Frankly, I'm traveling on the road, and I think my team also.
Okay, that's a generic comment. I just wanted to clear that.
We don't get the data.
Of course. Is there any change in your financial projections from as opposed to what you put out earlier?
No, I said that what we have said, it is we stick with what we have given in all the commentary on the business and what is said. So there is no change in that.
Good morning, Mr. Patil. Appreciate you coming on the call, sir. There was also some buzz of one of your large clients, like maybe a Volkswagen or another large client, one of those deals not getting renewed. Should investors be a little bit cautious on this? Any of your big deals come up for renewal, and is there a fear that it doesn't get renewed?
I will not comment on any. No comment on any such thing. There is no difference. There is no change. I think this is we don't like to respond, but I'm just telling you there is no change from where we spoke last time.
All right. So, but there's no risk to any large client. Could we take that on board at least? Or in the near term, there is no large client that comes up for renewal, and there is no risk to that, you believe? Is that, should we take that on board?
Anything. No, yeah, absolutely. Absolutely. And not, and we also all acquisitions we have said they are in line with what we have given. They are getting integrated in those times.
That's fine, sir.
So there's no change then from what we have said.
So no large client deal renewal, which is which there has a sword hanging over. You believe things are going as per plan, correct?
Yeah.
All right.
Yeah.
You earlier, sir, you didn't give us a fixed guidance, but you earlier said that the second half of the year would be far better than the first half, and your margins will hold on to that 21% odd ballpark. You're sticking to that, right?
See, I think we are sticking to what we have said, that our margins we will be in a position to hold, and you will see the shoots of growth to start with from Q3. I think we are sticking to our comment.
So October to December, third quarter is when this will start coming on. Growth will start to pick up, right? Mr. Patil?
We have said that you will start seeing the shoots of growth, yes.
Yeah. On an overall basis, sir, I have this JP Morgan report which says FY26, they're expecting a 1% degrowth on an organic basis. Is that in the ballpark correct?
I will not comment on any other part report. I think we know what we have given, and I think I have not seen anything, and it's hard for me to go anything beyond what we have already sold.
Okay, so as of now, you're telling us, clarifying that there is no risk to business. Things are status quo as it was at the end of the first quarter, and that's what you're assuring investors, right?
Yeah.
Just one final question, sir. We are looking forward to our chat at the end of quarter two. But at the end of quarter two, do you think you're going to come up with a guidance for this year? Because we don't have a concrete guidance still.
No, we may not. We may or may not give the guidance. We are not at it. We are still working. We are doing our business, which is very intense right now. But I'm not sure right now. I'm not saying.
All right. So FY26 could be a washout, but optimistic that you return to double-digit growth in 27 and 28?
I will not say anything.
Mr. Patil, I think he's being guarded, and rightly so, because I think the numbers, etc., are going to be released soon. Mr. Patil, we'll leave it there, and thank you once again for joining us. Festive greetings to you and the team, sir, as you continue to execute at KPIT. And as you said, you're joining us from the road, so thank you for that. So that's the KPIT management after yesterday's sharp fall. I mean, the bottom line is no change in terms of financial projections, guidance, etc., from whatever they have said earlier, and not committing to whether they will provide one at the end of this particular quarter. But they did say third quarter onwards, things will start to look a little better. Amnish Agarwal is with us at PL Capital. Amnish, you heard that KPIT conversation. Any thoughts on the stock?
The main thing is that there is some pressure on the auto side, particularly in some of the developed countries, developed markets, including Europe. So that is something which is known. So I think if there is some fundamental reason to it, I think market today, in case of any stock, is not in a position to absorb any sort of a fundamental shock. So I think it is better to, I would say, wait and watch how the numbers actually pan out. Because if the fundamentals are intact, then there is a possibility, and this is not only for KPIT, it applies to every stock. But if there is a fundamentals, a big change which is happening over there, then one need to be cautious.
Okay, so there is KPIT in that sense. Amnish, what else are you kind of sort of focused on individually? Lots of big movers. Rate again, do you have a view? $250 million acquisition, finally?
No, we don't have a view on it.
You don't track it. Okay. Tata Investment Corp was the largest volume-led gainer yesterday. It's like it's almost like a mutual fund. Lots of holdings, 20%, 10,000 rupee plus now. I'm not sure what happened. There was that Tata Sons sort of deadline yesterday as well, which passed without incident. I'm not sure whether this was on the back of that or something else. Any view here?
You see, usually all these investment companies, they trade at a huge discount to what is their actual NAV. So in these kind of companies, whenever there is some unlisted arm of the group which is there in their investment portfolio, so any rumor with regards to that, or you can say, I think that could be the only big trigger happening, because if you look at all the listed universe, there is the stocks are, or the market is under pressure, and there is no reason to believe that due to that the stock can actually go up. The logical thing seems to be that some of the other investments which they are having in their portfolio, which could be, you can say, any unlisted company, so that could be, you can say, the major reason for this sharp run-up.
Okay. Amnish, hi, good morning. Good to see you. I want to ask you about the alcohol companies. And we are supposedly getting into peak season. That's Diwali, then you have Christmas, and you can blame it on the weather as well if it gets a little bit cold. Two stocks will in focus. One is United Spirits, because talk is that they could reportedly be selling their IPL franchise, RCB, for an estimated value of $2 billion. We'll have to see whether or not the deal happens and if they get that sort of a valuation. So what's your view on the stock? And the other one is, Allied Blenders. They've been focusing a lot on premiumization, a lot on backward integration as well. And, I read a Jefferies note, they believe they're the dark horse for the time to come. They could potentially surprise on the upside. Your view on both these two names?
Okay, see, disclaimer being that we are not covering any of these two names. But having said that, if United Spirits actually, you can say, is able to sell the franchise of IPL, I think that could bring loads of cash into the company. And now it is a debt-free, cash-rich company, and it's also not paying nice amount of dividends. Secondly, as per the weather reports, this year winter is likely to be very harsh, and harsh winter actually works well for all these spirit companies. So to that extent, one can expect some sort of an uptick to happen in the volumes of all the spirit companies. And United Spirits as a stock, particularly if you see, it is very range bound in the last year or so. The stock has now not moved up. So any trigger on account of your RCB deal, that can actually bring some spark into this stock. Regarding Allied Blenders, I think ever since the stock has got listed, I think the company has now turned the corner. It is reporting profits on a consistent basis. And if you look at the overall scenario in the spirits industry, across all the players, excluding even you can see the MNCs. So they have been premiumizing, they have been innovating and launching new products, and interestingly, they have been able to create a niche and gain share in the market. So to that extent, not to go into you can say very specific numbers, but right blenders, I think the economic conditions for this kind of a recovery in the company are right. Because today the consumer is much more acceptable to the domestic companies launching the premium products, innovating, and all those companies have done well and they have been divided if you look at the trend in the past 2-3 years.
Okay, all right. A quicker conversation than usual, Amnish. Thank you very much for joining us. Appreciate it. We'll take a quick break. We have the metals analyst Vikash Singh of ICICI Securities coming on in just a bit. Stay tuned.
Welcome back. Well, you're tuned in to Bazaar Morning Call. You're on CNBC-TV18. As promised, let's get in Vikas Singh of ICICI Securities, who joins us to talk about the trends in the metal sector. Hi, Vikas. Good morning and good to see you. When I recall a couple of years ago, probably on this date itself, where people were fearing about Vedanta. The stock is in trouble and the promoter entity is in trouble. And you were one of the lone voices that said this is a good opportunity to buy. The stock, I think, has doubled since then. What's your view on the stock, and do you believe that it's the best play on metal since it has everything? A little bit of zinc, silver, the parent entity has the copper, entity, but otherwise it's a more wholesome play on commodities. Your view?
Good morning, Nigel. Thank you for having me on the show. Yes, so basically we are still bullish on Vedanta. If you look at the commodity prices, there are three main commodities are aluminium, zinc, crude, and then silver. All four has gone up. Crude was more or less stable, but zinc, lead, aluminium, and silver, especially silver, has gone up significantly. So yeah, there is still more juice left to Vedanta.
Okay, how much juice? Because there are so many people who are raising so many issues with Vedanta. They have an outstanding debt issue. Then you had that international research company come out and make all kinds of allegations. There's, the whole demerger is still at the NCLT, this 5-way demerger. What makes you bullish and how much more juice?
We are bullish on commodity prices, to be really honest. So we were bullish on silver. We were bullish on zinc and as well as aluminium. Aluminium, especially because if you look at the aluminium, they are going into deficit next year. China is capping their capacity at 45 million tons. And currently, aluminium is one of the largest contributor in the EBITDA for Vedanta. So that's what to continue to benefit them. They are also having backward integration, though it is slower than what Street was expecting. But eventually, they would have their own coal mines as well as some of the bauxites. So yes, that backward integration would also help them immensely.
Okay. So purely on the business case, purely on the way these metal prices are moving, I guess your bullishness is stemming from just that. Their exposure to some of these base metals as well. Actually, speaking of the rise in metal prices, Vikash, people have made a lot of money on, say, Hindustan Copper. Actually, metals have outperformed the rest of the market in the last 1 month, right? Even ferrous stocks like Tata Steel, etc., they're up 6, 7, 8%. Hindalco has risen. If I were to ask you now, from here on, for the next quarter, October, November, December, for the one or two stocks that could outshine, which ones could they be? Could, say, the ferrous pack play catch up? Or will the bullishness continue to be with copper and then therefore maybe a pure copper play like Hindustan Copper?
So we will not comment on Hindustan Copper since we don't have coverage. But if you look at the overall copper, basically, the bullishness is more on a supply side disruption, basically. Codelco had their guidance cut. They produced for 1.45 million tons last year, got cut their guidance to 1.35. Recently, Indonesia's Grasberg mine, which is the second largest mine, having 3 to 4% of the global production, has also gone down because of the mudslide. So yes, copper is bullish, but we would not comment on any company specific at this.
That's okay. You give us a new name. What I'm asking you, the next 3 months.
So we are still bullish on next 3 months. We are still bullish on Vedanta, and in ferrous space we are more bullish on the integrated players, basically, because we think that there would be a price hike, and since the iron ore price has already been hiked in the 2Q itself, their spread improvement could be slightly better than some of the non-integrated players.
Okay, so preference would be what? Tisco, SAIL, Tata Steel and SAIL. Got it. Just one more point. We also have been highlighting, and various sell-side notes as well have been highlighting, that the domestic steel prices are at a discount. If you compare it with the imported Chinese steel, or you compare it with imported steel coming in from the FTA countries as well. And now we're getting into a seasonally stronger period post the monsoon. So probably a price hike could be on the cards. Are you working with that? If yes, give us a rough quantum of a price hike both on steel and iron ore, since you said that you're expecting iron ore prices to move up. So we could already have a reference point if that comes about.
So actually, we said that iron ore prices has already moved up in 2Q itself, basically, which basically with the lag effect would hit them, some of the non-integrated players. Steel prices, we are expecting 1,000 to 1,500 rupees kind of the price hike by the end of October. This would start on the long side first and probably would spread to the flats at a later stage. Iron ore, we think, given the current international prices and post-monsoon, the supply usually increase. We are expecting flattish trend in the iron ore prices.
Appreciate you joining in, Vikas. A short but effective chat. Wishing you a good day ahead. And we noted that call that you had on Vedanta as well. 2 years ago, I recall, around this time, October 1st, the stock was at sub 250 rupees, where fears of the company not able to servicing their debt. Big U-turn from there. Well, for the time being, I think we'll slip into a break, come back. We'll focus on pre-opening. We'll also get you some calls coming in from Sudarshan and Mitesh.
Welcome back. 2 minutes to go for the pre-open session. The F&O cues as we start a new series, new month. Mangalam is standing by with exactly that. How does positioning look now? Mangalam, over to you.
Well, if you look at, the September series, the Nifty, for all its volatility, added about 110 points on the way up. So that's a positive. And as we move into October, the interesting part is out of the 5 last October series, 3 of them saw big gashes on the downside. But the ones that saw an up move were actually quite high. So October 2022, for instance, saw a move of almost 919 points on the way up. Last October, we saw a big decline of 2,000 points. Let's see what happens this time around. Conviction on the short side is fairly high. Why do I say that? Because one, rollovers are at nearly 83%, and this compares with an average of close to 80%. And the Nifty is starting this series with an open interest of 1.71 crore shares. This compares with a 3-month average of 1.5 crore shares itself. So these factors tell you that there are, heavy shorts in the system, and the FII shorts itself is telling you that data. Start of September, we were at near record low long positions for the FIS. Start of October, it's lower than even that. So last 3 series, August, we started with 10% FII long exposure, went to 8% in September, and now 6%. Only 6% of FII positions are on the long side, and we have 94% on the short side. But it's interesting to know that the clients are all on the long side, and every time the FII positioning has been so, limited when it comes to the long exposure. The next few series, we've seen big moves on the Nifty. For instance, April 2023, FII started the series with 9% long exposure. Next 4 series, the Nifty was up 2,600 points. November 2023, FII started with 11% long exposure. Next 4 series, the Nifty was up 3,000 points. As recent as Feb 2025 as well, FII started with 11% long exposure. The next few series, we saw an up move of 2,300 points. So for perspective, September started with 8% long exposure. We've added 110 points. October with 6%. Let's see what the next few months hold for the Nifty. For this month itself, the big triggers, the most important one starting today, the RBI policy outcome. Thereafter, you'll have the second quarter quarterly updates and then the results. Developments around US-India trade talk, something that we'll monitor very closely. And finally, this is also the month where you have both Dussehra as well as Diwali. So festive season sales after a GST rationalization is something we'll be tracking closely.
Okay, all right. Now, thanks for that, Mangalam. And speaking of festive sales, and I think it's already showing up in some of these two-wheeler numbers and the auto numbers that we're getting, because Bajaj Auto has gone back above the 5 lakh units a month mark after many, many months. It's been a last, I don't remember, I don't have the exact date, but last several months have been a struggle. Now they have revised it back and they're above the 5 lakh units per month sort of a run rate. And the exports picture was looking very good as well. 18% growth in exports. And I think domestic two-wheeler sales have also really picked up. So good going out there. Let's bring in our technical experts and get a sense of how the trading setup is looking like today. Sudarshan Sukhani as well as Mitesh Thakkar, both with us. Gentlemen, good morning. So, well, hopefully October will be a little better for the bulls as we get into the full, festive period. So, Darshan, what would your approach be to trade? Are you looking to buy the dips at all?
Yeah, good morning. Well, today I'm not looking to buy any dips. It's much better to stay away. But this is only a very short-term, analysis. That's for today or maybe for tomorrow. See, what's going to happen is that October will be dull. October is seasonally weak. But once October ends, we enter into a very seasonally strong period from November to May. And the process should be that if you see sharp dips in October, that's a buying opportunity for the next few months. So intraday, today, I would say avoid the markets. Markets may be choppy or even down. But in the month of October, look for going long in the Nifty.
Okay, so intraday, be nimble. But overall, a little more optimistic about the month ahead. Mitesh, same question to you. Looking to buy the dip for today or, still not too convinced about a pullback?
Good morning, Subhi. The last 2-3 days I've maintained that while there could be chances of a bounce back, the PCR is on the slightly oversold side. The bigger worry is the medium-term charts which have been damaged with the last 8-9 days of fall. So I maintain that a bounce back would be a chance to possibly take some short exposure. Unless until we cross 24, 850, 900 zones, I think the idea would be negative. And the VIX also has started to slightly spike up. But on an extreme short term, which is a 1-2 day kind of a trade, there could be more signs of a bounce back as you keep getting oversold. The last 8-9 candles have been on the negative side. And a lot of stocks have reached their short to medium term support area. So maybe you will see the next 2-3 days play out well. But on the upside, I think, what I'm looking at is either a sign of strong weakness around 24,850, 900, or a situation when we have a breakout beyond that. So I think the decisive index trade will come around 24,850 levels. Or else, my belief is that we'll test the 24,400, 350 mark.
Okay, all right. So Mitesh, for the time being in the very near short term, looking to short the bounces rather than buy the dips. Let's get to stocks as well and individual trading ideas. Sudarshan, what's on your list?
Well, it's mainly buying. See, should be even when the market is a little disappointing, there are 2,500 stocks. Some of them usually give opportunities. LIC Housing is a buying opportunity with a stop under 886. Hero Motocorp is a buy with a stop under 53.54. And Max Financial is a buying opportunity with a stop under 15.48. I have a single intraday short, that is JSL. It's come in my list earlier also. Sell with a stop above 7.56, but look for good opportunities on the long side. October could be the final lows.
Okay. Mitesh, your stock list?
So I have a mix of buys and sells. I have a sell on Patanjali, which kind of broke below a consolidation. So keep a stop at 587, look for targets of 550. The rest of the calls are on buying side. So Bank of India is a buy with a stop at 121 for a target of 130. Power Finance Corporation is a buy with a stop at 405. Look for a first target of 420. And you've been talking about metals and they've done well. And Vedanta features on the list today. Buy with a stop at 459 for a first target of 478.
Okay, so those are individual sort of stocks from both our guests. Well, let's move on. Allied Blenders and Distillers has inaugurated their PET bottling unit in Rangapur, Telangana at an investment of 115 crores. My colleague Shilpa Ranipeta caught up with Alok Gupta, MD of the company, began by asking him about the unit and what it does for them over a period of time. Listen in to a slice of this conversation.
This is a state-of-art facility built with one of the most modern Japanese technology, including robotics. This facility is designed to produce over 600 million bottles a year, about 50 million bottles a month. I think what makes this very interesting, it's in line with our backward integration program. It drives margin extensively for us. Of the 600 million bottles that we produce, we will consume pretty much everything captive, so we don't have to look for a customer. What we're producing, PET bottle, one of the big challenges really logistics cost. If you take a 16-tonner truck, the actual weight of PET is only 3 tons on it, so it's not the most logistics friendly item. But where we are standing today is our PET manufacturing plant. To our right is our bottling plant. The distance between the two is about 1 kilometer. So not only will we be able to capture the margin by going captive, but I think we'll also be able to bring down our total delivered cost extensively.
Right. And, along with this, there's also another capacity expansion that you have in plan, which is the single malt unit that is also under construction right now. Quickly give us a sense of by when do you expect that to be operational? And, earlier when we were talking, you also mentioned that that will help you also launch a lot more new brands, etc. So just talk to us a little bit about that.
Absolutely. I think our single malt plant is going to be the first single malt distillery. Essentially, it's going to be extremely value accretive. It will help us in two areas. One, as we all know, that malt is becoming increasingly difficult to source and is becoming expensive as well, because the Indian single malt story is really capturing the imagination of the global consumers. What this single malt distillery will do is to provide us enough high quality malt that we use for our high growth brand like Iconic, which has gone to cross 5 million, and Q1 alone we did about 2.3 million cases. So we go from 100% buy to 0% buy, which means we have 100% captive malt for uninterrupted growth for our prestige whiskies. Secondly, it allows us to then participate in the global high growth Indian single malt story, and by 2029 we are looking at launching our own single malt. What we've done with our unit is to dedicate it to the Rangapur. It has a very, very interesting history of last 2,500 years. There's many things that have happened, and we're trying to capture the soul of Rangapur in this malt, which of course will get launched in 2029. So it serves two purposes. One is to give us supply security for driving growth of our prestige whiskey, and secondly allows us to launch luxury brands in our portfolio.
Right. And, you know, in the slightly longer term or medium to longer term, then what does this do to your realizations with all this capacity that you're adding?
So let me add one more capex program, one more element that we have invested in is our distillery in Maharashtra.
Yeah.
The total capex that we've announced is about 527 crores. It covers 3 units. 2 of them are here in Rangapur, which is the PET facility and the single malt facility. In addition, we've also announced a ENA distillery in the state of Maharashtra. The total investment of 527 crores, of which 25% was invested in FY25, about 60% in FY26, and balance in FY27.
Right.
The PET manufacturing is up and running to capacity as we speak. The malt unit will go live in Q4 of this financial year. And of the 60 million litres of ENA in Maharashtra, 11 million litres is already under production, and for balance, we are under approval. So by FY27, we expect this investment of 527 crores to add about 300 bps to our margin.
Right. And so when we talk about that, you, I think most recently also spoke about your targets when it comes to gross margins and EBITDA margins also, and a lot of cost savings that you're looking at through all of these capacity expansion that you're doing with your own plants, etc. So run us through that. You know, how much are you looking at in terms of a target when we say both gross margins and EBITDA margins by about FY28?
Sure. So FY24 pre-IPO, our gross margins are about 37%. I think our margins have consistently improved. FY25 last financial year, we are almost at about 42%. Q1 this financial year, we're about 43%. That gets us into what we call as a pure parity.
Yeah.
We are just about started our capex cycle. Like I explained, we should see another 300 bips expansion in our gross margin. So we expect our gross margins to be about 45%. That gets us to the top end of the gross margin cycle.
Yeah.
Moving to EBITDA, our EBITDA margin in FY24 was 7.5%. We are currently at about 12.9% as we speak. We expect 300 bips to come from our backward integration program. And once the FTA is fully up and announced, which we expect by Q4 of this financial year or maybe Q1 of next financial year, we expect another 200 bips to be added. So our EBITDA guidance of 7.5% in FY24 over the next couple of years is to hit about 17% gross margin.
Okay, that's Allied Blenders. Let's quickly get back to our technical experts for a quick final idea for the morning. So Darshan, what is the stock you'll go with?
I'll go with Hero MotoCorp and with a stop under 53.54, and I have some small trading positions in it.
Okay, Hero MotoCorp. What about you, Mitesh? Your call.
I'll go with the buy on Vedanta for targets of 478.
Vedanta and Hero Moto. Got that, gentlemen. Thanks very much. We'll come back to you later through the course of the day. Right now, let's go across to Ekta very quickly to understand if this Pfizer agreement with the Trump administration and this whole push of making drugs cheaper in the US, whether that has any implication for Indian specialty companies, Sun Pharma being the biggest name out there. Ekta, help us understand this.
Thanks for that. Well, you know, the news is that Pfizer, in fact, has signed a deal with the Trump administration, which is going to be reducing prices for Medicaid patients in line with the most favored nation pricing scheme. So that means that basically they will be reducing prices for Medicaid patients, that's Pfizer drugs. Now, they will also be offering steep discounts to patients while selling directly to them. Additionally, in lieu of this, Pfizer is going to get a 3-year relief from any tariffs which could be imposed by the Trump administration. So what this does is that basically it's a quid pro quo deal which Pfizer really has struck with the Trump administration so that they do not, get away from the tariffs. Now, what exactly does it mean for a company such as Sun Pharma? Remember that Sun Pharma has a specialty portfolio. They have 19% of sales coming in from from the US when it comes to, they have from the specialty portfolio in particular, and a majority of that from the US. So this could be a positive read-through for Sun Pharma, but you're talking about a large MNC company such as Pfizer striking a deal. So the impact on Sun Pharma could possibly be a sentiment positive and probably gives a silver lining that yes, there is a way out if in case things do get really bad.
Okay, all right. We'll keep an eye on this one, right? Important one in terms of news flow, pharma, I mean, lots of stuff going on and lots of pulls and pushes here. Quick recap of the top stocks we covered since 8 o'clock in the morning. So Hoodco, IREDA will come up on your screens. So 0.6 and 2% respectively. Rate gain, finally that big acquisition coming through, and rate gain is up about 3%. Well, used to be a time of 30, 40, 50% growth, but with acquisitions, and without acquisitions, organic growth fell. We'll love to get a chance to sit down with the management there. Allied Blenders was another one which was up on your screen. Dynamatic Tech, Time Technoplast, Precall are some of the other names which are going to react to a specific news flow. And there's Atlanta and Siegel, which are coming up with some opening rates as well. So what do we have as far as the market open is concerned? Should be coming up in a couple of seconds from now. 10 points, by the way, is what the Nifty's got. So it's very, very quiet with regards to the action activity. And I guess, waiting and watching for the Reserve Bank of India, a dovish hold is the comfortable consensus out there, although some have not ruled out a cut as well. So it's a close one. So we'll see. 24,620 on the Nifty. I think we get to market open just about now. There you go. That's the opening bell. It's a quieter start. Nifty Bank, unlike the Nifty for the last 2 days, has been a little stronger. We've got positive closes for the Nifty Bank. So 0.1 to 0.18% on the Nifty Bank, 0.19 on the Nifty. Mid-cap index is up about 0.25%, and you've got the small-cap index, which will come up as well. So broader market doing just a tad little bit better. 600 up, 400 lower, but this is just, very, very initial rates and market breadth out of the gates, so as to speak, and it'll change and more stuff will come on. Nifty heat map gives you a quick sense of how we're likely to start, and we'll go straight to individual names and stocks. So Shriram Finance, Sun, Mahindra on the other one end, and BEL, HDFC Life, SBI Life, etc. on the other end. More up than down. That's the Nifty heat map. 30 points higher start, 24,640. Surbhi.
No, Prashant, my mid-cap screen was open. So before I talk about large caps, let's just see if we can get Tata Investment Corp up. I mean, what is with the stock? 20% yesterday. Unless my screen is frozen, no, it's not. It's another 5.5% up on that stock today. 6%, surging like there's no tomorrow. We'll try and get you more inputs on this in a bit, but that's definitely a mover. We're talking 25% from today and yesterday and today morning opening. Anyway, for the Nifty, we don't have so many major moves. Shriram Finance, now the papers had put out a story about the Japanese conglomerate Mitsubishi trying to take a large chunk of equity in the company. The company came out and denied that. Stocks up about 3% at this point in time. The Sun Pharma, Ekta just explained the implications of that Pfizer action in the US with the Trump administration, 2%, so not too much of a reason to worry right now, it seems. And autos are back because those numbers that have been coming in, and we'll get more through the course of the day today. Auto sales numbers so far have been looking good. Bajaj Auto is up almost 1%. Mahindra & Mahindra is rallying 1.4% as well. Reliance is supporting the bulls case today. It's up about 0.5% as well. Lever is up about 0.25%. So then what's pulling the Nifty down? On the downside, there's some profit taking in BEL, Eternal, HDFC Life and SBI Life. And Bajaj Finance is a little quiet, 0.5% lower, as is HDFC Bank, not quite joining the festivities, lower by about 0.5% at this point in time as well. Overall, the Nifty just 20 points higher. Nigel.
Well, you spoke about Sun Pharma, Surbhi, and Pfizer is the one that's listed here. That, in fact, has popped up. That's up close to 5%. This after Pfizer has agreed to lower US drug prices, and that's what helps them get exempted from tariffs. So I guess the street is reading that positively, moving on rather large volumes for a counter like Pfizer. Sorry, I'm not sure what's going on there. SFB, that one is up close to 13%, and the volumes are unusually high. So Saryodaya SFB should come up for you on the screen. Big move is what you're seeing on that stock. Escorts, well, that one as well has popped up. Saryodaya now up close to 18%. Big move is what you're seeing on that particular counter. You have Escorts as well, that's moving very, very well. That's up close to around 4%. KPIT, they put out a clarification. They were here on CNBC-TV18, and they said that business is functioning as normal. Probably yesterday's decline was because of a large investor pressing the sell button. For the time being, the stock is stable. We'll have to see whether or not it can pull back some of that ground that it lost yesterday. Prime Focus, I recall the stock moving from circuit to circuit, large investors coming in there, buying large chunks in the company. The stock went dancing away. Now, in fact, the stock is under some pressure. Some mild profit taking is what we're seeing on that particular name. But as Surbhi mentioned as well, Tata Investments, extremely high volumes. That stock continues to buck the trend ahead of that Tata Capital IPO.
Well, lots happening, right, in terms of individual action. 24,630 is where the Nifty is at. 17 odd points higher, 19 points higher is what we have going on. Nilesh Shah is with us, Managing Director at Kotak Mahindra Asset Management Company. Nilesh bhai, good morning. Great to have you with us here. Happy Vijay Dashmi and great to see you, sir. So lots happening.
Yes, every day is full of events. And as a Russian proverb said, may you live in interesting times. We are truly living in interesting times.
Maybe just too interesting,
interesting,
right?
yeah.
Make it a little less interesting. Better, but Nilesh bhai, let's talk about the push from the government in that sense, right? And when I say government, I mean authorities in terms of trying to boost consumption. We got two tax cuts, income tax cut, GST cut. RBI has done 125 basis points in cut. And today, we've got another decision on the Reserve Bank of India. What is your sense, Nilesh bhai, on what the RBI does today? And on the other side of that question, if you can also tell us what have you picked up? We'll get auto sales numbers, etc. We'll get the first sense of how the GST impact is played out. So if you are able to pick out and just tell us if it's been as encouraging or what. Go on.
So Prashant bhai, we are getting squeezed on geopolitical side. The US tariff at 50% is essentially a trade embargo, especially on labor-intensive sectors like aquaculture, textiles, gem and jewelry, handicraft. We have no option but to stimulate domestic economy, which is happening via income tax rebate that was announced well before US tariff. The GST cut came. Then there is interest rate cut of about 100 basis points since the RBI started rate cutting cycle. And then there is 8th pay commission. I'm sure government is also working on finding alternate exports market, especially in Europe, where rupee has depreciated 10 to 12%. The third will be stimulating private investments, because after consumption, we need a virtuous cycle of higher consumption leading to higher investment. And that's availability of credit, lower interest rates, as well as ease of doing business. So government is working on multiple fronts to stimulate domestic economy and to find alternate exports market to ensure that the adverse impact of US trade embargo is minimized to the extent. Now, in that overall trend, there will be minor blips. Between 15th August to 22nd September, people deferred their consumption. Fortunately, in automobile, they seem to have come back with cuts. So, and we are seeing, a large number of selling getting reported on a daily basis. My feeling is that the August as well as September GST collection could be a little bit subdued. And thereafter, there should be recovery. So clearly, we are living in interesting time. It's important to focus on longer-term trend rather than shorter-term blips.
That's always been the message from you, Nilesh, and so good to have you with us today as the festive season really moves up the next notch. So the 9 days of Navratri come to an end, and then is Dussehra, and then we go to the grand finale, towards Diwali. But Nilesh, I want to, before we talk about other things, and we will get to that flows question in a bit, but before that, I want to get your sense on this whole buzz in the IPO market. Earlier in our careers, I'm sure most of us will agree that every time the headline index was range bound, the IPO market would go thanda. This year, it's gone the other way, reverse. Just yesterday, I think our colleague Hormaz was telling us, over 25 IPOs just in September alone. So what do you make of this trend? Are you happy with largely the quality of paper? Is it getting excessive? Or do you think the market is matured? Because not all those IPOs are seeing a big listing pop. Many are just completely fizzling out. So your sense on the primary market?
So Surbhi, undoubtedly, our workload has increased tremendously. And it's literally inhuman for me to expect my analysts to cover every single IPO in detail. So by definition, we have become very, very selective. We have become very, very choosy. And majority of IPO, yesterday there was a WhatsApp message circulated. All these IPOs opened at a discount. And then I put it into our WhatsApp chat with the investment team. How many did we apply? And my head of research replied, sir, forget applying. We even didn't study these companies properly because preliminary we could reject them. Now, there is a class of retail investors which follow the quick money addiction habit. They all believe that 10 rupee NAV, 10 rupee NFO is a good thing to own. Similarly, they have misconception that IPO will always list at a premium and you will make money. Both these myths are wrong. But many a times people, instead of learning from other people's experience, learn by committing mistake. With the barrage of IPOs, undoubtedly, there is no worry on the quality side. SEBI has done a fantastic job on ensuring that only quality IPOs come. Institutional investors also have done a reasonably good job in ensuring that they invest in reasonably valued IPOs. Many of the IPOs which have opened at a discount had virtually no institutional participation. So my recommendation to investors, please don't make mistake on your own. Learn from our experience and go for those IPOs where you believe there is a reasonable institutional participation. And when I say institutional participation, I'm more talking about mutual funds, insurance companies, and pension funds, rather than individual family offices kind of companies.
So that's on the IPOs. The other factor of the market, and I'm just getting into the supply-demand dynamics now, is the fact that there is so much local liquidity. Obviously, there's liquidity that mutual funds are sitting on, and then the HNI and the family offices, because every time someone's coming and selling 3-4% of their company in the market, and they're sitting with this whole hoard of cash, it has to be deployed somewhere. So some of that is coming back to the market. So at the risk of sounding very unpopular, I'm saying, is the liquidity keeping the market afloat now? Would the current levels have been very, very different if we did not have some of this HNI/UHNI/family office liquidity? And how should we expect the next couple of months to be on this front?
So I do believe there is a fair amount of liquidity with domestic institutional investors. And many a time people have told us, like, why don't you keep cash? Why do you have to deploy? And I have requested them that if you are so bearish on market, would you like to short Nifty for 10 years? And then they go back. Then I request them, would you like to short it for 5 years? Then again, they don't respond. Then I say, would you like to short for 3 years? Again, I haven't met anyone who is willing to short Nifty for 3 years. People are worried about 3 months, 1 month, 1 year. We are making investment for 5 years and 10 years. We are requesting our investors to have asset allocation, moderate their return expectation, and invest over a period of time, keeping some dry powder for correction. Now, undoubtedly, next 3-6 months remain challenging. The FPIs are on the selling spree. They are saying for last 5 quarters, your earnings growth is single digit. Your valuations are at premium to historical averages. And most importantly, you are getting hit by US tariff and geopolitics. They are absolutely right in saying this. But we as domestic institutional investors are saying that look at the India growth story on a 5-year basis. We might be expensive on a 1-year basis, but we are the cheapest emerging market on a 5-year basis. Now, if you are investing for 3-6 months, probably it's time to stay out rather than indulge into the market. But if you are investing for 5-year and 10-year, then this correction is a great opportunity to invest into. Now, limited point here, Surbhi. It's not that we want to give exit to FPIs. We are bidding at a lower and lower prices. But FPIs have also learned from their experience in March 20. They sold 60,000 crore without price limit. We brought Nifty index from 12,500 to 7,500. Between October 21 to June 22, they sold 4 times more at 250,000 crore, but with price limit. And market came down from 18,500 to about 16,500. So it's a tug of war between FPIs on one side, DIIs on the other side. No one wants to give easy entry or exit to anyone. Everyone is negotiating price hardly. If we were not bidder at this price, maybe they would not have sold. And if they would not have sold, maybe we would have to buy at a much higher prices from promoter. So there is a tug of war going on. Both players are smart and they are having different time horizon.
It is a tug of war, but Nilesh is saying, don't worry, we're not here to give easy exits to anyone. And I'm sure, I mean, we have local fund managers, they're very, very smart. They're looking at whether it's IPOs, new managements, or whether, it's about valuations. I'm sure they're doing their job.
Right. Nilesh, morning. Good to see you in. Give us a sneak peek. How are the flows? Last time you told us, have no fear. The money is coming in thick and fast. As I always tell you, I'm doing my part, but there's only so much I can do. What's the feedback? Solid?
So the flows have reduced undoubtedly, Nigel. This is the time where people would have taken some money out to invest or spend on consumption. Generally, in festival season, we have seen some amount of redemption to either buy a house or buy a motor car or buy jewelry. And ultimately, wealth is there for spending. So there will be probably similar intensity of gross flows, but the net flows will be lower because of the redemptions for consumption or spending.
That's important, Nilesh. And I know you always call it as you see it. When you saw a month ahead where we were going to cross 43,000 crores, you called it. Now you're saying that there has been some redemption for maybe for festive purchases. So just dive a little deeper into that. Last month, we saw flows come down to about 33,000. From 43,000, it came down to net equity inflows, give or take, was around 33. I mean, how are you expecting that number to be now? And that's net equity without counting hybrid. If we add the chunk that comes in from hybrids, and that's becoming a larger chunk, right? Hybrid funds are getting 15, 20,000 crores on a monthly basis now. So then what is the kind of net support expected for the equity market? I mean, this month and going forward?
So I believe there is a higher allocation towards precious metal. And many people don't want to invest in precious metal directly, and which is why they are coming into multi-asset allocation fund. There is also push from fund management industry recommending customers to invest via multi-asset allocation fund. If you are HNI, you will get private banking service, wealth management service. But if you are retail investor, you don't get this. You don't get those services. In multi-asset allocation fund, India's best fund manager, best asset allocator, divide on your behalf between debt, equity, and precious metal. For example, in our multi-asset allocation fund, we took a call on silver, and to the extent what we could invest in silver, maximum permissible limit, we invested before this rally began. Now, these are the kind of services which customers are liking. Ye Harfan Maula fund hai, fill it, shut it, forget it kind of fund, and which is why they are attracting flows. On a longer term basis, I still believe SIP culture is doing very well. There is fair amount of liquidity waiting for correction. They will get invested when the correction comes. And we expect flows to remain strong. But please remember, we are not here to give exit to FPIs or to promoters. We will do what is right for our unit holders.
Yeah. But by the way, Nilesh bhai, this is a broader question on IPOs and primary market, right? Do you see signs? I mean, and you can only kind of, it's not a specific question on this or that, but do you foresee the music slowing down there? You know, when 60, 70, 80 times subscription doesn't, there's no guarantee that stocks start higher, stocks start lower. Markdowns from private to public, I mean, big ones, some of them. Is the music slowing?
Undoubtedly, Prashant bhai, I believe people will become more and more selective on IPO. They will look at valuation. You don't have to worry about business because SEBI is having a very good gatekeeping. But valuation is something which investor will have to decide on their own. I do believe subscription coming down significantly for expensive IPOs. Gone are the days where you will go to grey market, figure out what the premium is, and then decide how much to invest. I think as the reality bites in, as the myth that in IPO you always make money breaks, my feeling is that investors will become more rational.
Mm-hmm. On that point, Nilesh, and I know this is the critique or, shall I say, the debate that's always thrown at fund managers and large asset managers like yourself. And I'm going back to that statement that you're making. Oh, we have visuals from the RBI. That's the big event of the day, which kicks off in the next, I think, half an hour. 10 o'clock, we get the policy announcement, and the governor has just gone in. And of course, we have our team. Lata is going to be there to, give us all the action. Actually, okay, no, we've gone on this debate for a goodish bit. Let me change track now, because this debate can go on and on. Whether Indian institutions are giving an exit to all these promoters, all these private equity funds, and all these foreign investors that are, rushing out. Who's right? I think we'll only know in hindsight. Nilesh, sorry, you want to make a point?
Yeah. So whenever we have seen governor is wearing red tie, there is a rate cut. I don't know which color tie governor was wearing today.
I missed it. I think we'll go back and check on the feed. But to wrap that up, Nilesh.
Again, that's the myth in the fixed income market. Myths are there in equity as well as fixed income market.
I'm sure our colleagues are checking right outside. I missed it because, I was more focused on your festive colors. You and I think, are matching in festive colors today. But we'll check the governor's tie. Very quickly, speaking of the governor, what expectations? Rate cut today or not?
So it's a 50-50 call. The street is equally divided. But the best outcome will be a dovish language with the carrot of rate cut rather than a rate cut.
All right, Nilesh bhai, we'll leave it there. Thank you very much for joining us. Happy festive greetings to you, and we'll hear from the governor himself. 10 o'clock is the decision, and we'll be on it. Thank you. All right, we'll just talk about, I know I was asking Nilesh bhai with a quick pulse on sectors with regards to festive season, right? Vikas Gupta is with us, Managing Director at PG Electroplast, to talk about exactly that. We'll focus on three things: synergies from the 1,000 crore capex, room AC demand trends and outlook. I'll start with the second first, actually. And number three, update on the compressor joint venture with China. Vikas, good to have you with us here. Season's greetings, and really appreciate you coming on. So give us a sense, Vikas. The month has ended, the quarter has ended. The GST cuts, has there been a pickup? It's not the strongest. It's not the typical season for buying ACs in that sense. But anything you can tell us?
So good morning, Prashant. Festive greetings to all at CNBC-TV18. So basically, as per the initial channel checks that we have done with the retailers in Pan India, as per us, the south and west are still under pressure because of the incessant rains and the frequent rains which are happening in those parts of India. But we are seeing a good positive offshoots in North India, and in the last 1 week, the sales have picked up for all the consumer durables, especially air conditioners. The inventory which was sitting with the retailers, with the distributors, is I think getting cleared. And with the forecast and the order book that we see with our clients, we are quite optimistic.
Hi, Mr. Gupta. Festive greetings to you and your team. We really want to understand where your conversations have reached with respect to, the manufacturing of compressors. And I think you're looking at getting into a joint venture with a Chinese entity. Can you tell us more?
So, good morning, Survi. So first, I'd like to correct on that. So it's not a joint venture with a Chinese entity. It will be a manufacturing agreement where we will be manufacturing a compressors on their behalf. And it will be kind of a contract manufacturing agreement. And it is still in works, and we are still awaiting some approvals from the local government. The China partner is awaiting that approvals. So maybe, hopefully, we should be able to get it by the end of October or November first week. Then we'll be keeping an update on that.
Oh, okay. How interesting. But can you give us some sense that these are compressors that you'll make for what, the global market or for the Chinese market? How much of it will be for your own captive use?
So largely, the compressors that we will manufacture will be for the local market and for our captive consumption. And let us see how the things play out. We are still waiting for the agreement to be signed. It is not appropriate for me to give out all those details as it is still a work in progress.
No, fair enough. Just to understand the investment part of this, will you have to allocate any fresh money, or is it going to be part of your overall capex plan for the current year and the next year?
So that capex for the compressors is already factored into our overall capex for this financial year.
Because the approval was pending, right? And that's why this got pushed out quite a bit. Are you hearing anything?
So we are still waiting for that approval. So it is taking more time than anticipated.
But okay, now though there is a bit of normalization, etc., right? So it should. I mean, one would have thought that perhaps helps things along.
Yeah, so we are also hopeful, like the things are improving. The visas for the Chinese nationals have started coming in, and we are seeing a positive momentum, and we are hoping that it should get through.
In this month, right? That's what you said.
By end of this month.
And this is only a next year story, right? In terms of how this will all, I mean, late next year.
Yes. No. So if we are able to get the agreement signed, we should be able to start the production within 3 quarters from the signing of the agreement.
Okay.
So we already have the factory in place. We already created the infrastructure, the land and building, everything was already there in place.
Yeah. Okay. Now, Vikas, give us some numbers, just an update from the last time that we spoke in terms of the inventory, your inventory backlog. Where is that? What is the number at?
So, Prashant, it will be difficult for me to share the exact inventory number right now because please understand we have just closed the quarter and we are in a silent period. But what I can tell you overall, the demand is coming back. And the order book that, as I told earlier, the order book is looking quite strong. And we are hopeful that we should be able to clear all the inventory by middle of November for us.
Middle of November. You said November, December around is where
yes.
The excess should all go away. And you get back to normalized kind of inventory levels by January.
Yes. No, so we are expecting to normalize the inventory by middle of November.
Mid-November. Got it. So it's good to hear.
I just had a specific question on some of the recent most capex announcements, Mr. Gupta. There's 1,000 crores that you're putting to work in Andhra at Sri City. And then there was an announcement of another 1,000 crores of, I think, a greenfield project, which is in Ahilya Nagar in Maharashtra. So do you already have anchor clients tied up for this? By when do these facilities come on stream? I think it's 2 years at least?
So let me start with the Sri City announcement. So Sri City, we made an announcement of putting 1,000 crore of investment in Andhra Pradesh. That is spread over a period of 5 years. Please note that. For the initial period, the phase 1, we are planning to put up a capacity of refrigerators. The refrigerators will be the 1.2 million annual capacity that we are putting there. We are in discussion with some clients, and we are hopeful that we will have an anchor customer in place for our refrigerator business in a couple of months' time. So that project is already started on the execution phase. We are hopeful that we'll start the production for refrigerators by I think the third quarter of FY26, FY27.
Third quarter of FY27. So that's at Sri City. And the plan for Ahilya Nagar, that's also 1,000 crores. And by when does the revenue recognition start happening there?
So for the Ahilya Nagar, it is very near to our existing plant in Supa in Ahmednagar in Maharashtra. We have acquired a 70-acre. We are in the process of acquiring a 70-acre land parcel there. And this 1,000 crore investment is basically a capex plan that we have planned for the period of 5 years. So initially, we are going to put up a plan for further expansion of our AC capacity. So it is still not factored in. So the capex for that will be announced for the FY27. But for the refrigerator capex is already covered in our initial capex plan that we released for FY26.
Got it. Vikas, we wish you all the best of luck, and we'll speak once we have the numbers out, right? So look forward to our conversation then. We can maybe have specifics then. All right, we'll take a quick commercial break here. We're going to come back in just a bit from now. The markets, of course, holding, waiting, and waiting for, of course, the RBI. So we'll start with some RBI programming on the other side. Kaushik Das, Chief Economist at Deutsche Bank. Indranil Pan, Chief Economist at Yes Bank. Parul Mittalson of Standard Chartered Bank. With what they expect. So 16 minutes to go. The clock is ticking to what the RBI does at 10 o'clock.
Good morning and Shubha Navami to all of you. Welcome to our special monetary policy coverage, which comes to you straight from Mint Street. I'm seated in the RBI lobby, and joining me from the CNBC studios is my colleague Ritu Singh. Good morning, Ritu. If you can begin by telling us what your poll gave us.
Good morning, Lata, and a very happy Navni to all our viewers. The poll, it's going to be a close call. The poll says 80% that there will be a pause this time. 20%, not insignificant, are, expecting a 25 basis point cut. Those in favor of a cut say, a forward-looking central bank should use the headroom with the low inflation print to cut rates, whereas those that are in favor of a pause say, RBI has already done enough with the 100 basis point cuts. It's provided liquidity. So now wait and assess the impact of the tariff tensions and how that plays out, and keep the powder dry to support growth when it actually needs help. But that said, the street is expecting more cuts. 70% in fact say there will be another 25 to 50 basis points cut. More are leaning towards one more 25 basis point cut, just not perhaps in October. But a dovish pause is what the markets will watch out for. Now, how the RBI communicates that is also something we'll have to see. Growth currently at 6.5% for the year is most likely going to be revised up by 20 to 30 basis points, simply because the Q1 number came in higher than expected. Inflation, on the other hand, will be revised downwards because of lower food inflation prints that we've been getting, and of course the GST cuts. Apart from this, there are several other measures the markets will watch out for. Communication is going to be very important. Any sort of support to sectors that are going to be hit by tariffs. Those are some of the key things to watch out for. But Lata, what are you going with?
I'm going with the other 20%. I think the economy is, compared to August, far weaker. There is the 50% tariff, there is the H-1B visa, and every day there is a negative news, either it's pharmaceuticals or furniture or, now even movies. I would think that, corporate enthusiasm and courage is at a very low tide, and a bit of boost is called for. Why can't we have a cut now and in December would be my question. But I think that's just an opinion. We should defer to our experts. In joining us is Kaushik Das, all economists, Kaushik Das from Deutsche Bank, Indran Elpad from Yes Bank, and the Treasury head from Stancy, Parul Mittal Sinha. Gentlemen, and Parul, thank you very much for joining us. Parul, you go first. Well, as a bond market ace player, what are you looking for? What will you do if you're in RBI's shoes?
Yeah, so this is a very tricky policy, and this is the first time I'm seeing that the markets or the traders are more cautious than what most economists are suggesting RBI should do. We also are leaning towards a cautious stance. We think RBI will hold on. I think three broad reasons. One, prudent to remain cautious in this time of uncertainty. There's a lot of back and forth on the tariff stance between India and US. We'll see if that gets resolved over the next 2-3 months or gets worse. And therefore, it may be more prudent for RBI and the government to give more targeted support to the impacted sectors. That's one. Number two, if you look at rupee, dollar rupee is at its all-time highs. Rupee, if you look at a long-term average, is trading on relative basket basis towards the lower or the weaker end of the range. So that already supports exporters and supports the economy to some extent. Rupee is weaker by around 3 to 5% versus the long-term average. And the third one is there is some discussion on bond market transmission not happening, and therefore this easing may support transmission even further. I think there we think that the bond market transmission is getting impacted because of demand supply issues, not because of the rates needing to be even lower. And I think RBI may be more,
Let me stop you there.
To give targeted intervention rather than give a broad rate cut. So we are leaning on the side of caution, pause this time, but in some way, market will watch out for if the stance or the communication is more dovish than in the previous two policies. Inflation, no doubt, has come off quite a bit. It gives the room to RBI to cut rates, but the communication...
Parul, 1 minute. Parul, 1 minute. Parul, 1 minute. Just tell me that if there is a dovish pause, how will market react? If there is a cut, how will market react?
So if there is a cut, and I expect cut comes with a dovish language with it, market can move lower, rates can move lower by 10 to 12 basis points. Dovish pause, market will remain largely unchanged because that is what is priced in.
Okay, fair enough. Kaushik, your thoughts?
Yeah, Lata, Shubha Navami, first of all, and happy to have you on our side. I'm in the minority camp calling for a rate cut from 6th August itself, the particular policy day when RBI did not give a rate cut, which was our call at that time. And my point is August was too early after the 50 basis points June cut, we got, which was a surprise. December will be too late. October is the perfect time for RBI to give a 25 basis points rate cut. Having waited in August, the same argument was made in August that, you need to wait and see how things play out. Now you have a lot of information. You have the tariffs, which are sitting at 50%, and there have been more talks about H-1B visa hikes. You had this issue about, other things which are coming up, which you need to be cautious about on the services sector. People who are arguing that, uncertainty is there and therefore December is the right time, you should remember that uncertainty will not go away in December. For all you know, it can increase. And if you are late at that time, that is a bigger worry rather than moving now. And if things were to settle down, it's not like even a 20% tariff will be good for India. That will also have negative impact on growth. So I would say a forward-looking central bank should think about the forward-looking growth trajectory and not the April-June GDP number, and base their kind of decision based on the forward-looking path, which I think will come closer to 6.2, 6.3 growth in October, December, January, March. The other thing is RBI is an inflation targeting central bank. From 3.7 inflation, we've gone down to 3.1 in August, and we are going to go down to probably 2.6 in this forecast round when they present it in October.
Yeah.
If you do 100 basis points downward revision to inflation and you do not cut rates, then that will be a little inconsistent, and therefore they should do it. Also remember that in June, we already had an effective easing of 25 basis points because of liquidity. So we already had that 125 basis points rate cut.
Yeah.
RBI then eventually took it away by doing VRRR auctions and aligning the short-term rates to the repo rate.
Yeah.
If you bring it down to 25 basis points lower, you're not doing much. You're just going back to the June levels. And inflation is not going to come down for this year. That 3.1% probably will come down to 2.6. But the next year's forecast of 4.5, my guess is RBI will be reducing it lower towards 4%. And the April-June number that they've given at 4.9, that also falls to 4.5%. So definitely the GST and the disinflationary impact that we are seeing opens up room for a 25 basis points rate cut. Sooner you do, the better it is, because you should remember that transmission takes a bit of time. What I saw was that the transmission of the previous rate cuts has happened to a large extent.
Sure, Kaushik.
Therefore, this is a good time that RBI can think about providing an additional rate cut. It will look like fiscal monetary coordination, happening at its best. And to the points of the bond
Got that, Kaushik. There are arguments on both sides. You're arguing for a cut, and Parul has been speaking about a pause. Mr. Indranil Pan, which camp are you at? And if you do expect a dovish pause, what are some of the words you look out for in the commentary? Train our ears. Will it be the inflation forecast? Will it be supporting growth? What exactly will you watch out for?
Yeah. First of all, I am in Parul's camp for today's policy, no rate cut. And very frankly, as an economist, I don't understand what this dovish pause and a hawkish pause means. And I think given the fact that the stance is unlikely to be changed, they have to be very nuanced and very careful in terms of how forward communications go. Now, from my perspective, I think the clear message, and this is happening across all central banks across the world, and given the uncertainty that is there, you can't really provide a very clear forward guidance at this point in time. And then having to chew on your words, take it away, or turn it, and therefore have a significant implication for the market. And hence, I think the best that the Reserve Bank can do is to not provide a very clear forward guidance at this point in time because of uncertainties on both sides, the growth and the inflation perspective. On the inflation perspective, yes, inflation will be sort of dropping, and to a large extent also because of the GST cuts that will provide a downward shift in terms of inflation. But I think as a central bank, they will probably be at this point in time looking at more the momentum of the inflation, because this is a policy-induced one-time reduction that is happening. And therefore, my perspective is that they should be able and willing to sort of look through this inflation shift lower. On the other hand, we had incessant rains in certain parts of the country. I understand from a price perspective, paddy and wheat may not be impacted. But we'll have to look forward and see what is the output on the vegetables, because this is a very crucial period on the vegetables. And the one thing that has really brought inflation, the food inflation down, was the vegetable prices. On the growth side, yes, I hear very clearly from Kaushik about his concerns about H1B, the tariffs, etc. But if I actually go and talk at the sort of ground root levels, on the H1B, a lot of companies, the IT segment is actually looking at nearshoring. So they are very, and the other thing is that to a certain extent, the H1B regulations that initially hit us on one morning has possibly been eased out to a certain extent, whereby it is a one-time sort of implication rather than an annual implication. And I think the administration is very clear about the fact that the H1B issue will not strike the absolutely sort of on a skill level at the higher level. So I think there is some comfort over there, especially doctors and all are well protected, therefore, and it might not be a very severe implication for the Indian growth story.
Yeah.
On the other side,
Indranil, quickly.
On the other side, I think from the tariff side. Yeah, please go ahead. Please go ahead, Lata.
Yeah. No, I just want quickly, Parul, dovish pause. If you very quickly tell us what will give you the sign of dovishness, assuming it's a pause.
So if the inflation forecast for next fiscal year and Q4 of this fiscal year is what we'll watch out for, because that is the main number which told the market last time that the space was very limited.
Okay. Kaushik, one big thing you'll watch out for.
For a rate cut, obviously. And if it doesn't happen, then, how RBI communicates about the December rate cut. Remember that with a 50 basis points rate cut, 10-year bond yields went up by 50 basis points. So communicating that we are not cutting today, but it'll be positive for the bond market, or maybe, for the markets 2 months from now, that will be extremely difficult. I think cutting the rates is a much easier thing. And, and then people will still hope maybe December, if there is any need, they can do more. I would look for one rate cut, and if needed, to do more in the future.
Okay, Mr. Indradeepan, very briefly, what is your GDP number? And since you're expecting a pause, what is your terminal rate, and when is the next rate cut, if at all?
Well, as I said, very difficult to provide a forward guidance, but if you really push me to the wall, my terminal rate will be 525. I don't know the timing. On the GDP, my expectation is a 6.6 to a 6.7 for the current financial year, and a 6.5 for the next financial year. We are broadly looking at the GST implications, neutralizing the tariff implications for now. We'll have to sort of go ahead and see actually what is the on-ground implication that comes out, especially we are in a very crucial phase of the festive demand, and if there's a very significant upshot in the festive demand, we may actually see that tapering out quite significantly in the third and the fourth quarter.
All right, Mr. Pan, Parul Mitra Sinha, Kaushik, thanks so much for your thoughts. We're standing by, for the RBI governor any moment now. From our experts just now, you heard two expecting a pause in this policy, Parul expecting a dovish pause, and Kaushik, batting for a 25 basis point rate cut. It is going to be a very close call, but the markets really want to hear is future directions. If it's dovish, whether the inflation forecast is lowered, especially that 4.9% number for the first quarter of next year, that is something the markets will watch out for. Growth is likely to be revised up. Given statistically in Q1, we had a higher than expected number than what RBI had factored in. We have the governor. Let's listen in.
All of you on the last day of Navratri, and my best wishes for a very happy Dashera and Gandhi Jayanti tomorrow. Since the August policy meeting, significant developments on the domestic front amidst a fast-changing global economic landscape have altered the narrative on growth inflation dynamics in India. Buoyed by a good monsoon, the Indian economy continues to exhibit strength by registering a higher growth in Q1. At the same time, there has been a considerable moderation in headline inflation. The rationalization of the GST is likely to have a sobering impact on inflation, while at the same time stimulating consumption and growth. Tariffs, on the other hand, will moderate exports. As for the global economy, it has been more resilient than anticipated, with robust growth in the US and China. The outlook, however, remains clouded amidst elevated policy uncertainty. Inflation has remained above respective targets in some advanced economies, posing fresh challenges for central banks as they navigate the shifting growth inflation dynamics. Financial markets have been volatile. The US dollar strengthened after the upward revision of US growth numbers for the second quarter. Treasury yields hardened recently as expectation of rate cuts by the Federal Reserve ebbed. Equities have remained buoyant across several advanced and emerging economies. I now come to the decision of the Monetary Policy Committee. The Monetary Policy Committee met on the 29th and 30th of last month and today to deliberate and decide on the policy repo rate. After a detailed assessment of the evolving macroeconomic conditions and the outlook, the MPC voted unanimously to keep the policy repo rate unchanged at 5.5%. Consequently, the STF rate remains at 5.25%, while the MSF rate and the bank rate remain at 5.75%. The MPC also decided to continue with the neutral stance. I shall now briefly set out the rationale for these decisions. The MPC observed that the overall inflation outlook has turned even more benign in the last few months due to a sharp decline in food prices and the rationalization of GST rates. The average headline inflation for this year has been consequently revised lower from 3.7%, which was projected in June, 3.1% in August, to now 2.6%. Headline inflation for Q4 this year and Q1 next year too have been revised downwards and are broadly aligned with the target despite unfavorable base effects. Core inflation for the year and Q1 next year is also expected to remain contained. The MPC also noted that growth outlook remains resilient, supported by domestic drivers, despite weak demand. It is likely to get further support from a favorable monsoon, lower inflation, monetary easing, and the salubrious impact of the recent GST reforms. However, growth continues to be below our aspirations. Even though the growth projection for the current financial year is now being revised upwards, the forward-looking projections for Q3 and beyond are expected to be slightly lower than projected earlier. This is primarily due to trade-related headwinds, despite being partially offset by the impetus provided by the recent GST reforms. Summarizing, the MPC concluded that there has been a significant moderation in inflation. Moreover, the prevailing global uncertainties and tariff-related developments are likely to decelerate growth in H2 this year and beyond. The current macroeconomic conditions and the outlook has opened up policy space for further supporting growth. However, the MPC noted that the impact of the front-loaded monetary policy actions and the recent fiscal measures is still playing out. The trade-related uncertainties are also unfolding. The MPC therefore considered it prudent to wait for the impact of policy actions to play out and for greater clarity to emerge before charting the next course of action. Accordingly, the MPC unanimously voted to keep the policy repo rate unchanged at 5.5% and also decided to retain the stance at neutral. I will now be dwelling in some detail about our assessment of growth and inflation, which has gone into these MPC decisions. First of all, growth. Economic activity has remained resilient, with growth of real GDP surprising on the upside at 7.8% and GVA at 7.6% for Q1 this year. As suggested by high-frequency indicators available so far, domestic economic activity continues to sustain momentum even in Q2. Looking ahead, an above-normal monsoon, good progress of Kharif sowing, and adequate reservoir levels have further strengthened prospects of agriculture and rural demand. Buoyancy in services sector coupled with steady employment conditions are supportive of demand. This is expected to get a further boost from the rationalization of GST. Rising capacity utilization, conducive financial conditions, and improving domestic demand should continue to facilitate fixed investment. However, ongoing tariff and trade policy uncertainties will impact external demand, prolonged geopolitical tensions, and volatility in international financial markets caused by risk-off sentiments of investors pose downside risks to the growth outlook. The implementation of several growth-inducing structural reforms, many of which were announced by the Honorable PM on 15th August, including the streamlining of GST, are expected to offset some of the adverse effects of the external headwinds. Taking all these factors into account, real GDP growth for this year is now projected at 6.8%. This is a revision from our earlier forecast of 6.5%. Q2 now is projected at 7%, Q3 at 6.4%, Q4 at 6.2%. Real GDP growth for Q1 next year is projected at 6.4%. The risks are evenly balanced. I will now come to inflation. Inflation conditions remained benign during 25-26 so far, with actual outcomes turning out to be significantly lower than our projections. Low inflation is primarily attributed to a sharp fall in food inflation, aided by improved supply prospects and measures taken by the government to effectively manage the supply chain. Core inflation remained largely contained, with the August reading at 4.2%. This is despite continued price pressures on precious metals like gold and silver. Turning to the inflation outlook, the progress of the southwest monsoon has been satisfactory. Healthy kharif sowing, adequate reservoir levels, and comfortable buffer stocks of food grains should keep food prices benign. The recently implemented GST rate rationalization would also lead to a reduction in prices of several items in the CPI basket. Overall, the inflation outcome is likely to be softer than what was projected in August, primarily on account of the GST rate cuts and benign food prices. Considering all these factors, CPI inflation for this year is now projected at 2.6%, with Q2 and Q3 at 1.8%, Q4 at 4%, and Q1 next year at 4.5%. The risks are evenly balanced. I will now dwell on India's external sector position. India's current account deficit moderated in Q1 this year to $2.4 billion or 0.2% of GDP. This is in comparison to $8.6 billion or 0.9% of GDP same period last year, on account of an increased net services surplus and strong remittance receipts despite higher merchandise trade deficit. During July and August 2025, for which we have data till now, merchandise trade deficit continued to remain elevated, notwithstanding rising global trade uncertainties. India's services exports, driven by software and business services, witnessed robust growth in the last 2 months, July and August. Furthermore, robust services exports coupled with strong remittance receipts is expected to keep the current account deficit sustainable during this year. On the external financing side, net FDI reached a 38-month high in July this year, driven by increased gross FDI and a moderation in repatriation and outward FDI. Net FPI, however, recorded outflows of $3.9 billion this year so far. We have data till September 29. This is on account of both equity and debt segment outflows. As on September 26, this year, India's foreign exchange reserves stood at a healthy $700.2 billion, sufficient to cover more than 11 months of our merchandise imports. Overall, India's external sector continues to be resilient, and we remain confident of meeting our external obligations comfortably. Notwithstanding the robust domestic macroeconomic fundamentals, the rupee has witnessed some depreciation accompanied by phases of volatility. We are keeping a close watch on the movements of the rupee and will take appropriate steps as warranted. I'll now be covering the liquidity and financial market conditions in the country. System liquidity, as measured by the net position under the LAF, stood at an average daily surplus of 2.1 lakh crore rupees since the last MPC meeting in August. Going ahead, the drawing down of government cash balance and the remaining 75 basis points cut in the CRR, which was announced earlier, in the remaining period of October and November, will aid the banking system liquidity in the near term. Through our two-way operations, we will actively manage liquidity to anchor the short-term rates. Money market rates have been relatively stable amidst comfortable liquidity conditions. During this easing cycle from February till August, for which we have data till now, in response to this 100 basis points cut in the policy repo rate, the weighted average lending rate of scheduled commercial banks moderated by 58 basis points for fresh rupee loans. 71 basis points is on account of the interest rate effect. The moderation for outstanding rupee loans is to the extent of 55 basis points. Similarly, on the deposit side, the weighted average domestic term deposit rate on fresh deposits declined by 106 basis points against the 100 basis points cut, while that on the outstanding deposits softened by 22 basis points over the same period. Transmission of this monetary policy has been broad-based across sectors. Going forward, adequate liquidity in the system and the remaining CRR cuts will further facilitate monetary transmission. I now give my statement on financial stability in the country. The system-level financial parameters related to capital adequacy, liquidity, asset quality, and profitability of the scheduled commercial banks continue to remain healthy. Similarly, the system-level parameters of the NBFCs too are sound, with adequate capital and improved GNPA ratios. Bank credit growth, despite being lower than last year, continues to be healthy and supportive of real economic activity. I would like to emphasize here that as other sources of funding are gradually but steadily increasing their footprint. It is the overall flow of financial resources to the economy that is more pertinent for assessing flow of funds to the productive sectors of the economy. The total flow of resources from non-bank sources to the commercial sector increased by 2.66 lakh crore this year so far, more than offsetting the decline in the non-food bank credit of about 48,000 crore rupees. I shall now come to the additional measures. I have 22 additional measures aimed at, number one, strengthening the resilience and competitiveness of the banking sector. 2, improving the flow of credit. 3, promoting ease of doing business. 4, simplifying foreign exchange management. 5, enhancing consumer satisfaction. And lastly, internationalization of the Indian rupee. First of all, I have a few measures for strengthening the resilience and competitiveness of the Indian banks. The ECL framework, the expected credit line framework of provisioning with prudential floors, is proposed to be made applicable to all scheduled commercial banks and all India financial institutions. You would recall earlier a discussion paper in this regard was issued. We propose to make these effective from 1st April 2027, therefore giving sufficient time to the regulated entities. Moreover, there will be a glide path till 2031, so effectively 5 years. This is to smoothen the one-time impact of higher provisioning, if any, on the existing books of some of the banks. Furthermore, it is proposed to make the revised Basel III capital adequacy norms effective for commercial banks, again, from 1st April 2027. In furtherance of this, a draft of the standardized approach for credit risk shall be issued shortly. Under the revised approach, the proposed lower risk weights on certain segments are expected to reduce the overall capital requirements, particularly for MSMEs and residential real estate, including home loans. It may be recalled that capital requirements for operational risk have already been finalized in 2023, whereas the capital requirements for market risk under Pillar 1 of the Basel III guidelines are under finalization after receipt of comments from the public. All these measures, we propose to make them effective from 1st April 2027. These measures will help align our guidelines with international standards adapted to our national conditions and priorities, and strengthen the capital adequacy framework for the banks and the all India financial institutions. 3, a draft circular on forms of business and prudential regulation for investment was issued in October last year. It has now been finalized after wide public consultations, and it will be issued shortly. The proposed regulatory restriction on overlap in the businesses undertaken by a bank and its group entities is being removed from the final guidelines. The strategic allocation of business streams among various group entities of a bank will be left to the wisdom of the bank boards. It is further proposed, this is my fourth proposal in this regard, to introduce risk-based deposit insurance premium. You are aware that today we are having a flat rate of premium for all banks, irrespective of size, irrespective of risk, at 12 paisa per 100 rupees of net deposits. We propose to bring in risk-based insurance premium. This will incentivize sound risk management by banks and reduce the premium to be paid by the better rated banks. I will now announce 5 measures to improve the flow of credit to the real economy. 1. To expand the scope of capital market lending by banks, it is proposed to provide an enabling framework for Indian banks to finance acquisition by Indian corporates. Some of the acquisition finance related to infrastructure companies is already available, already provided. We propose to now expand it. 2. It is proposed to A. remove the regulatory ceiling on lending against listed debt securities, and B. enhance limits for lending by banks against shares from rupees 20 lakh to rupees 1 crore per person, and for IPO financing from rupees 10 lakh to 25 lakh rupees per person. These had not been revised for some time. 3. It is proposed to withdraw the framework introduced in 2016 that disincentivized lending by banks to specified borrowers, those borrowers which had credit limits from the banking system on the whole of rupees 10,000 crore and above. While the large exposure framework since put in place for the banks addresses credit concentration risk to a particular entity or group at an individual bank level, concentration risk at the banking system level, as and when considered necessary, will be managed through specific macroprudential tools. 4. To reduce the cost of infrastructure financing by NBFCs, it is proposed to reduce the risk weights applicable to lending by NBFCs to operational, high-quality infrastructure projects. This should give a boost to funding for infrastructure in the country. 5. Since 2004, about 20 years ago, licensing for UCBs, the urban cooperative banks, had been paused. No license has been given thereafter. Considering the positive developments in the sector, including legislative amendments in the Banking Regulation Act during the last 2 decades, and in response to the growing demand from the stakeholders, we propose to publish a discussion paper on licensing of new UCBs. I now come to measures related to ease of doing business, and we have been taking a number of measures over the recent few months and even earlier. I have 7 announcements to make, including those related to pharma. First, a large number of circulars and directions totaling about 9,000 have been consolidated. I had earlier announced in this regard, and we have consolidated them subject-wise across 11 different types of regulated entities. Drafts of the same are ready, and they shall be issued shortly for public consultation. They should certainly aid simplification. Second, it is proposed to provide greater flexibility to banks for opening and maintaining transaction accounts of borrowers, that is, current accounts, CC and OD accounts. This will particularly help borrowers which are regulated by a financial sector, for example, the NBFCs. Restrictions with regard to collection accounts are also proposed to be withdrawn. The export sector is a vital part of India's economy, to further strengthen the sector and enhance ease of doing business for them, we shall A, extend the time period for repatriation from foreign currency accounts of Indian exporters in IFSC from 1 month to 3 months. B, increase the period for forex outlay for merchanting trade transactions from 4 months to 6 months. And C, simplify the process of reconciliation of outstanding entries related to exports and imports in the respective reporting portals, the EDPMD and IDPMS. Sixth, and these relate to FEMA, again, key provisions relating to eligible borrowers, recognized lenders, limits on borrowing, cost of borrowing, end use and reporting, etc. in the ECB regulations issued under FEMA are proposed to be rationalized. Seventh, it is proposed to rationalize FEMA regulations regarding non-residents establishing their business presence in India. I shall now state 3 consumer-centric proposals. 1, the bouquet of services offered to BSBD account holders, basic savings bank deposit account holders, without a levy of minimum balance charges, is proposed to be expanded to inter alia include digital banking, that is, mobile and internet banking services. 2, the internal ombudsman mechanism is proposed to be strengthened to make grievance redressal by the regulated entities themselves more effective. 3, the RBI ombudsman scheme is also being revised for improved grievance redressal, and at the same time, we are also including the rural cooperative banks under the ambit of this scheme. Now, I have 3 proposals for internationalization of the Indian rupee. We have been making steady progress in this regard. The first proposal relates to permit AD banks to lend in Indian rupees to non-residents from 3 countries, Bhutan, Nepal, and Sri Lanka, for cross-border trade transactions. Second, to establish transparent reference rates for currencies of India's major trading partners to facilitate rupee-based transactions. And third, permit wider use of SRVA balances by making them eligible for investments in corporate bonds and commercial papers also. Let me now conclude. Despite an external environment that has deteriorated since the August policy, the Indian economy remains poised to register high growth. The sobering of inflation has given greater leeway for monetary policy to support growth, while compromising on the primary mandate of price stability. However, the MPC decided to wait for the cumulative impact of the recent policy actions to play out before charting the next course of action as India strives towards achieving Viksit Bharat by the centenary year of its independence. It would need the coordinated support of fiscal, monetary, regulatory, and other public policies to attain its goal. The recent rationalization of GST rates by the government is a major step in this direction. In terms of monetary policy actions, we will remain vigilant of the incoming data and stay focused on our objective of maintaining price stability while supporting growth. The various policy announcements today that we have mentioned will also support the achievement of the goal of Viksit Bharat. And in pursuit of this objective, we will be proactive, objective, and consistent in our communication while backing it up with credible actions. Thank you, Namaskar, and Jai Hind.
Well, I think it's as dovish pause as possible. The governor is very clearly saying that the lower CPI reading and the GST cuts have, in his words, opened up policy space for further easing. So clearly another cut is coming. We don't know the timing, but the markets are not humored at all. I think we are pushing almost 6.6. When the governor started his speech, we were at 6.54 on the 10-year. So at the moment, the markets are reacting to the pause and not to the very clear dovishness. But beyond this, I think the Reserve Bank is almost opened up a whole constitution, a whole charter of banking reform. And there are plenty over there. The ECL is the most important. The glide path from is there after 2027, but it becomes applicable in April 2027. Most of the private sector banks seem to be already prepared. It's the PSU banks who are asking for the glide path, and that has also been given. There are also other advantages in terms of risk-based deposits, and then capital market lending. I think that is the big thing for the capital markets. So we have to watch out for how the stocks are performing. And I guess the banking sector will also have a shot in the arm. At least there is no rate cut now. At least there is no pressure on the margins now. Ritu, before I come to you, let me go to Upasana and Kaushik and the economists. Upasana, what have you made of the announcement? Is there an imminent December cut? What are the takeaways?
Yeah, Lata, as you mentioned, it is clearly a dovish pause to quite an extent. I would not entirely call it dovish, but they've balanced it very well. And obviously, much going ahead will depend on data. But having said that, this is purely in line with what we were expecting. We wanted a clear guidance by RBI that there is room for further easing if data permits. And that's how exactly what they have delivered. They have kept a pause and kept their powder dry for future if necessary. So they have highlighted the growth risks which would come about from tariff uncertainty, which is clearly the way forward. You know, the upward revision to GDP numbers also come on the back of the first half of the year being much more robust, while the second half moderating. Clearly, the growth risks are something which we have to, keep a tab on. And that is where the window for further easing will open. That's how I would say. And on the other side is the inflation bit. I think it's purely in line with expectations. Again, the downside revision. We know that the GST-led disinflationary trend had to play out, and that is what has been accounted for. Alongside even the Q2 number, which obviously has been revised down significantly by RBI because that was a known number. So I don't think there's much surprise on either of the two sides. And it is purely in line with what markets were also looking for. A forward guidance which suggests RBI is ready to act if needed.
Okay. Well, I think this policy is much more important for stock markets. The markets have done well at about 1/3% higher for the big indexes. But look at the bank Nifty, 0.7 higher. It's about 370 points higher. And that's because banks have got much more freedom. The ability to fund acquisitions, something which was not given so far. As well, more of IPO financing, limits removed on loans against shares. All these are very, very pro capital market steps that have been announced. As well, the large exposure framework has been toned down. That 10,000 crore limit will no longer apply. So banks get a lot of freedom actually after, ease of doing business clearly there for the banks. And that's why you're seeing bank stocks do very well. And of course, the feared rate cut is not just yet there. Let's see when it comes in December or in February. Kaushik, the RBI has very clearly said 4.5 is the inflation forecast for April, May, June. So it doesn't look like more than one cut more, right?
Yeah, Lata, anyway, we have our terminal repo rate at 525. As I told you that, we saw that number in June itself with effective easing happening, and then RBI started doing VRRR and took that effective 25 basis points away. So we think 525 will be the, terminal policy repo rate, because next year, even if you have, say, four quarter average for the year, earlier we were thinking it could be 4.5. Because of GST and food prices, we think it could be between 4 to 4 quarter for the full year average of FY27. You could have, the repo rate at 525, so 100 basis points positive real rate. So that should be okay. The only thing is, if you see whatever I said in your pre-policy discussion, that forward-looking growth would be revised down. If you look at January, March, RBI is saying growth is at 6.2. That is what they're expecting, and April, June they're saying 6.4 instead of 6.6. So we are sub 6.5% for the first half of next year. And on inflation, as I told you, they'll bring it down to 2.6. They have done that. So from 3.7 or higher, we have gone down 100 basis points, and RBI still has not reacted. In my view, RBI could have cut rates today itself with all these arguments, but they've decided to hold on and do it in December. We'll see how that plays out for the bond market as well as the effective transmission. Because if you give a big gap between what happened in June and then if you're going to do in December, then you could argue it may not matter that much at the end of the year if you do a 25 basis points. But that is behind us. Now we know that RBI has held the policy rate where it is. We have to now see how the bond markets are reacting going forward and whether they are, optimistic about expectation of rate cut in December, which in my view should come. The way RBI has phrased their statement, it looks like they're kind of, indicating that they're okay to do the rate cut, but they were waiting for transmission and the fiscal and monetary policy, all this transmission to take place by November. Hopefully, we'll get to know where we stand on the tariffs as well, and what the Fed has also done beyond the rate cut that we saw in September, what's happened to the global economy.
Fair point. We'll come back to you. Yeah, Kaushik, we have to look at all the banking steps because they're fairly important. This is as much a monetary policy as much as it is a banking regulator statement that has come, and the stock markets are reacting to that very strongly. I want to go to Ritu to summarize those actions, but Ritu, just hold on, one word from Rajiv as well. Bond market is almost pushing 6.6, Rajiv. Is this a disappointment? Are you all not making space for a potential cut?
So I think the issue is not necessarily the guidance. So guidance, I think, has been very balanced in terms of giving that space for future easing could open up. But I think the immediate challenge is clearly demand supply, and that's something that has been clearly visible when you look at where the bond markets have been reacting to. So I think that overhang of that is still there, and lack of any immediate measures to address that. I think that's one disappointment probably, because when you look at from June till date, in spite of the policy actions, in spite of a much more balanced guidance today, you've seen that the transmission in the market has completely got, I would say, reversed. To a large extent, we've seen the easing in rates being reversed. And I think there's nothing really that has addressed that specific issue. So I think that disappointment, if any, on the immediate reaction of the bond market largely comes from that. And I think this is something that is a little bit more structural in terms of enabling demand going forward.
Yep. Well, Ritu, can you summarize? I think this is a huge rechartering of banks. Main points, please.
Well, yes, a whole lot of measures for the banks. But quickly, before I get to that, the MPR, the Monetary Policy Report, is out. And the CPI projection for next year, according to the MPR, the inflation will average about 4.5%, with 4.5% both for Q1 and Q2, and 5.1% for Q3, and 3.9% in Q4. So do expect inflation to remain above that 4% comfort level for the better part of the first 3 quarters of the next financial year before it finally eases to 3.9%. That is an important number to keep in mind when we talk about further space for policy easing. But yes, like you said, so many measures for banks, very much a banking policy, large exposure framework, some relaxation in that for capital market lending. Importantly, if I, one more thing I wanted to highlight is the draft circular on business and prudential regulations, which was this overhang on the likes of HDB Financial that, the parent entity and the group entities cannot have overlap in business. That has now been removed and it will be left to the board's discretion. So this is good for, banks like ICICI Bank, for HDFC Bank, that do have their own home loan subsidiaries, with some overlapping businesses as well. That will come as a relief. The ECL framework, the fact that it is only kicking in from April of 2027 also gives banks some leeway, to ramp up the provisioning. So that is also something that the RBI has announced. A whole lot of measures on, ECB norms under pharma. Those have been rationalized. Support measures for exporters. That should also help. Other measures include, since 2004, urban cooperative bank licenses have not been granted. Those will also now be, considered. A proposal has been mooted for a discussion paper. So, we'll have to go through all of these announcements. But, coming back to the MPR, inflation remaining higher than 4% for the better half of FY27. Kaushik, keeping these numbers in mind, do you expect the chart of the policy, or rather the pause, to be slightly longer?
Not necessary, because we had the last rate cut in June, and by the time you come to December, most of the transmission of the previous rate cuts would be behind us. Yeah. And that time RBI probably would find kind of adequate justification to kind of give an additional rate cut. By the way, I don't know whether you've seen it or not. I'm reading the MPC statement. It seems that two members, Dr. Nagesh Kumar and Professor Ram Singh, were of the view that the stance should be changed from neutral to accommodative. So there have been a lot of, kind of discussion within the MPC. And if two members thought that the stance should be changed back to accommodative, it was as if like they were almost willing to give a rate cut in this policy itself. And they were much more on the dovish side compared to the other four members. So I would say still that December would be a, kind of good time. If you've not, my view was that you should have done in October itself. If you haven't done it for whatever reason, then December you should do it, because February is like light years away in this kind of market environment, and that is after the budget. And if you have done the last rate cut in June, then February is too far away. So I would assume if you have to do a rate cut, December would be a good time, and then let the real economy adjust with the transmission that happens, because you would also expect RBI to hold on to these levels of, repo rate, say 5-quarter, for 15 to 18 months before they decide to raise it again at some point in the future. So you should not delay it too much. And in this kind of environment where growth is always at a risk, it is better to err on the side of caution. If it is a little lower, it doesn't hurt. And as I told you, June, we were already at 5-quarter. So it's not going to be a big deal if you bring it to 5-quarter.
Yeah.
So that's my view, that December could be still very live.
Kaushik, the members don't get to vote on stance. The law is very clear. The Reserve Bank Amendment Act, the monetary policy framework only gives all the members the right to vote on the rate action itself. The stance was a generosity which Shaktikanta showed. Urjit Patel did not give them the right to vote on stance. So that's not something that even if they feel that the stance should change, they cannot express it, because that's not within the ambit of the MPC members. It is entirely the Reserve Bank's call. Upasana, I just wanted to ask you the growth forecasts, 6.2, 6.3, would you call it ambitious? Would you call it fair enough?
I think, Lata, for now, it's fair enough. I mean, even for next year, they're talking about a 6.6% growth. For now, there are pros and cons. So we need to weigh that as we progress. And that's how we'll have to take it forward. So I think 6.8 for the full year this year, along with 6.6% next year, for now looks okay. For the inflation forecast, I believe that there could be some downside to next year's forecast, but it's always good to keep a buffer because of volatile food prices. So I think 4.5% inflation and 6.6% into next year is a reasonable forecast for now. But just if I can step in for expectations, I too would agree on a December rate cut, because clearly beyond a point, if you keep pausing with transmission almost complete, then it's best to push forward, the kind of growth support that you would want to give. But I would also go one step further to say that there is a possibility of additional rate cut beyond just a 25 basis in the February policy. So by the time we exit FY26, our terminal rate could be closer to 5%. And just because liquidity, durable liquidity, should probably moderate into the fourth quarter, and RBI is looking to keep operating target rates closer to repo rate, it would be probably more wise to keep the terminal rate closer to 5 and keep the weighted average call rate also closer to 5% by the time we are exiting this year.
All right, let me quickly just read out some more additional information that we've got from the MPR, apart from CPI. GDP growth, for FY27 at 6.6%, Q1 at 6.4%, Q2 at 6.6%, Q3 at 6.8%, and Q4 at 6.5%. These are numbers we're getting from the MPR. But importantly, while we're still awaiting the statement on development and policies to see more of these banking measures, some of the important ones, for instance, loans against shares to individuals, which was capped at 20 lakh rupees at the moment, has been raised 5 times to 1 crore rupees. So that is one of the important measures, that banks had also been suggesting, to the RBI that it has now brought in. We'll get you more details on that. Lata, large exposure framework norms as well. I think that'll be a key trigger as well, and a lot of easing as far as infrastructure financing. I think those are key measures that we'll watch out for. In the meantime, let me quickly ask Upasana again. Upasana, these banking measures aside, anything else that stood out from you from these MPR projections of CPI and GDP?
As I said, I guess I'm looking for, I think there is some downside to the inflation forecasts made by RBI, both for FY26 and 27, marginally lower. And that is exactly the reason I believe that there is room for monetary easing beyond just 25 basis. Even for GDP, we are at 6.5% next year at the moment. Obviously, the risks are skewed to the downside because we don't know how long this tariff uncertainty is going to persist. And it is going beyond just goods. It's going into services, how the current account deficit is going to worsen going into next year. Most of the risks that we are seeing from the services side are going to probably pan out into next year if the problem persists. So 6.6% GDP growth next year, I would say, has some amount of downside risk. But for now, probably 6.6 is okay to maintain.
Okay. Upasana, Kaushik and Rajiv, thank you very much indeed for your time. We now have the big banker himself. Joining us now is the Managing Director and CEO of Bank of Baroda, Mr. Devdutt Chand, joining us all the way from Frankfurt, where he is at a meeting. Thank you very much, Mr. Chand. Good morning to you. I'm sure it's very early morning over there. But the first point is there is no cut just yet. Is that a sigh of relief? The Reserve Bank seems to indicate there is space for one more cut.
Thank you, Lata. I believe currently, because of the market scenario, the global scenario, it's better to keep our, the cut in the coming months rather than doing it now. Considering the growth side has been very well balanced at this point of time, inflation has been very benign. I don't think there was a requirement, anything to cut the rate at this point of time. And the RBI has clearly said they would be reacting to different market scenario going forward. I think this is the best case scenario possible at this point of time, and quite happy with this.
Okay. Well, for the banking system as a whole, do margins bottom out in the third quarter as of now?
Lata, I believe as far as the repricing or the resetting of assets are concerned, they are all done. But you have to see whether this quarter has taken the full impact or the coming quarter would take the full impact. But as far as resetting, realignment are concerned, the asset side, it has been completely done.
Yeah. Okay, sir, I'll come back to the policy. I mean, it's fairly straightforward. It was an expected dovish pause. But, there is a whole lot of steps for people like you. First up is this ECL framework, expected credit loss framework, becomes law as of April 2027, but you all get a glide path up to 2031. How prepared are public sector banks like yours Is that a bit of a challenge to be ready on April 2027?
No, look, I don't believe it's a challenge. Actually, banks like us who have been preparing for long. And it talks about something meeting to a global requirement in terms of the ECL framework. And I think many of the banks like us, we do have a substantial PCR on the NPA side. At the same time, also do have large standard asset provisioning as on today. So considering that, I don't think there is any way going to impact, there is a glide path there to meet that. At the same time, on the system front, on the policy front also, we have been preparing for long. I think it's a right move to make Indian banking matching to the global requirement in terms of ECL. And I think there is a glide path, and the banks would be, all the banks, including us, would be very capable of migrating to this scenario.
Will there be an immediate rise in provisioning in FY27?
I don't think that the reason being the final computation that we have to do, but there will be marginal impact. But we, as I said, we are also holding good amount of standard asset provisioning, right? So that would take care of any additional requirement of the ECL. There will be some impact, but then you have to come out at the right time with regard to after doing all the computational part as far as the bank is concerned.
Yeah. I don't remember your reserves, but I remember I think Bank of Maharashtra in particular had huge amount of reserves. So I guess most of you will be having some standard provisioning reserves. The other big relief that has come for you all, or rather incentive to lend, is that large exposure framework goes. Now you can lend more than 10,000 crore to one group. Will that spur credit growth, you think, for banks? Will you expect a higher number this year?
It would be. This is a measure to have a higher exposure vis-a-vis many of the group entities. And as you know, many of the group entities, they are expanding in terms of capital, and it would typically give us more opportunity to lend them more. So I think it's a very welcome move. It's something can really create a higher growth for the banks in terms of the credit outgo. At the same time, allow group to expand, particularly on the capex side. So I think it's a good move to have, and even if we operate globally, we see, the ability to lend higher definitely helps the economy to grow faster.
Okay. By the way, even deposit premiums are going to be marketized, so to speak. I guess there will be a minimum deposit insurance for everyone, but thereafter it will depend on the risk perception of the bank. Will that be an advantage for public sector banks?
It will be. We have been demanding, this is something we have been requesting for long, and I think this is one way, like the moment you are trying to, on the asset side, put risk weight and capital firm. Now time has come to improve the quality of liability on the bank side. So the moment this kind of the market pricing of deposit happens, possibly it would allow the right kind of banks to have more deposit. And as you know, deposit has been slightly on the lower side for last many years. So I think it's a very good move for to keep a market premium for banks to mobilize deposit, and it will be positive for banks like us.
Okay. And the other very big announcement is now you can fund acquisitions. Is that opening up a new area of business, and will that push up credit growth for banks like this year and next year?
But I strongly believe that, as you know, Bank of Baroda, we are operating globally, and we have been doing debt financing for acquisition since long. So we have this skill set, or we have this the way to lend for the debt financing for merger and acquisition. I think it's a very good move. It's aligning ourselves in terms of international best practices on the credit delivery. And I think that would give us substantial, like Indian companies can also think of going global now also. So it's a good move to, create adequate demand from the bank side to lend more, at the same time putting our banking practices in line with the global practices. And we as a bank, we have been doing it in the global operation since long, and we are quite hopeful of doing it also in India.
Okay, well actually, let me just get some numbers from you. Do you think net interest margins will bottom out in Q2 or Q3? What's your expectation?
Once we announce the quarterly, we'll be in a better position to articulate on this. But as I said, that as far as the repricing or the resetting of advance rates are already done. The only thing we have to see that
so more or less bottom.
The full impact of all this. Yeah.
Okay. And the other thing, credit offtake. What is your number for this year, either for yourself or for the sector? Now that you have, more avenues to lend.
Absolutely. As I said, our full year guidance always been 11 to 13%, but exit quarter can be slightly higher than this number. As you said, as you've seen that the Q1 and Q2 almost at 11 to 12%. So we still hold on to the guidance of 11 to 13% credit growth for the full year. But exit Q3, Q4 can be a higher percentage considering all the measures announced today. And also we are getting into a busy season as far as the economy is concerned. So quarter to quarter can be higher, but overall still I think the system as a whole, the growth can be 11 to 13%.
Okay, so if you can hold on for a minute, Ritu, I'm sure you're bursting with a few questions.
Yes, Mr. Chand, just to come back to the regulatory ceiling against debt securities and IPO financing, how significant, we wanted to understand, we have exact numbers now. The RBI is proposing to enhance the limit for lending by banks against shares from 20 lakh 5 times to 1 crore and for IPO financing from 10 lakh rupees to 25 lakh rupees per person. How much additional headroom is there and what kind of credit will this unlock?
I think it's a positive move. Like the capital market has been very strong for many years, and now if you look, the deposit also, many people are moving to the capital market. That is what we have seen in the past. So in that scenario, a very strong capital market. Now the limits are also to be higher, so that banks can also have an indirect exposure with the capital market.
Yeah.
So as a bank, we don't have much of exposure on this as compared to many of the other banks. But I think it's a very positive one because since we have a very strong capital market, the payment and settlement system are excellent as far as the India is concerned. In that scenario, these limits are, I think, are in a manner which typically gives them huge opportunity for us to grow in this segment. But you have to figure it out how much exactly would be the case therein.
And what is your understanding, Mr. Chand, of the sort of relief measures that have been announced for exporters? Of course, keeping in mind, the higher tariffs that may kick in, depending on how the negotiations go, extending the time period for repatriation from foreign currency accounts of Indian exporters in IFSC from, 1 month to 3 months, to increase the period for forex outlay for merchanting trade transaction from 4 months to 6 months. And the third one is to simplify the process of reconciliation of outstanding entries related to exports and imports in their respective reporting portals. Just help us understand how important these moves would be for the exporters.
Yeah, very important. This is what actually post the tariff thing the exporters were demanding. We have been, as a bank and as a system also, we have been interacting with the exporter post these tariff measures. And I think these are going to help them in terms of creating their own liquidity at the same time. Sustaining their operation, that is more important. So all these measures earlier also when the COVID happened, at that time also many such measures were announced. And I think this is going to help them in terms of rationalizing their entire operation. At the same time, helping them along bank also to have a liberal terms in terms of the export finance. And that's something I think going forward is going to be positive for the exporter.
Okay. So before we let you go, I know you have a big meeting in Frankfurt. One last question. It's about a week since, or not a little more than a week, 10 days since the GST rates have been cut. Are you noticing any spring in the step in terms of personal loans, retail loans, BNPL kind of loans? Any higher credit demand?
It is so. It is so. Post GST, I think we had one of the very strong last 10 days of the auto loans, the demand. Actually, it went up a significant amount day-to-day basis post the GST cut. So GST is going to spur the consumption. GST is going to spur the housing purchase, the auto purchase, and all those things. And we've already seen for last around 17 days with the September month. And I think going forward, it is going to be very strong as far as the consumption, the demand from the retail, particularly on the auto loan side, many of the consumer finance side, many of these even housing sales side. I think these are going to be very strong.
Okay, sir, thank you very much. We have taken a lot of your time. It must be early morning, 7 a.m. or something for you. Thank you so much for giving us your first thoughts, sir, and have a great day out there in Frankfurt. So clearly, from one of the biggest bankers in the country, the mood is very, very positive. The GST cut itself has spurred retail demand. As we heard, auto loans demand have been seeing a huge spring in its step. As well for banks, large exposure framework gone, so they can lend more, they can lend for acquisitions. And Indian companies, as we can see, every day our research team is reporting a bunch of acquisitions which Indian companies are looking at. Banks can participate in all those, they can lend more for capital market operations, lend more for IPOs, lend more loans against shares. So clearly there is a kind of a deregulation that has clearly set in, and that's very positive. And on the monetary policy side, well, bond markets are really unhappy, 6.6% on the 10-year. So bond market transmission is not going to happen, but looks like bank-related lending could find some kind of a recovery, some kind of a spring in the step. That's the word from the monetary policy that has been just announced by the Reserve Bank Governor. From Ritu and me, thank you very much for watching. We will be back covering Mint Street at 12 noon when the Governor begins his press conference. For the moment, it's a break, and then there will be a lot of discussion with stock market stalwarts on what they made of the policy, especially for the banking sector.
Hello and welcome to Trading Hour live from the CNBC-TV18 Motilal Oswal studio. I'm Sonal Bhutra. With me as always is Hormuz Patakia. Well, we got that update coming by from the RBI policy meet. It's status quo. The rate has been unchanged, but there have been a slew of measures for the banking industry. We're still getting them. Of course, it was said in the release that came out, but still to get the details of that one. Ritu tells us there are around 22 of them. So we'll of course analyze that. But yes, markets reacting to that update that has come by. The Nifty is up almost 80 points. We have the mid caps which have recovered from the lows as well. The bank's doing well. So there's a 400-point uptick on the bank Nifty itself. It is of course led by some of these private banking names. The Nifty Bank is at the day's high. This hour itself, we have a lot of them which are doing well. So we'll watch out for that one. But yes, individual updates in terms of ECL framework coming in from 2027. There's a lot in IPO financing as well. We'll discuss that and all in greater details.
Very interesting measures announced by the RBI governor. One such stock that is reacting to it is HDB Financial. And just get that up before we go to Ajay Srivastava. And the overhang on the stock, which was about the overlapping with the promoter businesses, that has been done away with in the final guidelines from the RBI, and that has had an impact on the stock. 3% higher on HDB Financial. It's been rebounding from its IPO price. It slipped below that on Monday, and it's now seeing some bit of rebound. This is in fact the best single-day gain that the stock has had since its listing day, which was in July. So good going for HDB Financial. Ajay Srivastava, who is the CEO at Dimensions Corporate Financial Services, is now joining in. Ajay, good morning. Thank you for joining in. The policy on expected lines, if you could call it that, but the slew of measures that have been announced for the banking segment, for the IPO financing related issues as well. But sticking to banking specifically, does that ease out a lot for the banks going forward, and it's showing up in the reaction as well?
Of course, it does. I think it's a great way to kind of just put some relaxation in the policy, because we're just too stringent about everything in this country at this point of time, particularly the capital market relaxation in terms of lending against shares, IPO financing. I think it's a great move to show liberalization, and also reflects, to my mind, more than anything, a little bit of panic setting in the system to say, what would kind of revive this market and stall the FI selling, in the manner, and therefore is welcome. It's a great step, although from a short-term perspective, it's great. From a longer-term perspective, I think the Basel III norm, which are going to come into place, we're going to just evaluate how much impact it's going to have on provisioning. Yes, there is time for 3 to 4 years, but if you're an equity investor, you need to be wary about that in the next 3 years, how much capital will they need to earmark against the Basel III norms. I think we'll have the numbers in a day or two, and our teams will take it out. But by and large, I think for the short term, it's a great positive, because the mood is relaxation, not kind of more stringency. Gold loans were kept out of it. At one point of time, the RBI governor used to hate it. Now they are kind of acceptable. But the only disappointment, I don't understand from where do they get the inflation number from? Because, and that's where the policy goes wrong. And that's why you see the yields are not dropping, in the government yields are not dropping, is you start with the wrong assumption of interest rate and everything else falls apart. If you look at your insurance premium, look at a car insurance, look at a health insurance, look at your education, look at a healthcare, all the services you consume as a normal person. Where is this 2%, 3% inflation? It's going about 10, 20% at this point of time for most people. And that is why the governor did not say it. I was looking forward to, maybe he'll explain the press statement as to what's he going to do to reduce the yield on the 10-year government securities, because the transmission of interest rate is not happening. Although you as a saver has been penalized exactly 106 basis points on FDs. So you penalize the savers, so now they have less purchasing power. You maybe compensate a little bit to the lenders, and that's why the economic policy doesn't work. So good things done, but fundamental economic policy is not working because you're working with the wrong framework of inflation numbers.
I think everyone would agree on what's happening in ground in terms of the price hikes and inflation and premiums, the things that you mentioned basically. But that's about the overall macros. There have been a lot of measures as well, which Hormuz was talking about as well. You spoke about how enhancing limits for the IPO market, that's a positive. But Ajay, here, if we look at the slew of IPOs that have come by and the kind of retail interest and subscription that we're seeing, and still they're not seeing the kind of listing gains that at least a lot of investors expect. What is your take on the entire phenomenon that is playing out?
Oh my God. They are lucky to be IPO'd and subscribed. They are what I call in our office nutcase valuation. You got to be really nutty. And I wonder the investment bankers, the mutual fund who are buying the anchor book, what exactly are they buying at what prices? And look at the companies. It's not some fancy quantum computing companies which are coming to the market. We are having already a Chakki mill coming to the market. We have a Mangal Sutra manufacturing market. The lowest of the lowest quality of IPOs are coming up with absurd valuations. I'm even surprised that they managed to squeeze through, which is a great thing because mutual funds have got money to do it. But that's not a great sign for capital market. You need to get capital to where the growth is, where the future is. We are putting capital to where the past was. Can you imagine a flour mill getting an IPO done in this day and age? It's just ridiculous. I think it's just IPO business is just ridiculous at this point of time. I'm not saying all are ridiculous, but 90% of IPOs don't deserve anything close to this pricing. And whoever is buying it, 2 years, 3 years down the line, we'll see what happens to the share prices of these companies. Believe me, they will not even be half of what they're coming at today.
Showing up in the listings today as well, BMW Ventures listed at a 25% discount to its issue price, and a lot of the other listings as well. But Ajay, the other major talking point has been IT. Start reporting results from next week onwards, with the expectations are already pretty subdued for the sector itself. Do you believe that FY26 will just end up being a washout year for the entire sector, and maybe once they get their act together, we can expect some rebound from FY27?
There is an old Hindi saying ki mara hathi sawa lakh ka hota hai. The question is, when you decide the elephant is dead, so at least the tusk can be harvested. It's a one-way street of going down, IT. And I think the worst point of the IT industry's future was this 18,000 crore buyback of Infosys. That shows you how pathetic the situation is in the Indian IT industry, that they could not find anything to invest in the world. You look at the top 7 in the US, they are investing 25 billion in a quarter. And my company goes and gives back money to shareholders because it says, I can't find investment avenues. Now, would you want to buy a share of such a company which feels in IT sector, they cannot find anywhere to invest? Now, if that is the management which is running these IT companies, I would not put my money into this. We have zero investment in the last 2 years. We continue to have zero investment, and we are negative on this outlook for IT, not because this industry is not good. The management who are running this for their promoter shareholders, not for the common shareholders and growth. If you can't find growth in today's world and where the world is moving different tech, I think you really got to be blind or stupid or dumb or all three, in which case you don't get my money to invest in your company.
All right, we take that. Ajay, thank you so much for being so candid and honest about your opinion. That's the word coming in from Ajay Srivastava. With that, we'll slip into a short break. Up next, we'll focus on the crypto market with Manisha Gupta on the other side.
CNBC-TV18 presents Crypto Corner, powered by CoinDCX.
Welcome back. As promised, let's shift focus to the crypto space. Manisha is now here with more. Manisha.
In Crypto Corner today, we are talking about the month of September, which has worked out positive for crypto or virtual digital assets. Bitcoin actually is closed September in slight mild green there. And if you look at the overall market cap, that also turned up by at around $4 trillion yet again. So the US market shutdown, of course, the government shutdown assessment is something that the street is looking at. But as you've seen in last 24 hours, we've seen gains come back in case of precious metals, and so has been the case for crypto as well. The month of September also is important because ETF launches, instead of being it being a case-to-case basis by the US regulators, it is now an open market. So we've seen three important major ETF launches as well coming in: Rex Osprey XRP ETF, Rex Osprey Dodge ETF, and the Grayscale ETF as well. So this is our development that we saw in the month of September in sense of regulations and ETF launch. The other thing really has been about crypto adoption, and September really saw more institutional participation, more companies onboarding Web3 and blockchain as a technology. And then you had countries like Thailand and Vietnam launching newer initiatives, experimenting with crypto when it comes to inbound tourism in sense of payments there. Airlines like Emirates and Air Arabia also are now adopting crypto payments in sense of acceptance there. There also are countries like Kazakhstan, Pakistan for that matter, which are moving ahead in sense of crypto mining and adoption also. The other thing that seems to be catching up even more in the month of September in sense of numbers has been tokenization. So the interest in stock tokenization clearly seems to be accelerating in the recent few months. You have platforms like Robinhood and Kraken, which are now offering tokenized stock products. NASDAQ also has requested SEC approval for rule change to allow listing of tokenized securities on the platform, on exchange that is. And then there also is a statement from the SEC, Paul Atkins, where he says that tokenized assets could improve access to financial markets and also reduce the costs going forward. Very interesting pattern should come in on your screen, because every time history shows that if the month of September goes positive for Bitcoin, then it's a given then October and the fourth quarter of calendar year are much in positive. That's a precedent that we've seen in 2023 and 24 as well. After a positive September, October was up by nearly 28% in 2023, and October 2024 closed up by nearly 11%. And that led to positive gains for the fourth quarter of that year as well, where we saw 23 close up by 49% for Bitcoin, and the fourth quarter of 2024 closed up by 45%. So that's exactly what the markets are hoping for the month of October and this quarter going forward for Bitcoin and crypto.
Manisha, thank you for that. Take a short break. On the other side, we get you one of the listings of the day, Jain Resources Recycling. The management joins in on the other side to talk about the road ahead for the company.
CNBC-TV18 presents Crypto Corner, powered by CoinDCX.
Welcome back. You're still tuned into Trading Hour. Let's talk about the primary market action. Jain Resource Recycling made its D-Street debut with a good listing. The company, the stock listed at 265 rupees versus the issue price of 232 rupees a share, which is a 14% premium. Kamlesh Jain, who is the chairman and managing director at the company, is joining us now to discuss more and the outlook going forward as well. Mr. Jain, good morning. Thank you so much for joining in. Now that you've listed, you will be able to give us forward-looking statements and tell us more about your plans as well. You did revenues of around 7,100 crore rupees in FY25, margins of around 5%, profits of around 223 crores. With the expansion plans in place, with the increased capacity utilization, what kind of numbers are you looking at in the next 2 fiscals?
Yeah, thank you. So we are definitely looking for a robust expansion plan, and already, as we have discussed last time, for the copper cathode, which is going to start from the next year, and value products of copper. And we are also going to enter in many areas of recycling, like tire recycling, e-waste recycling. So company has got a robust plan for next 2 years to grow in the recycling sector, which is the main forte for us. And recycling is going to be a huge opportunity for the, this next 20 years. Will grow and grow. It is not like business. It's a compulsion to recycle if we have to live the life on this planet.
Mr. Jain, good morning. Thank you for joining in. Congratulations, first up, for becoming a public company today. Now that you are operating at utilization levels of 75% and considering the projections that you are making, are you having any capacity expansion plans on the anvil?
Of course. So we always keep a 20% capacity extra to grow. In our business, it is always purchase order book matter than the sales order. Sales is always there for us. There is no problem for doing sale because it's a commodity what we manufacture. It's the base raw material for any downstream project like copper manufacturing of tube or sheets or battery manufacturing. So in whatever we are able to source, we can recycle and we can sell. So that's a circular economy solution. Our purchase book matter, so we keep 20% capacity extra. Once it gets full up, we again build up 20% capacity extra. So this year again we have created around 25% capacity extra to cover up the future raw material.
Mr. Jain, I just want to understand, how does pricing work in this case? Because I've had conversations with some battery recyclers. They've spoken about that maybe the scrap prices go down sometimes the output prices go down. Is it volatile for you as well? In that case, how do you ensure maintenance of margins and profitability?
So we have a strong and robust mechanism for hedging all our purchase and sale. Our margins are not at all get affected, and it has been completely locked from day one when we purchase the material. So we hedge in MCX, hedge in London Metal Exchange, and sometime in COMEX also. As we buy 24 hours round the clock purchase, so round the clock we hedge back to back with every apple to apple. So there is no risk for any variation in the price and the margins, the profit margins. We are above the risk factors of price movements of the base metal commodities.
Mr. Jain, the last time you spoke to us, you had mentioned that exports are 60% of your overall business. If you could quantify that for us as to how much of it goes to the US market and what are the situations that you are facing from there currently, and going forward, do you expect to either maintain, bring down or increase the share of exports as a part of your overall mix?
So first of all, we don't export to US at all. Our export is zero to US market because commodities we sold only in Southeast Asia, Korea, Japan, China, Singapore, Malaysia, all in Southeast market and somewhat in Middle East market, but mainly in Southeast Asia market, where the freight cost also almost zero for us to ship from Chennai to all these countries. Now, second point is we buy from US. So we don't sell to US, we buy a lot from US, around 17% last year purchase. And this year also we buy substantially, but our domestic purchase is going very big now. So come back to the US side, we have no effect of tariff war or anything going. And this kind of I will not call garbage, but this kind of scrap and recyclable resources, every country has to export to India only because of India's USP, because of India's ecosystem for recycling. So Indian companies are doing very well in the recycling sector, and they will grow more and more.
Also, maybe because we don't segregate enough, and that's why some of the waste cannot be recycled also. Mr. Jain also wanted to understand the point on growth going forward. 5% margins currently, 5.2 to be precise for FY25, 7,125 crores in terms of top line. What kind of growth are you envisaging, considering that you're saying this is a business which would continue to see growth?
As I said, recycling is not a business where it is by choice. It is by compulsion. We have to recycle if we want to live the life on planet. I mean, whether it's domestic or it's overseas. And what we do is not typical waste to energy or typical waste management. What we do is very different type of recycling. These are recyclable resources.
Yes. So, Mr. Jain, in that case, what kind of growth will you see?
So definitely the growth is, we are growing last so many years around 30-40% CAGR, and I expect same level of growth for the next years to come, and it will be maintained on a strong growth path. I can't tell exact numbers, but I am sure that the company will be growing for the years to come.
And margins, will they improve? They've improved from 4.1 to 5.2%. Will that trajectory continue as well?
Yeah. Yes, in this business of recycling, the scale is more important. So once you grow the scale, the cost of production goes down, the fixed overheads goes down, and that way the margin goes up. So when you do, our top line goes up, I am sure our bottom line margin will also go up because of the cost will go down.
Right, Mr. Jain, thank you so much for sparing time and joining us. Congratulations on your listing once again, and we look forward to having you after your quarterly results as well. The management there of Jain Resource, and bucking the trend, if you could call it that, among the list of IPOs that have gone public, have listed recently 20% higher in comparison to the issue price. By the way, the index is now at the highest point of the day. The Nifty now 120 points higher at 24,730, and all credit to the Nifty Bank. In fact, now heading to the 24,750 mark now is the Nifty, building on to those gains, and credit to the Nifty Bank, and it's back above that mark of 55,000, building on to that as well. 55,300 is the first level now to watch for on the upside. 600 points higher on the Nifty Bank after the slew of measures announced by the RBI governor. Take a short break, more on the markets on the other side. Welcome back. Take a look at the Bank Nifty and 600 points higher on the index. You pull up the Nifty Bank constituents as well. Most of them either near or at the highest point of the day, be it Axis Bank, be it HDFC Bank, be it ICICI Bank, all of them contributing to the gains on the index, and the broader market names as well. There you can see the list of contributors: ICICI, HDFC, Kotak, Axis, all of them. But the PSU banks though are sulking a little. SBI, PNB, Bank of Baroda, they run up quite a bit as well. So not so much on the PSU banking front. That index is at the lowest point of the day. Not so much in the broader markets as well. That too continue to remain around the flat line. But the last few minutes have been all about the Nifty Bank and its impact on the Nifty subsequently. But that does not take away from the fact that there are a lot of broader market movers as well. Netweb Technologies is now up 12%. And just before we get to that, on to a conversation on the auto sales. The M&M total tractor sales during the month of September were up 49% from last year. My colleague Parikshit spoke to Vijay Nakra, who is the president of the farm equipment business at Mahindra & Mahindra, and began by asking him about the September sales and the demand boost after the GST rate cuts. Listen.
What you're seeing, a large part of the performance obviously is attributed to the benefit of the move by the Honorable Prime Minister, which is to reduce GST. We are seeing the benefit of that play out at the start of the festive season. But there are two things that I also would want to add to that. One, we must understand that the festive period last year to this year needs to be understood in terms of number of days. Last year, the entire festive period was in the month of October, which means Navratri and all of Diwali, except for the last 2 days, were in the month of November. This year, the festive period has been split between September and October. So we've seen 9 days of Navratri this year in September. Dashami is tomorrow, which is in October, and Diwali is in October. So one should actually compare the festive period performance at the end of October to look at September plus October. That's point number one. Second, I think also, the favorable monsoon with 8% higher long period average, reservoir levels at 90%, the government's announcement of a significant increase in MSP to increase the money in the hands of farmers, and the higher 2% land sowing of the Kharif period. All of this have augured well both for the month of September and will continue to play out well into the festive season of October.
Right. Now, if I were to ask you about total sales in September, you're talking about 64,946 tractor sales. How much of this came in just the 9 days of Navratri?
Again, there I don't think it's the right thing to talk about as an absolute number. And Parikshit, let me tell you why. The reason is that the announcement for drop in GST had come in earlier. So normally, if that was not the case, we would have seen some amount of spread of sales to happen through the month of September. But given that the GST benefit was to come in from 21st of September, which was the start of the festive period, deliveries pre-21st had slowed down, and all of that sort of flowed into the last 9 days of September. So I don't think it's a fair comparison, but the statement to say that it has been significantly a strong performance is what counts as far as the 9 days is concerned, whether we talk about deliveries or inquiries moving forward into the month of October.
Okay, now as of right now, as of 1st of October, what would be the booking pipeline that you're sitting on, and what could be the kind of growth you're looking on a year-on-year basis, on a month-on-month basis in October?
But it's difficult to give that guidance. Again, I think in tractors, we should just understand the context of booking, because, over here, you may have a lot of bookings, but what matters over here is that conversion, because, unlike some of the other segments and sectors which are lifestyle products, over here, there is a process of, this asset is one of the highest cost purchases of a farmer, and hence it's the ability not only just of the down payment, also the financial approvals that come in from the banks and the financial institutions. So all of that has to come together for finally the delivery of the product to take place. So again, I'm not getting into specific number to say what is the opening booking as we get into October, but the pipeline is very strong for us to be able to convert that into numbers in the month of October. And again, in terms of strong performance for October, I'm kind of reiterating my point that one cannot compare September to September separately and October to October separately for the reason of the festive period. But having said that, September plus October, we are confident to continue with the strong performance that we are doing with the tractor business. And I think even the industry will continue to play out very strongly.
Right. If I were to ask you about the actual demand sentiments, have you seen an actual uptick as a result of the GST reduction? Because a lot of the customers would anyway be holding back sales till Navratri because of the Shraddh period. How would you actually gauge the sentiment on the ground right now? And going forward, what would be your outlook for tractor sales across the country, even though you cannot give us an estimate right now?
Yeah, how do we gauge the sentiment this year compared to last year? I think the best measure at this stage is the kind of inquiries that we get at our counters, and that is significantly higher compared to last year. Whether you look at Shraddh plus Navratri or you look at only Navratri. So that is a very strong indication that farmers have sort of started understanding the benefit of the reduction in GST, because that plays a significant role in the input cost for a farmer, in their calculation of their earnings. So the strong inquiry pipeline gives us that indication that as we sort of get into the second part of the festive season, the demand is strong. I also want to say that, the reduction in GST is a fundamental change. It's not a festive season offer where the customers are just going to rush and try and get that benefit in 9 days or 18 days. So the customers have understood that this is a significant change that's come in. A lot of them, as they start buying tractors now, getting into the Rabi season, have started buying it in the festive period. And I think this benefit is not just a festive period benefit, but we'll probably see it play out even for the rest of the year. And hence, we believe that the second half, while the first half has seen for the industry about 11.5% growth, this sort of strong industry performance will tend to continue in the second half of the year. And I'm not giving a guidance, but I'm just saying that the strong momentum of demand should continue even post-festive season in the second part of the year.
Okay. Without commenting on Mahindra, any industry estimate as to what kind of growth the industry could post for the full year?
Difficult to put a number to it now, but like I said, we've seen a double-digit growth in the first half, and I think that sort of momentum should definitely continue, into the next couple of months of this financial year.
All right, that's the word coming in from M&M in terms of what the outlook is looking like. They expect festive season to be strong over September and have strong booking pipeline for tractors in October. Time for a short break now. We'll get to more on the markets on the other side.
Boy, have a look at the Nifty Bank now, 650 points higher on the index, and that has now taken the Nifty to the 24,800 mark. So almost 700 points higher now on the Nifty Bank. 55,300 has been conquered, and as of now, at least, the Nifty Bank also within 15 points away of that 24,800 mark. ICICI Bank, HDFC Bank, Axis Bank, all of them trading gains of 2.5%. And just before we wind down on the show, just pull up Tata Motors as well. It just had an announcement from the company stating that they will be announcing the record date for the CV business demerger shortly. Remember, today is the effective date of the demerger taking place. So 1st of October, the effective date, the record date will be announced shortly as well. So 3% higher on Tata Motors. And also springing up today is Trent. 3% higher on that stock as well, nearing the highest point of the day among the top gainers on the index. But with that, we call time on this edition of Trading Hour with the Nifty Bank at the highest point of the day, as is the Nifty, from Sonal and me. Thank you for watching. But just as we go into the break, here are some market opinion from Nilesh Shah, the Managing Director at Kotak Mahindra AMC, on the IPOs, the performance, the FPI outflows, and a lot more. And listen in. And there, as you can see, the record date has been issued now as the 14th of October has been the record date for the demerger of the commercial vehicles business from Tata Motors. So 14th of October will be the record date. So shareholders will be entitled to 1 share of the demerged CV business compared to 1 share of the current listed entity. And a day after the record date, Tata Motors will start trading X the CV business, and it will be renamed as Tata Motors Passenger Vehicles Limited, and the demerged entity will begin trading sometime mid-November, is what the company has mentioned, as Tata Motors Commercial Vehicles Limited. So with that, we call time on this edition of Trading Hour. Thank you so much for watching. Halftime report on the other side.
With the barrage of IPOs, undoubtedly there is no worry on the quality side. SEBI has done a fantastic job on ensuring that only quality IPOs come. Institutional investors also have done a reasonably good job in ensuring that they invest in reasonably valued IPOs. Many of the IPOs which have opened at a discount had virtually no institutional participation. So my recommendation to investors, please don't make mistake on your own. Learn from our experience and go for those IPOs where you believe there is a reasonable institutional participation. 3-6 months remain challenging. The FPIs are on the selling spree. They are saying for last 5 quarters, your earnings growth is single digit. Your valuations are at premium to historical averages. And most importantly, you are getting hit by US tariff and geopolitics. They are absolutely right in saying this. Generally in festival season, we have seen some amount of redemption to either buy a house or buy a motor car or buy jewelry. And ultimately, wealth is there for spending. So there will be probably similar intensity of gross flows, but the net flows will be lower because of the redemptions for consumption or spending.
our special coverage of the monetary policy. The Reserve Bank of India top officials gathering now to address the media after announcing that pause in policy widely along expected lines. But, more than the policy measures, it was the banking measures that caught the attention of the markets that were the focus. For the first time ever, I think we've had as many as 22 measures announced for the banking and financial sector as a whole. Let's cut in, to the governor and his deputies who are addressing the media as we speak. Stand by. There's really been these raft of changes as far as bank lending is concerned. We've not seen this before. Acquisition financing, easing norms. Okay, there we go.
Welcome to this post-policy press conference, fourth for the 25-26. Friends, we have with us Governor, Reserve Bank of India, Shri Sanjay Malhotra, Deputy Governors, Shri M. Rajeshwar Rao, Shri T. Ravi Shankar, Shri Swaminathan J., and Dr. Poonam Gupta. We also have with us Executive Directors, Dr. Ajit Joshi, and for the first time, Dr. Indranil Bhattacharya. I also welcome my other colleagues from the Reserve Bank. As always, we'll have a few housekeeping announcements. Sir, there are around 23 participants from the media, and I request the media participants to please stick to one question so that everybody gets a chance. I'd also request everyone to switch on the mic when they are intervening so that the people listening to this transmission, they are able to listen clearly. And once you are done, please switch it off. Sir, so with your permission, I'll call out the names. I would ask Ms. Lata Venkatesh from CNBC to ask the first question. Lata, please.
Thank you, Puneet, and thank you, Governor, for the opportunity. You have said in the statement that the fall in inflation opens up space for further supporting growth. You have omitted the word limited, which was there previously when you said limited space. So should we understand there is space for more than one cut? And what are the trigger? If you had the space, why not now? What trigger are you waiting for? You also said that the transmission is broad-based. Are you okay with the way bond yields have moved? There doesn't seem to be transmission there.
Yes, there is a change, as you have noticed. I mean, inflation has reduced considerably since we met earlier in June by 1%. And so that does open up the space. At the same time, growth you have seen, while it has surprised us on the upside in Q1, Q3, Q4, and even next year, there is a downward revision slightly. And as mentioned, it is on account of the tariff, the 50% tariff that has come into play, offset to some extent by the GST. Why not a rate cut is again, given in our statement. Monetary policy transmission, while it has been good across sectors, it is still happening. And it's not only monetary policy transmission. There are other policies, for example, the government GST rate, and a number of other policies announced by the Honorable PM and the government. They are taking shape and their impact is still unfolding. At the same time, there are still a lot of uncertainties. We see developments every week, every day, and we also see responses there too. There is still, clarity on that account. And so that's why the MPC felt that we should pause. Insofar as transmission to government bonds is concerned, you are aware that there was a good transmission of about from 686 peaks or thereabout to 630, about 46 basis points. And after that, there has been a hardening. So the net impact thereof is only about 660, 659 today, so about 30 basis points, more than 30 basis points, about 30 or less than 30 basis points in the government yields. We are watchful and we'll see, how Ultimately, it is, of course, for the demand and supply. We'll see how all the needs of the economy are supported.
Speak about limited. Why did you drop that word?
I mentioned no, that inflation has dropped by 1% from our earlier forecast. It is now at 2.6% from our earlier forecast. So it has dropped down by 1%, and so that's the reason. And the growth at the same time, I did mention, has also been revised slightly downwards. Primarily, of course, as I mentioned, on account of trade-related, the higher tariff that has come into play, which is still negotiations going on, etc., still unfolding. But we have taken that. Yes, we have made that change. Yes, and that's the reason. The changing growth inflation dynamics is the reason that we have changed the language.
Thank you, sir. For the next question, I'll ask Mr. Mayur Shetty from Times of India. Mayur, please.
That's the attempt, that whatever are the external headwinds, we try to counter them. Ours is primarily a domestic demand-driven economy, so the impact is limited. It's not as high as some of the other countries, as I had earlier mentioned. And the government, as well as the RBI, both fiscal, monetary, and other policies, will make all efforts to ensure that whatever are the headwinds, they can be countered. At the same time, you are aware that negotiations are still going on. Government is looking at other means, opening up other markets. There has already been a trade deal with the UK. Negotiations are on with so many other countries, including Oman, EU, etc., that will also open up markets for our exporters. And on the whole, the Indian growth has been quite resilient, and we are very hopeful that we will continue to maintain a very high growth trajectory while maintaining price stability.
Thank you, sir. Next, I'll have Mr. Manojit Saha from Business Standard. Manojit, please.
Thank you, Governor. The commentary is that inflation is coming down while there is softening of growth expected because of the trade-related uncertainties. I wanted to understand, so this clearly hints that going ahead, rates can probably come down. Rates going up is not an option. So is there a discussion to change the stance to accommodative?
Yes, there was a discussion. As you have already noted, 2 members want it. We don't have a vote. It's more of a forward guidance. Let me again, clarify. This was clarified in one of the earlier policies. It has got nothing to do with liquidity. It is only as a measure of forward guidance as to where the rates can be going forward. So 2 members, Professor Ram Singh and Dr. Nagesh Kumar, have given their guidance as accommodative, while the others have maintained it at neutral.
Thank you, sir. Next, we'll have Ms. Hamsini from Money Control. Hamsini, please.
Thank you. Good afternoon, Governor. I'll move a little from macro aspects. One of the things in the policy speech which sort of caught my attention a lot was the limits for specified large corporates. That has been sort of done away with, and the reason in 2016 it was introduced, one of the reasons cited was to also develop a very vibrant bond market and de-risk the banking sector to some extent. So now that we've gone back on that, what is the inference that one should make, that credit growth for large corporates should once again come back or be fed by banks, or despite all efforts to create a little bit of vibrancy in bond markets, it's not yet picking up? How should we infer that particular change, sir? And as a continuation to that, a lot of changes have also come pro-banking sector in this particular speech, like for instance, funding acquisitions, etc. What was the rationale in making, or in opening the doors for ease of doing business for banks, granting a lot of their wants?
A lot of questions in one question only. First of all, my understanding is that the 2016 policy was more about mitigating risk and reducing, limiting exposure to large corporates at the banking system level, not at the bank level. For the bank level, I would like to clarify that the large exposure framework which was there continues. There is no change at the bank level, individual bank level. Whatever is the large exposure framework continues. At the banking system level, any borrower which was having an exposure, a credit limit of 10,000 crore rupees or more from 2019 onwards, this limit was progressively reduced from 25 to 15 to 10,000 starting from 2016 to 2019. That has been done away because it is felt that that the large exposure framework is able to take care of the needs at the individual bank level, and at the banking system level, if there is a need, we have the macroprudential tools already to take care of that. Thirdly, you have been seeing, that the share of corporates in the total banking exposure has in fact, come down over the years. I do not have the right numbers. I think last 10 years it has reduced by about 10% or so. So the risks are not so many. So that's the primary reason, why we have reduced, why we have proposed to remove this large exposure framework for specific borrowers at the banking system level. And then there are a number of other measures, ease of doing business. I think we announced 7 measures on top of some 5 measures, smaller measures, which we had announced couple of days ago. That's a continuous process. We need to continue looking at rationalizing our regulations so that the productive needs of the economy are met with the least of compliance burden, with the least of cost, while at the same time ensuring that wherever prudential measures are required, they are not compromised.
थैंक यू सर. अब मैं श्री अनुराग शाह, ET Now स्वदेश से आग्रह करूंगा कि वे अपना प्रश्न पूछें. अनुराग जी.
थैंक यू सर. पुनीत सर. सर, जिस तरह से आपने अपने संबोधन की शुरुआत में भी जीएसटी रिफॉर्म की बात करी, आखिर में भी जीएसटी रिफॉर्म की बात करी, तो सर जो ग्रोथ का टारगेट को रिवीजन किया गया है उसमें टैरिफ का कितना योगदान है और जीएसटी रिफॉर्म का कितना योगदान है? और क्योंकि सर 22 तारीख से ही ये रिफॉर्म की शुरुआत हुई है, तो आगे चल के इसमें और ज्यादा जो ग्रोथ का आउटलुक है उसमें और बदलाव हो सकता है. और सर महंगाई को जो आपने 3.1 से 2.6 में लाया है, तो जो जीएसटी रिफॉर्म है एक सरकार की तरफ से बहुत बड़ा ऐलान किया गया और उससे पहले बजट में जो पर्सनल इनकम टैक्स में ऐलान किया गया था, इन दोनों के बाद से लोगों के हाथ में काफी ज्यादा पैसा रहेगा और वो कंजम्पशन में जाएगा, तो वो महंगाई पे कितना इम्पैक्ट डालेगा? और सर एक पिछली बार मैंने एक सवाल पूछा था, लेकिन सर वो थोड़ा सा सही से नहीं पूछ पाया, तो अगर अनुमति हो तो बाद में पूछ सकता हूँ.
तो पहले ये जो आपने बोला है, ये सभी का जो प्रभाव है, चाहे वो जीएसटी हो, चाहे वो 50% टैरिफ हो, बेसलाइन में हम 50% टैरिफ को मानते हुए ही हमने सारे अपने अनुमान अब इसमें अनुमान में हमने उसको इंक्लूड किया है. तो लेकिन जैसा कि स्टेटमेंट में भी बताया गया कि जहाँ तक वृद्धि दर की बात है, तो जो टैरिफ हैं 50% का टैरिफ और साथ ही साथ जो अनसर्टेनिटी है, ग्लोबल डिमांड, इसके 2 इम्पैक्ट हैं. एक तो जो ग्लोबली डिमांड पे न केवल यूएस डिमांड बल्कि पूरी ग्लोबल डिमांड के ऊपर में जो कमी आएगी, एक वो इम्पैक्ट है जिसकी वजह से हमने, आपको मालूम है कि 20 बेसिस पॉइंट्स पहले अपनी वृद्धि दर 6.7 से 6.5 करी थी और अब एक 50% का जो इम्पैक्ट है वो डायरेक्ट एक्सपोर्ट्स यूएस के ऊपर में है, जो कि कम हो सकता है यदि जो अभी जो वार्ता चल रही है वो और सकारात्मक होती है। और जीएसटी का इसका जो प्रभाव है वो उससे कम रहेगा, हमारा अनुमान है, तो इसलिए वो पूरी तरह से ऑफसेट नहीं कर पाएगा। कुल मिलाकर के जैसा कि हमने कहा करीबन 20 बेसिस पॉइंट्स औसतन की कमी इन सभी इम्पैक्ट्स की लेते हुए हमने ये अनुमान अपना लगाया है। कुल मिलाकर हालांकि इस साल में चूंकि पहले 6 माह में अच्छा इकोनॉमिक एक्टिविटी हुई है और हमारे पास में नंबर्स ऑलरेडी आ चुके हैं, तो इस वजह से कुल मिलाकर के इस वर्ष का जो ग्रोथ फोरकास्ट है वो बढ़ा है।
धन्यवाद सर। अगर समय मिला तो बाद में पूछ लीजिएगा, बाकी सबको मौका मिल जाए। धन्यवाद सर। नेक्स्ट आई रिक्वेस्ट स्वाति भट्ट फ्रॉम रॉयटर्स। स्वाति प्लीज।
Thank you, sir. So, at the RBI for the last decade or so, largely the focus has been on reducing the banking sector risks. But now by easing the large exposure framework, allowing banks to, fund acquisitions, IPO financing, more in shares, aren't you in some way, making, inviting possible risks here? I mean, and what are we trying to achieve through all this easing? Can you just throw some light on that? Thank you.
We have taken measures very balanced, calibrated, thought out, considered. Even though we'll be doing a public consultation, even pre the formal consultation, a number of consultations, and there are measures on both sides. There are at least a couple of them, ECL, credit risk, related capital adequacy norms, which I won't say which put high requirement, I don't think so, but it will be better targeted. Those banks, depending on the risks, some of them may have to provide, and keep higher credit, it will be better targeted. And similarly, some of the other measures that we have taken to enhance the flow of credit, improve the competitiveness of the banks. It's not as if those measures were not there at all. For example, project finance, we were already allowing project finance. Project finance for infrastructure companies was already allowed. We have not seen, acquisition finance. For acquisition finance was not, was already allowed for infrastructure companies, and now we have expanded it. Similarly, the loans against shares, etc., or for IPO financing, it was already there. It was not revised for a number of years. So it's but natural that, we revised them. I think on the whole, all these measures taken together, and we'll continue to take more measures, as and when required. Always the aim will be to promote the stability while at the same time improving competitiveness, encouraging and enhancing growth of the economy. You want to come in?
Sir, I think as Governor has already mentioned...
Because number of measures actually, these measures pertain to the regulation division. I request DGMRR to...
I think most of the measures have been well thought out and calibrated, one. Second, the banking system's ability to handle the risks has improved over the period, so there is some enough provisions. Third, most of the measures have enough guardrails built into them to safeguard the interests of the banks and the financial system. And speaking of the loans against, I think the limit has gone from 80 to 1 crore. I think the limits were last 1998. So on overall, I think it has been a calibrated set of measures. And again, it's coming up for public consultation, so we will take the feedback and revise it if appropriately required.
Thank you, sirs. Next, we'll have Mr. Vishwanath Nair from NDTV Profit. Vishwanath.
Hi, good afternoon, Governor. I'll go back to your first speech as RBI Governor, where you spoke about the cost of regulation and the ease of regulation. Are we to see these 22 guidelines that, or whatever, indications of guidelines that you've listed out in today's speech as a move towards that? Because while ECL is a very necessary and very delayed sort of framework that is coming in, a lot of others seem to be giving banks whatever they were asking for. Some of it, like for example, acquisition financing was something that banks have been speaking very vocally about over the last few weeks. Is that how we should see these moves?
Yeah, see, circumstances change, times change, requirements change, and so nothing should be frozen in time. And so that's why we had earlier also said that we will be continuously reviewing our regulations. In fact, we have decided in the FSDC under the chairmanship of the finance minister, where all the finance sector regulators come together to review each and every regulation every 5 to 7 years. So while we are doing that, and while it will be a continuous process, as you are mentioning, some of these things which have come our way, we have thought it appropriate to revise them, and that's it's very important that we continuously revise, review, improve our whole regulatory ecosystem.
Thank you, sir. Next, we'll have Mr. Anup Roy from Bloomberg. Anup, please.
Thank you, sir. Sir, in the policy you mentioned about rupee reference rate with trading partners. Now with major trading partners, so far we have 4 rupee reference rate, and now it will be expanded. So what are those currencies? And also I wonder what will be the benchmark reference rate that you will use, and will that also increase rupees trading in the international market? Like what I mean is that earlier there used to be a cross currency like INR USD and then USD say CNI. How will you fix that?
Yeah, I think the objective is that you minimize the use of crossing currencies to get rates. That will help both our currency as well as the other currency. We are currently looking at a couple of currencies. We are looking at Indonesian rupiah as one. We are looking at AED for another. But there are a few others. We will gradually keep taking them up. About your question on how do we set the benchmark? We'll have to see. We'll have to see because there are not many active transactions to begin with. So the process FBIL has to work out, what is the best way of initiating something. This is a case where, the pricing, the reference has to be shown first, and the market has to pick up from there. So keeping that in mind, we'll have to work out ways of, how do we arrive at what benchmarks do we use for these reference rates. Thank you.
Thank you, sir. अब मैं जी बिजनेस की एकता सूरी को आमंत्रित करूंगा कि वे अपना प्रश्न पूछें.
गुड आफ्टरनून सर. सर, मेरा सवाल यहाँ पर आम लोगों से जुड़ा हुआ है, उनकी जेब से. मैं ये पूछना चाहूँगी कि पिछली पॉलिसी से लेकर इस पॉलिसी तक 2-3 खबरों ने बहुत तूल पकड़ा हुआ है. सबसे पहले तो ये कि क्या बैंकिंग सेक्टर का ये कहना है कि जिस तरह से यूपीआई ट्रांजैक्शंस बढ़ रही हैं, हमारे इंफ्रास्ट्रक्चर पर बहुत बड़ा एक तरह से बर्डन भी बढ़ता जा रहा है, लेकिन कॉस्ट उतनी हमारी रिकवर नहीं हो रही. तो क्या आने वाले दिनों में यूपीआई ज़्यादा बड़ी ट्रांजैक्शंस पर किस तरह की कोई फीस लग सकती है? और दूसरा एक खबर ये कि यहाँ पर बैंकिंग सेक्टर का ये कहना है कि हम होम लोन में हमारे पास घर गिरवी है या गोल्ड लोन में सोना गिरवी है, लेकिन जब हम स्मार्ट अप्लायंसेस की बात करते हैं, जैसे स्मार्टफोन हो गया, तो यहाँ पर रिकवरी पॉसिबल नहीं है. तो क्या बैंक्स उसको रिकवर करने के लिए पुराने वाले तरीके पर जा सकता है कि जहाँ पर फोन लॉक हो गया अगर आपने किस्त नहीं भरी? और जिस तरह आज सेबी का एक एक्ट वैलिड हैंडल जो लॉन्च हो रहा है कि अगर मैं पैसे भर रही हूँ किसी को तो मुझे पता चल जाएगा कि ये फ्रॉड है, ये सेबी रजिस्टर्ड नहीं है। तो ऐसा ही कोई ऐसा प्लेटफॉर्म कि अगर मैं किसी को पैसे ट्रांसफर करूँ तो मुझे ये समझ में आ जाए कि ये एक फ्रॉड अकाउंट हो सकता है या मैं इसमें फंस रही हूँ।
3 प्रश्न। पहला, यूपीआई पे क्या कोई चार्ज लग रहा है? तो ऐसा कोई अभी हमारे सामने ऐसा कोई प्रस्ताव नहीं है। दूसरा, आपने कहा कि क्या मोबाइल फ़ोन को जो लोन दिया गया है मोबाइल फ़ोन खरीदने के लिए, क्या उसे लॉक करने की इजाज़त दी जा सकती है या नहीं दी जा सकती है, जिस प्रकार से अन्य गृह लोन के लिए या ऑटो लोन के लिए इजाज़त दी हुई है। ये मामला अभी परीक्षणाधीन है। हम इसको क्योंकि इसमें दोनों तरह से हमारे पास में तर्क और वितर्क आ रहे हैं, उनका हम अध्ययन कर रहे हैं। हमारा ये प्रयास है कि जो हमारे ग्राहक हैं, कंज्यूमर हैं, उनका जो अधिकार हैं, जो डेटा प्रिवेसी है, वो सुरक्षित रहे। कंज्यूमर इंटरेस्ट, ग्राहकों का इंटरेस्ट, हित वो सर्वोपरि है। साथ ही साथ जो लेंडर्स हैं उनका इंटरेस्ट भी किस प्रकार से सुरक्षित रखा जा सकता है, ये मैटर अभी अध्ययनाधीन है। तीसरा आपका प्रश्न था फ्रॉड के बारे में शायद, उसके लिए कुछ कार्य हम लोग, ये एक गंभीर विषय है, इसके ऊपर में हमने कई कदम पहले भी उठाए हैं और निरंतर हमारा ये प्रयास रहेगा कि किस प्रकार से हम जो फ्रॉडुलेंट तरीके से एक अकाउंट से दूसरे अकाउंट में पैसा निकाल लिया जाता है उसको हम किस प्रकार से रोकें। उसी क्रम में पहले हमने आपको म्यूल हंटर के बारे में बताया था, उसी प्रकार से एक अन्य जो एक एक्सपेरिमेंट, ये अभी एक्सपेरिमेंट की स्टेज पे है, अभी इसको पूरी तरह से हमने लागू नहीं किया है। उसको हम अभी जो हमारा सॉफ्टवेयर है हम तैयार कर रहे हैं कि किस प्रकार से पूरी इंफॉर्मेशन लेते हुए पहले से ही यदि हम ग्राहक को ये सचेत कर दें कि ये एक रिस्की ट्रांजैक्शन है, आप इसको न करें, तो उसके लिए हम अभी प्रयास कर रहे हैं। अंग्रेज़ी में यही बात कहने के लिए मैं हमारे डीजी को निवेदन करूंगा, वो आपको अन्य सबके लिए, ये तीसरा वाला जो प्रश्न है अंग्रेज़ी में सबके लिए, और दूसरा वाला जो प्रश्न है जो मोबाइल फ़ोन के बारे में है, मैं डीजी MRR को बोलूँगा कि वो अंग्रेज़ी में इसी चीज़ को वो रूपांतरित करें।
Yes. Yeah. No, I will not try to translate what the governor said, but yeah, it's basically this: the digital payments intelligence platform. You would recall that RBI had set up a group; it had announced. We are now implementing it, as the governor said. The actual prototype is getting developed by our innovation hub. An entity is being set up to run this. The basic idea behind this platform is that you collect information from whatever sources are available: mule accounts, telecoms, geography, where the call is coming from, and whatever else, whatever information is available. And you have an AI system which is being trained on this information. And the idea is that this system will alert before a transaction by saying that this transaction is risky. Based on the alert, the customer will have to take a call or the bank will have to take a call. So we expect that this will have a significant impact in terms of reducing, the number of frauds that we see in the system. By no means, I'm saying that the number of frauds are high. The number of frauds are well under control. If you look at number of frauds per transactions in UPI and others, they're quite low. But these systems will further lower those transactions. Thank you.
The issue of digital locking, which I think it had referred to, I think the issue is under examination, as Governor has pointed out. And there are pros and cons on both sides in terms of balancing the customer rights and requirements, data privacy, and also the creditors' requirements. So we are examining the issue. We will evaluate the pros and cons and then take a view at a later point in time.
Thank you, sirs. Next, I'll ask Ms. Sangeeta Mehta from Economic Times. Sangeeta, please.
Thank you, sir. Thank you. Sir, my question is on forms of business. You all have relaxed the guidelines and you have said that the board of the banks will have the discretion to decide. Why has RBI chosen to relax the norms? And sir, on one more thing on this, what would be the specific macro-prudential tools that you would be using for larger exposure framework?
So, first thing you are saying relaxation. Let me first of all clarify that that was only a draft. So it was not a final kind of a guideline or a direction. So the other thing is, see, we don't want to micromanage. We believe that the banks will take a conscious, considered, balanced view depending on their needs as to how they wish to conduct their own business. And so that's why, we have just left it to them. Second question was?
What would be the
macroprudential tools. A number of them.
No, we have several
I'll leave it to the
tools which are available. Maybe we can look at, say, putting a cap on the exposure from all the banks, because I think the fundamental point which Governor mentioned was the concentration risk. All the banks' collective exposure to a single entity. So we could think of limits for that. But that is something which can be considered at a particular point in time, if appropriate.
And then we have supervision.
Yes.
Also. We can also put in supervisory measures in case required.
But this will be draft first.
Yes.
This is final now.
Forms of business is final.
Yeah. Forms of business is final.
No, the large credit.
That is draft. That is a draft circular.
Thank you, sirs. Next, we'll have Mr. Ashish Agache from PTI. Ashish, please.
Thank you so much, sir. Sir, a quick follow-up to Vishwanathan's and Swati's questions. So earlier there was a perception that financial stability sort of foregrounds RBI's approach on things. Are we to now understand that it's a sort of turn towards being more pragmatic? And so second quick question, sir, how do you look at these adverse weather events right now? Since the last policy there have been more. So how do you look at this from an inflation and growth perspective?
I don't think, that you should see these measures as any kind of a relaxation or kind of letting go our sight, from financial stability. Stability is foremost for us. Whether it is price stability, whether it is financial stability, that is foremost not only for us, I think for the country as a whole, it's very, very important. Because if you do not have price stability, there are consequences. Similarly, financial stability, one episode of financial instability can take you, many years behind. So all of us need to be very conscious of that. At the same time, we have to be very careful. We have to ensure that we are not in any ways impeding growth or limiting whatever are the fulfillment of the genuine requirements of the various productive sectors of our economy. So financial stability, price stability will continue to be the primary focus of the Reserve Bank, as it is for all other central banks as well. Weather-related events, yes, they do have an impact on both growth and on inflation. There have been a number of them. At the same time, let's also keep in mind that the government has also put in place a number of measures now. The supply chain management is much better, and they are able to respond to them better. And so that's why we have seen that over the years, despite there being more weather-related events, as you mentioned, inflation has been much better behaved. It's been lower, last 10 years vis-a-vis earlier 10 years. So, and at the same time, we will also do whatever is required for the health of our banking system to be able to take care of any weather or climate-related risks.
Thank you, sir. Next question will be from Mr. Ankur Mishra from ET Now. Ankur, please.
Thank you so much for the opportunity. Hello, sir. I want to ask you regarding the rupee depreciation, which you have mentioned in the policy also, you will take measured as and when required. In the MPR, the revision of exchange rate has been there from 86 to 88 this time. I want to understand from you, is the current exchange rate comfortable for you? And also talking about MPR, you have made projections for inflation also 4.5%. In that context, keeping the neutral rates and talking about the real rates here, it is below the estimate. How much of the scope of then easing is there for you?
What is below the estimate?
Real rate. 4.5%, sir, is the projection which has been given in the MPR.
Okay. So, your first question was on?
Rupee.
Rupee. So, rupee, see, we do not, you asked me, whether you're comfortable with this rate, etc. So, we do not target, any level or any price band. Our effort has been to manage any undue volatility, and we will continue to do so. Insofar as you are saying the real rate is concerned going forward, you are saying is 4.5%. That is in Q1. So there are a number of things which go into it, and it's not only inflation that we have to look at. We have to also look at growth in our overall macro, in our monetary policy. And so, based on that, we have continued to retain the policy repo rate at 5.5% and the stance at neutral.
Thank you, sir.
Thank you, sir. Thank you, sir. Next, we'll have Mr. Mahesh from Financial Express.
Thank you, sir. With all these measures taken, are you still seeing any green shoots in the capex happening in this country, especially with the large corporates, apart from the infra and the renewable sector? Thank you.
Yeah, we had a good number, in Q1. We had a good, healthy number. A lot of sectors we are seeing good demand. I think cement, for example, auto, a lot of other sectors, they are seeing a good demand for capex. And on the whole, we are confident that capex will further going forward revive. Private capex will revive.
Thank you, sir. Sir, next it will be Mr. Aryan from Informist Media. Aryan, please.
Thank you, sir. This question is for both the Governor and DG Gupta, if possible. The MPC resolution said that the MPC was waiting for the impact of prior steps to take further action on rates. Eventually, the transmission of the prior actions will take place. Considering your growth and inflation forecast for the next few quarters, what do you think will stop you from cutting rates, especially considering the real and nominal GDP? The real and nominal GDP numbers in the June quarter painted very different pictures of the economy. Thank you, sir.
Leave it to you.
Sure. As you know, monetary policy is a forward-looking response. So while Q1 numbers have actually been surprisingly good, as you said, but there is some softness projected in the second half of the year. And inflation numbers have also been surprisingly very, very benign. So I guess taking into account both of those developments, as we said in the statement, some room has opened, but it has to be contextualized with everything else that's happening, both domestically and globally. So it's a fast evolving, very, very fluid situation. Yes, Q1 numbers have been good, but those are only one factor in the number of things that we consider for monetary policy action. And that is an important factor, but it's a backward-looking factor. So to that extent, there is room, but as has been said and has been also repeated by Sir, a number of other things will be taken into account before deciding the next action in December.
Thank you, ma'am. Next, we'll have Mr. Laltendu ji from the Hindu.
Good afternoon, Governor. You have partly answered my question that I'll be asking. This is about the impact of the tariff on the Indian economy. Have the RBI or the MPC mapped different, the impact into different sectors? Thank you, sir.
Yes, we have the map. We have the details. You are aware, which are the sectors: gems and jewelry, shrimps, textiles. Now maybe a little bit of very little extent, generic branded pharma, which has now come in later, footwear. These are the primary sectors, which will be impacted.
Thank you, sir. Next, we'll have Ms. Subhana from the Mint.
Hi, sir. So, sir, I wanted to go back to the first question on monetary policy transmission. You said that and there has been an impact of yields have gone up by 30 to 35 basis points. Now, that has gone up since the June monetary policy, and we've seen some headwinds on monetary policy transmission. So, what is it that is RBI concerned about this monetary policy transmission getting impacted through the bond channel? In your assessment, would you bring back OMOs or GSEC purchases? In what way would you signal, to ensure the market that the policy repo rate adjustments, would feed through long-term rates?
See, the primary tool that we have for monetary policy transmission is the policy repo rate, and align the policy, the operational target, which is our Walker, to the policy repo rate. Last month, it was at 5.46%. There has been broad-based transmission, as I mentioned to you, across all sectors, whether it is money markets, bank credit, even corporate bonds. Corporate bonds are down from their peak by 50 basis points, 5-year AAA corporate bonds. And similarly, for other bonds also. Similarly, for government securities also. It's a process. It takes time, and we are hopeful that the transmission will take place, even in other sectors. Please also keep in mind that even in 10-year, as I mentioned, it's about 25-30 basis points. Only because of monetary policy, it had decreased by even more, 60 basis points. There have been certain developments after that. The other thing is, 10-year will not move 1:1. Let's keep that also in mind. So 25-30 basis points, while there is scope for more, and we feel that it should head downward. A number of measures have been contemplated in this regard, including, how the primary GSEC auctions will be held, the tenor of these government offerings, not only central government as well as state government. We are quite confident that monetary policy transmission will happen, even has already happened to a great extent, and will continue going forward.
Thank you, sir. From the left-hand side itself, Mr. Ben from New Indian Express. Ben, please.
Right, sir. What is a complaint or a suggestion? The RBI statements and releases are coming too late these days and in too many bunches. It could be given on a reasonable time. It could be, we can't do a better job of that. Like that banking, the regulation, 7 regulation changes, it came at 10:20. Or the bulletin came, last bulletin came at 11:30 or something. It's beyond our capacity to manage.
We work 24/7.
So I don't think.
I get the point, and we will endeavor that we bring them out. What time do you want them out? By 6 p.m. Okay.
So my question.
All right, that is the Reserve Bank of India governor, repeatedly talking about how there is no letting go of oversight when it comes to financial stability with this, 22 other measures that have been announced, relaxations for the banking sector primarily. There will be enough guardrails that will be put into place when all of these regulations are announced, and it'll only be done after public consultation. But that said, I mean, this is a big shift coming in, from the spate of regulatory tightening that we've seen in the previous few governors' regimes. Whether this is capital market financing, removing limits, allowing acquisition financing, lending for IPOs against debt securities, or easing the risk weights. RBI has said for MSMEs, residential real estate, for NBFC lending to infrastructure, all of these mark really a sea change, a large exposure framework easing that also that the RBI is talking about. So you had the RBI top brass addressing that, and of course back to the policy, the pause that has come in expectedly with the RBI leaving room for more rate cuts on the table by saying that the lower inflation print does open up some space for action in the future. On that note, let me welcome our esteemed guests on the show. Neeraj Gambhir, Group Executive and Head of Treasury Markets and Wholesale Banking Products at Axis Bank, Pranjal Bhandari, Chief India Economist at HSBC, and Soumyakanti Ghosh, Group Chief Economic Advisor at State Bank of India. And also with us for these banking regulations is Anil Gupta, Senior Vice President and Co-Group Head at ICRA. Thank you so much, all of you, for joining us here. Anil, let me start with you before I go to the economists. This series of measures, banking reforms, as the RBI is calling them, that it has announced, whether that is, the overlapping businesses that, RBI has left to the discretion of boards, allowing, acquisition financing, lending for IPOs against debt securities. What do you make of these changes and the kind of additional credit this will unlock for banks to capture back market share from other financial players?
Yeah, thanks. So it's difficult to quantify maybe the incremental credit flow which may flow because of these relaxations, but definitely the measures which have been announced are in the backdrop of slowing bank credit growth, and all these measures, maybe especially the enhancing that removal of the circular on enhancing the borrowing through market mechanism for large borrowers, that is going to have maybe a favorable impact in terms of maybe credit flow, because that circular especially involves maybe larger corporates to borrow maybe 50% of their incremental borrowings through market mechanism. While that is possible for larger well-rated companies, but for large maybe companies which are rated in lower rating categories, it becomes difficult for them to raise 50% of their incremental borrowings from the capital market. So that should improve the credit flow to these corporates and should be beneficial for the overall bank credit.
Anil, let me specifically get from you some of the names, for instance, and forms of business, this circular being withdrawn. HDB is the clear standout beneficiary. For other banks, who are the ones that stand to benefit?
So, like all the large banks will have subsidiaries operating into, let's say, insurance, NBFCs, capital market businesses, merchant banking activities, broking. So while maybe some of these businesses, let's say, are not overlapping like insurance, capital markets, but the major concern was on the lending piece, which is done by through the NBFCs of these large banks. I think the intention is basically to give the free hand to these banks to continue lending, because see, these banks operate and cater to different customer segments. through bank and their subsidiaries. These customers may require maybe a different kind of a setup. Even the employees which are working in these subsidiaries may have a different skill set. The branches which these subsidiaries will have a different skill set, a different setup. So basically, working the same product which is being catered by a subsidiary through a bank is very, let's say, less feasible. So that gives a lot of headroom for these banks to maybe cater to a wider segment of the customers and in wider product segments also.
Well, Anil, hold on. I'll come back to you in just a bit. Pranjul, quickly, your takeaways. The pause, as expected, has come in, and the RBI does seem to have left room for rate cuts in future.
Yes, absolutely. Going into the meeting, we were forecasting a dovish pause, and I'm still surprised at how dovish the pause was. A couple of reasons. One is the commentary on inflation, the fact that, they said clearly that there has been significant moderation. They've cut all kinds of inflation forecasts for FY26, first quarter FY27, fourth quarter FY27. Similarly, with growth, they've mentioned clearly that growth is below aspirational levels, and then they've cut the second half of the fiscal year growth numbers as well. It can be asked whether does that mean they will cut or not, and my sense is they gave both direct and indirect indication that they are open for more easing. One is that they said that more space for easing has come up. The governor also said that this is communication, but we also want to follow it up with credible action. So I think that was sort of a direct inkling that, some rate easing could come in the future. And I think there was some indirect way of communicating that as well, with 2 of the 6 MPC members actually preferring a accommodative stance at this point of time. I think that's a really big signal. So all of this makes me feel that if, we go into December policy and the 50% tariff is still there, and I think that's the main thing here, the 50% tariff, if it's there, then I would say that there could be easing in December and also in February. But I think a lot depends on the tariff rate at this point of time. Quickly, one more thing. I think the governor also said in his in the press conference right now that at this point of time it is not clear, but over a year, I think it will be clear to them that the negative impact of the high tariffs can be more than the positive impact of GST tax cuts. And that is why they have brought down their second half of fiscal year GDP growth numbers. So if that were to be the case, then I would say that December is going to be a rate cut.
Okay, Pranjal, that was quite comprehensive. Thank you. I mean, that is a list of things that makes this policy sound more dovish than we'd expected. Soumyakanti Ghosh, you had gone into this policy expecting a 25 basis point cut, which has not come. What is your base case scenario? We don't know how the tariff negotiations will go. What happens in December and thereafter?
No, thank you, Ritu. I think the policy is, if I look into this policy is basically very balanced communication in terms of rate space opening up in the future. But beyond the rate cacophony, this policy is actually beyond the rate cacophony, and it is actually a very good policy in terms of addressing the market microstructure. And if I have to borrow Ben Bandanke, it's constant policy discussion that is based. I think all these measures which we have mentioned in terms of the large exposure framework, the deposit risk insurance premium, and also the mergers and acquisition will do 2 things. First, it will increase the bank lending significantly, and also it will come at an affordable cost, because the transaction cost will also decline because of the many complexities around this circular. I don't want to get into the details, but the point is that, so this will serve the purpose of not only making the regulations more transparent, more constant, but also it will move in the direction of reducing the transaction cost of the banks. Now, having said that, coming back to the policy, I think if you look into the policy inflation projections, it was 4.2% at the beginning of this year for this current fiscal. Now it has been reduced to 2.6%. So there is a 160 basis point reduction. On the growth front, we moved up to 6.7. Now we have moved, then we came down to 6.8. Now we have moved back to 6.8. And if you actually very closely look into the RBI inflation revisions and the GDP revisions over the last 7 to 8 years, you will find a distinct pattern that even if the RBI inflation projections have been downwardly revised, but if the GDP numbers are not adjusted, the rate cut doesn't come in the policy. So possibly if you look into the numbers right now with the GDP growth rate being adjusted in the second half, I think that will open up space for possible rate cuts, maybe in December, maybe in February. The timing we can always debate. But as of now, I think the policy is clear in its communication that inflation is headed down, and the only way why the rates have not been cut in this policy is one to look through the prism of uncertainty. But the question remains there that even if we may wait for the uncertainty to recede, there is no guarantee that it will recede in the next couple of months. So it can actually increase. So it can cut both ways. But my sense is that the policy has given enough indications of further easing in the next couple of months.
Okay, thank you for that. We have to take a mandatory break. Mr. Neeraj Gambhir, when we get back, we want to ask you about how the bond markets have, absorbed this policy. But we have to take a break. Back in just a moment to continue this discussion. Welcome back. We continue our monetary policy discussion with a whole host of experts. Mr. Neeraj Gambhir, just before taking the break, we were talking about the bond markets. Perhaps OMO is not something that the governor said, but plenty of dovish commentary. The 10-year now at 6.56. Where do you see it settling, and some of the biggest takeaways for you from this policy?
Thanks, Ritu. But before I go to the bond market commentary, I want to say something about the overall direction of this policy. I think it's really a breakaway policy and standout policy for me as far as the number of regulatory changes in the banking sector related changes that they have introduced. Some of these are long-standing demands, for example, allowing banks some kind of a role in M&A financing. Some of these are basically changes that were in the draft stage, for example, the forms of business circular. And some of these were changes that they have recently made, for example, the changes with regard to opening current accounts as far as there was concerned. So these are very, very significant and important changes, and some of these changes will have quite a bit of bearing on the way banks function. Of course, for many of these, the devil will lie in the detail as to the exact form of the circulars and what is permitted and what is not permitted. Coming to the bond market, I think the market was expecting a little bit of a dovish bias in this policy. But I think the dovishness in the policy is a little bit more than what the market was expecting. So we've seen some pullback in the yields, even although not very much. The key issue for the market is two. One is that we're going to have significantly higher supply than what the current demand seems to be. So we seem to have some kind of a demand-supply mismatch. Second, we're going to have a new 10-year bond. And as a result of that, the old 10-year bond seems to be sort of going a little bit out of the favor. So that's having some kind of a bearing on that yield. But even if we were to get a 25 basis point rate cut in December, which is what the market will likely play for now, I do expect the long end of the bond curve not to do much. Most of the benefit will be seen at the front end of the curve. So maybe up to 5-year part of the curve will see a much better outcome if there were to be a rate cut in December or even in February.
Okay. Well, may I butt in, Ritu, with your permission? We've just come down from the press conference. Shaumya, I wanted to ask you, I specifically asked him, you have dropped the word limited. In an earlier instance, you said it gives us limited space for accommodation, and now you say there is space for accommodation. Do you get the feeling that it is not one but more than one cuts possible because they have wantonly dropped that word?
Yeah, it could be possible, Lata, because as of now, they have moved the needle from 4.2, if you remember, in the April policy to 2.6 now, and they have moved the needle from 4.9 to 4.5. So in December, there could be further, if the inflation trajectory behaves like that. And there could be some more downward revisions in February. So if it goes down, there could be space could open up actually for maybe more than one rate cut. Where that will happen, whether in December and February, that's a matter of open debate. But I think the communication is very nuanced and structured and positive for the markets because it gives a clear signal that the central bank, as you correctly said, has moved beyond the limited rate action to rate action, so which could be not in single digits, it could be also multiple. So that's, I think, the bottom line. And separately, I think I was just speaking to Ritu also, I think the market is actually beyond the rate cacophony in terms of improving the market microstructure.
Oh, yes, of course. As Neeraj says, that makes it a standout policy because of the many deregulations that have been announced. But Pranjul, would you agree? Does the tone sound like more than one cut?
I think so. I think, we waited this time around, despite inflation being low, growth being lower. We still did not do a cut this time because there are a couple of uncertainties still. And one big uncertainty is what really happens once Diwali is over. In the run-up to the Diwali, we have GST rate cuts, meeting Diwali consumption demand. And all of that is holding up growth over September and I would say even October. And we are seeing it actually very clearly. We are seeing in PMI new orders are falling, but export orders are falling, but domestic orders are rising. So we have some offset because of the GST tax cut right now. But once Diwali is behind us, then I think sentiments towards growth will worsen very quickly and rapidly. If 50% tariff is still there at that point of time, then I think we are geared for 2 rate cuts, and I would say over December and February, but a lot depends on the 50% tariff. Lata, since you asked, I want to also mention one thing. For me, the standout was not just the dovishness and the regulatory points mentioned, but also discussion on the currency. We are also very used to RBI talking about how they only lower volatility in the rupee, but this time around, they actually went ahead and mentioned that appropriate steps will be taken on the currency front, and they're watching the currency very closely. I've never really seen this in the past, and my sense is I won't be surprised if over the next year we start seeing a lot more steps on attracting capital inflows into the economy. I think even some of the regulatory steps today, for example, relooking at the ECB norms, also this whole banks M&A financing, which could indirectly get some FII money in. I think all of that also has one eye on the rupee and capital inflow. So I would just sort of leave that on the table as well.
Okay. Well, I wanted to, I take your point that he was a little forthright on the rupee, probably to scare away speculators, was the way I saw it. But yeah, we may have capital attracting steps. But I wanted to ask Neeraj, for the same reasons that you say it stand out, more acquisition finance possible, more loans against shares, more loans against debt, more IPO financing. Will credit growth be a different number given all this? I mean, if you were forecasting 10, will you forecast 12 now?
I think more than the credit growth in the near term, of course, this is all subject to the finer detail that comes out. I think what was happening was that certain forms of financing was increasingly moving away from banking system into NBFCs, into mutual funds, into FPI investments through the VRR kind of route. And what this does is to bring some of that financing back into the banking domain. So effectively, it's kind of making banks far more relevant now for the corporate borrowers. And for corporate borrowers, the financing requirements are changing. It's not only about working capital, it's not only about capex, but it's also about a whole lot of other things that they want to do. And that includes acquiring assets both domestically as well as offshore. So again, it's subject to what the fine print is, but it brings a lot of that financing back into the banking system domain.
Okay. Actually, you're right. Probably NBFCs will lose if banks do more of capital market financing. Maybe the total will not improve. But Soumya, would you bet higher capital, higher loan growth? Have you changed your number from what it was before the policy?
No, I think, Lata, of course, it will lead to higher loan growth. If you remember, I think this large corporate exposure framework we had also mentioned earlier that it is actually leading to more external commercial borrowings on the part of the bank. So banks will actually now look more inwards. And just to give an example, I think that 50% norm over rupees 10,000 crore was applicable if the banks were to make a 3% provision. So now this 50% norms is going. So that will obviously lead to a significant transaction cost, the rate of interest also on the part of the banks. The corporates will have also better bargaining power. And my sense is that this deposit risk insurance premium, mergers and acquisition or LF, all these measures will actually propel the credit growth. So that I think is one of the positive developments from this policy.
Well, Anil, very quickly, we've spoken about the forms of business and the, that 10,000 cap, etc. But this expected credit loss also, the expectation was it would come in earlier. Now RBI is talking about 2027 with a 5-year ahead glide path to meet those capital requirements. To what extent had banks already prepared, and how much more headroom will this give them? This kind of an easing over multiple years to sort of get to the level that is required per the norms.
Sure, Ritu. So this discussion paper actually came in January 23, where this proposal was there to implement ECL for the banks. And at that point in time, based on our discussion with various banks, we estimated that it could have an impact on reported capital ratios, let's say core equity capital ratio, which we look at, of maybe around 300 to 400 basis points for the banking system. Maybe larger banks, private banks, have carried some floating provisions which can lead to maybe some kind of a lower impact. But at a system level, we expected maybe that if the ECL is implemented from April 2025, because the circular came in January 2023. So we estimated 300 to 400 basis point impact. Now we are saying that we will have 2 more years compared to maybe our initial estimates. So this will definitely moderate the impact from what we initially estimated of 300, 400 basis point. Now, because over 2 years, not only the banks have made provisions on their stress pools, second, the capital ratios have improved, NPA numbers have gone down. Also, the look back period when you will do your ECL modeling will not have that COVID period, which had a high kind of a stress on the asset quality. So the look back period for the modeling will throw up lower maybe PD and LGD numbers. So that will have an overall favorable impact on the ECL impact whenever it happens. 5-year transition frame was also proposed in the discussion paper. So not incrementally a new thing, but definitely provides maybe some headroom for the banks to transition.
Okay, that's a comprehensive reply. Thank you very much. Anil, thank you, Neeraj, Pranjal and Soumya as well for adding more color and helping us understand what the governor meant when he spoke at the press conference as well. Thank you, Ritu, for taking us through. The key takeaway really is that it is a dovish pause. We should expect one more cut. And as our economist experts say, probably 2 more cuts. And as Neeraj said, this is a brave new charter for banks. Much less or fewer regulations, and that's a breathing space. But will credit growth grow? That will depend on whether there is economic growth as well, and that's where Pranjal has raised some very important question marks given the global environment. Thank you very much for watching this special monetary policy coverage. It's time for a break now, and then I suppose a little bit of business lunch will follow.
Good afternoon, you're with us here on Business Lunch. We are coming to you live from the CNBC-TV18 Motilal Oswal studios. I am Hormas Fatakia, and the markets have begun the October FNO series on a very positive note. The Nifty currently trading near levels of 24,800, 160 points higher on the index, and that is courtesy the Nifty Bank. And it is the Nifty Bank that has been leading the charge higher for the benchmark index as well. 650 points on the Nifty Bank, still hovering around that 55,300 level, but more importantly above the mark of 55,000. So good going for the Nifty Bank, and the index heavyweights are the ones that are leading the charge here. Take a look at that. ICICI Bank, HDFC Bank, Kotak, Axis, all of the private banking majors doing well. Not doing well are the PSU banks, SBI and PNB, and the PSU banking index in general has been sulking after the measures announced by the RBI in its policy. Of course, there are a lot of other triggers as well, considering the fact that we started the October series with record FII short positions. The long positions ratio was only at 6%. So there is, of course, that short covering factor to be taken into account as well. But for now, a good day for the benchmark index as of yet. But the big announcements of the day, the Reserve Bank of India announcing a slew of measures aimed at enhancing the resilience and competitiveness of the Indian banking sector. Ritu has been on top of this all day long, and she's here with the key takeaways. Ritu.
Well, Hormaz, I mean, this is the first time in over a decade of covering RBI I've heard of more than 20 banking-related measures being announced in a policy, and that has really been the story of this policy more than the monetary policy action. Whether starting with the expected credit loss, application for all banks, which was expected to kick in earlier. Now RBI says will only come into effect from the 1st of April 2027, and even after that, banks will be given a 5-year glide path until 2031 to absorb the loss, to absorb any additional capital that they have to provisions that they have to provide for their loans. That is one. Secondly, and RBI is yet to give more details on this, to reduce the overall capital requirement for banks, RBI is also proposing to ease the risk weights for two key segments, MSMEs and residential retail, home loans. That is something we'll watch out for. The draft circular on forms and business, which had proposed that there be no overlapping business between the bank and its subsidiaries, has been scrapped. It was a draft, yes, it had not been implemented, but that had, put some sort of an overhang on companies like HDB Financial. For all banks that have these subsidiaries, that has now been scrapped and left to the discretion of bank boards entirely. Apart from this, for after more than a decade or more than a few decades, RBI is allowing banks to get into M&A financing. We'll have to see how much market share banks will therefore be able to wrestle away from other financial institutions now that they're going to be allowed to do this. The regulatory ceiling on lending against listed debt securities has been done away with. RBI has also increased the limit for lending by banks against shares from 20 lakhs all the way to 1 crore rupees, and for IPO financing from 10 lakh rupees to 25 lakh rupees per person. These are big changes when it comes to lending for the capital markets. Apart from this, there was a 10,000 rupee cap, for per specified borrower, above which, they couldn't borrow from the banking system. They would have to raise their money through the capital markets. That cap has been done away with entirely. As far as the large exposure framework is concerned, that continues on an overall systemic level, but RBI will look at more specific levels at a bank level. And infrastructure financing by NBFCs, the risk weights there are also proposed to be eased. So a draft of measures for banks and financial institutions that will surely have far-reaching implications.
22 measures. Well, a lot of them, Ritu. Thank you for that update. It definitely showing on the Nifty Bank in today's session. But the auto sales, the other big trigger for the day, and they have been trickling in as well all through the morning. Sonal is here to summarize the ones that have come in so far. Sonal.
Thank you so much for that. They've been decent so far, some of them even better than Nomura estimates. So let's start with the big one, that's Bajaj Auto, where their total sales came in at 5.1 lakh units, which compares with a Nomura poll of 5 lakh units. Total sales, that means, is up 9% on a YY basis. The domestic sales were up 4% on a YY basis, but this growth this time around was led by export sales, which was largely expected. So 18% growth on a YY basis for exports of Bajaj Auto. For M&M, let's talk about their auto business first, because that's where their total total sales came in at 1 lakh units, which compares with Nomura estimates of 90,000 units. Total sales saw a growth of 16% this time around. The tractor sales did really well, 49% higher on a YY basis, and this is higher than the estimates as well at 66,111 units. For Escorts Kubota as well, so it seems the tractor segment is doing really well. Even for Escorts Kubota, tractor sales were up around 47%. For Hyundai as well, the numbers have come in better than what Nomura was estimating. Some of their categories saw highest ever sales this time around, so Hyundai did well as well. For VST tillers, the total sales went up by 35%, so the agricultural segment, the GST cuts, all of it really aided sales for these companies this time around.
Indeed. Sonal, thank you for that update. GST definitely having an impact on these sales. But India's Trade and Economic Partnership Agreement with the European Free Trade Association is slated to come into force today. The EFTA bloc comprises of Switzerland, Iceland, Norway and Liechtenstein. And under this agreement, New Delhi has received an investment commitment of $100 billion in 15 years from the group, while allowing several products such as Swiss watches, chocolates and cut and polished diamonds at lower or zero duties. My colleague Parikshit spoke to the Norway ambassador to India on the trade pact. Listen in to what she had to say.
Well, I said India is the biggest market in the world. It will be the biggest consumer market. We are smaller markets comparatively. So of course, it's a disparity in one way. But all EFTA countries, they have very clear technologies, cutting-edge technologies in different areas. That means that there is complementarity between India and the EFTA countries. And for Norway, they are particularly in the field of energy and green energy in the maritime space.
Now, the US government shut down following disagreements between the Congress and the Trump administration over a funding bill. This report tells you what it means for their economy.
The U.S. government shut down much of its operations on Wednesday as deep partisan divisions prevented Congress and the White House from reaching a funding deal. That sets off what could be a long, grueling standoff that could lead to the loss of thousands of federal jobs. The 15th government shutdown since 1981 commenced hours after the Senate rejected a short-term spending measure that would have kept government operations afloat through November 21st. Democrats opposed the legislation due to Republicans' refusal to attach an extension of health benefits for millions of Americans that are due to expire at the end of the year. Republicans say the issue must be addressed separately. There was no clear path out of the impasse, which agencies warned would halt the release of a closely watched September employment report, slow air travel, suspend scientific research, and withhold pay from U.S. troops. It will also lead to the furlough of 750,000 federal workers at a daily cost of $400 million. Democrats are under pressure from their frustrated supporters to score a rare victory ahead of the 2026 midterm elections that will determine control of Congress for the final 2 years of Trump's term. The healthcare push has given them a chance to unite behind an issue that resonates with voters. Along with the extended health subsidies, Democrats have also sought to ensure that Trump will not be able to undo those changes if they are signed into law.
I don't know, we'll probably have a shutdown.
Trump has refused to spend billions of dollars approved by Congress, prompting some Democrats to question why they should vote for any spending legislation at all. Independent analysts warn the shutdown could last longer than the budget-related closures of the past. Trump and White House officials have threatened to punish Democrats with cuts to government programs and the federal payroll. Last week, Trump's budget director threatened permanent layoffs in the event of a shutdown.
With that, we call time on this edition of Business Lunch. Thank you so much for watching. Midcap Radar on the other side.
Good afternoon. Welcome to Midcap Radar live from the CNBC-TV18 Motilal Oswal studio. I'm Sonal Bhutra. With me, as always, is Vivek Iyer. M&M, that's the stock on our radar, beat street estimates with total September sales coming in at 1 lakh units versus estimates of 90,000 units. My colleague Parikshit spoke to Nalinikant Gulaganta, who is the CEO of Automotive Division at the company, and began by asking about the festive season so far and the sales in the month gone by.
Just from an SUV perspective, domestic 56,233 vehicles is what we sold. That's about 10% year-on-year growth for the whole month. And commercial vehicles quite strong as well. 26,728 vehicles. That's about 18% year-on-year growth for the month of September. Now, as you know, because of GST, there's quite a bit of demand which got bunched up at the post 22nd of the month. So we are also tracking retails on the ground. So what I'm going to talk about is dealer-reported customer retails for the first 9 days of Navratra, starting 22nd onwards till now. Very strong traction so far. SUVs, the dealers are reporting about 60% growth compared to the exact same 9 days of Navratra last year. So it's an apples-to-apples comparison from that perspective. 60% growth in SUVs, and then 70% growth in commercial vehicles relative to what it was in the first 9 days of last year as well. So good start to the festive season, if you ask me. Of course, some of that is pent-up demand, which came through because folks were waiting for the new GST rates to come into effect on 22nd as well. But definitely the GST toll auto reforms have given us fillip to the demand portfolio as well.
Right. I would also like to ask you about how do you start October? One of the things that you have mentioned in your press statement is that the surge in festive demand has placed significant constraints on availability of trailers, and we are working to improve dispatches to our dealer networks within the constraints. So could you give us a sense of the kind of booking pipeline that you're working with, what kind of growth that we could see in dispatches, and how are you looking to address the shortage of trailers?
Yeah, it's a tough one to predict at this point in time. The demand is quite strong. The inquiries and walk-ins have been quite good as well. So it's not necessarily a demand constraint challenge we have. As an industry, we have a trailer shortage, primarily because most of the deliveries started happening post 22nd, so that we are able to take in the right GST into our invoices. So that's created a bit of a challenge in terms of trailers. And we are kind of working through it. One of the things we're doing is increased dispatches through trains is one thing we're doing, and of course working very closely with our logistics partners, including Mahindra Logistics, to solve this problem. So it's something which will play into October as well. So hard to say at Parikshit at this point on what will play out. We're of course super focused on making sure that we are able to dispatch the vehicles and we catch the festive in time. Having said that, of course, the demand will flow into November. We have also see that it's going to be a strong wedding season this time in November. So we're optimistic that we'll continue to get demand going into November as well.
Right. Now, if I were to ask you about the spread, the sales spread between rural and urban, what has been the sentiment like, and what would be the ratio of volumes coming to you?
Yeah, so just dialing back over the last 5 months, rural has been quite strong for us. And I'd say even for the industry, rural has done well. We've been quite happy with our urban performance, even in the last 5 months, although industry has struggled a little bit. But going into the festive, what we have seen early signs is strong demand for Bolero and Bolero Neo, and definitely strong growth for Scorpio and coming as well, which has a rural bend to some extent. So we continue to see that. So definitely that's continuing to play through. But urban demand has certainly come back in terms of walk-ins, in terms of inquiries. We see that urban demand has come back. Certainly has come back on 3XO, which is our compact SUV portfolio, and it's come back in terms of three-door Thar as well. But yeah, we're quite optimistic on the urban side this time going in the festive.
Right. So what would be the current ratio in terms of percentage of sales coming from rural, percentage from urban?
Yeah, so it varies, but normally when we come into festive, there's a little bit of an uptick in rural demand. So we are roughly about 50-50 at this point in time. And that goes back a little bit down on the urban side. But yeah, it's somewhere in the 50-50 going into the festive.
Right. Now, in terms of your top volume drivers in the portfolio, what would those be? The top 4 to 5 vehicles?
Yeah, Stop UN is definitely top of the heap there. Very strong demand, continues to be quite strong for us. And 700 goes right after that, renewed interest with the GST cuts which have happened. 3XO as well now with Revex, which are new variants coming in, we're seeing significant interest there. So all of these models have seen cuts in excess of 1 lakh. If you take 3XO, it goes all the way to 1.5 lakhs, and that's on a CSUV vehicle. So significant demand coming due to that as well. But the interesting trend for us is also folks trading up in variants, right? And it's not like just because the price has gone down, they're actually spending less. They have the same budget, and they're looking to see if they can get a better variant for the same budget they have. So which is an interesting twist.
Outlook on EV sales right now, how much of that is coming in terms of volumes from your total sales?
Yeah, it's a good question. So when we started putting out our BEVs in Q4 last year, we were about like 2 to 3% of our bookings was coming from EVs. Now it's close to 8%. And we have an event coming up in November where we'll be unveiling a new EV as well. So our expectation is we'll stay in the 8 to 10% going forward of our overall bookings, which will come from EV. And then over a period of time, as we add more to the portfolio, new IQ as a platform we launched in August, as that comes in a couple of years, we will then start to go towards the high teens to early 20s.
Okay. Finally, I would like to ask you about, you mentioned a new EV launch coming up. How many total new product launches in this fiscal to keep exciting the market and keeping the demand momentum going?
Yeah, so we are focused on both on ICE and EV. We have an exciting launch coming up in the EV space as well, but we have a strong launch lined up in Q4 for the ICE side as well. So quite excited to bring both to the market. Both are very compelling products, and one will come in Q3, the second one will come in Q4.
Well, that was the management of Mahindra & Mahindra speaking to our colleague Parikshit. Very strong demand is what the company says they are witnessing. We'll now slip into a short break. We'll get you more on the markets and stock-specific action on the other side. Stay tuned. Welcome back to Midcap Radar. Well, all eyes are on the big LG Electronics IPO slated this month. My colleagues Manglam Malu and Shilpa Ranipeta caught up with LG Electronics India Chief Sales Officer Sanjay Chitkara and Chief Accounts Officer Atul Khanna and began by asking them about the rationale behind the timing of the IPO.
See, Diwali is a very important and it's a big season for our industry, and where consumer sentiments are high and our sellouts are very good. So I think that's a right time for this IPO. And talking about our parents, I think it hardly matters where the parents are. Today our focus should be how the Indian subsidiary is doing their business and how they are growing and reinvesting in the market. I think the focus should be on that. And in that sense, LG is creating a benchmark. See, we came in India 28 years ago. And at that time, very few global players could able to recognize the long-term growth potential of India when we started our business. And from last 28 years, we have been working very hard to make consumers' lives good. And I think this IPO is a new future journey for us.
So we've had a lot of MNCs on record say that they're looking to cash out on their India chips to be able to reinvest in their own business back home. I just wanted to understand how that money will be utilized by them, because no money is coming into the company. It's an OFS.
So it's you rightly mentioned, it's a OFS where 15% equity parents are liquidating. And as I have mentioned, LG, we are reinvesting here in India. We are coming up with our third plant. It's in Sri City, Andhra Pradesh, where our $600 million US dollar investment we are doing. And this is not only a conceptual stage. We have already done the groundbreaking ceremony in the month of May. The construction has started, and our plan is that by end of next year, sometime just near to Diwali, we start production there in our first line. And there will be a phase-wise investment. And by 2029, we'll finish this project. Notably, this plant is much bigger than our existing two plants. In size-wise, it would be roughly 3 times bigger. And we are doubling up our capacities. We are investing in new products, new technologies. We are also investing to improve the retail infrastructure in Tier 2, Tier 3 town. Introduction of many new products. We are also scaling up our B2B business. That's our focus area. That is the HVAC, information display panels, e-blackboards. So a lot of exciting things are going on in LG these days.
Your financials are much ahead of your listed peers, whether it's even your return on net worth, even your PAT margin is much better than the industry. So on the face of it, it does look like the IPO is very conservatively priced. What is the sort of rationale behind this, conservative valuation that you're looking at? Is it that you're looking at leaving more value on the table for investors?
So you are very much right that any IPO of any company would depend on market sentiments as well as the strong fundamentals. Our fundamentals are very strong, and it has the IPO price band is being consistently directed and guided by our BRLMs, banking partners, and we are following their guidance and making it a room for our investors also to take some portion of that money into their own hands. So that is a very positive move, and we cannot call it as exactly the very lower times in terms of conservative. But yes, it is, I will say, optimally priced in terms of market sentiments as well as our banker guidance.
Let's talk about your numbers. Sales over the last 3 years have compounded at around 11%. Your margins have seen an improvement. So EBITDA has compounded at over 25 to 28%. Do you believe that these are numbers that can sustain going forward, or will you accelerate the pace of growth?
Let's not forget that we are serving to a structurally massive growing economy.
Right.
It's a 41 billion TAM for our products. If I leave aside the mobile phone business, and it's going with a 14% CAGR growth as per that share report, and it will become 73 billion US dollar market for us. And premiumization is happening. Currently, the India is sitting at a level of say around 17% as per that share report, and it will grow up to 25-27%. And LG has very strongly positioned itself as a very premium brand in India. So we believe that it will definitely, we will be the biggest beneficiary of this premium drive. And let's not forget that the penetration rate of our products in India is very low. A product like microwave, just 4% of household have, and air conditioner just 11%, a washing machine 21%. If we compare the other major economies like China or USA, they are sitting at 80-90% level.
So will you grow faster than the projected market growth?
Definitely. Being a sales leader, my intention is to...
That's your intention. Next to you is the accounts leader as well.
Our endeavor is always to expand our margins, and there are some reasons behind that. That we are expanding, we are doing a lot of investments into structuring our Indian, I would say, local insights, as well as local sourcing, reducing the dependency on overseas buying. We are procuring almost 54% of the components and sub-assemblies in-house.
Right.
As well as our key endeavor is to all produce key components, heart of the product, in our in-house factories.
So we have just a minute to wrap this. So we'll, just do a quick fire here. You have to answer in as little words and as quickly as possible, right? Which one do you believe will be the category that will grow the fastest in your overall portfolio?
Air conditioners.
Air conditioners. Which will be the margin driver for the business in the next 3 years?
Or B2B businesses.
How much will that account for in your overall sales?
Currently it is around 8%, but it will definitely, the contribution will go up.
And services as a proportion of your sales are
2%.
how much? How much will that grow to?
It is definitely 70-80% it will grow.
One new category that you probably are looking to enter that you're not already present in.
See, it's a competition sensitive information. I cannot disclose right now, but there are plans are going on.
One category which you don't believe is ripe for you to enter?
I don't think so, any category.
You shut your mobiles business, so one thought that,
See, that was a not a local decision. We did this in year 2021. And because we wanted to focus on where our strengths are there, that is appliances and TV, and we want to optimize our resources and investments.
A competitor that you are constantly keeping an eye out on?
Our last year performance.
That's a good one.
All right, that's the big upcoming IPO. We'll be watching out for that one. But for that, we'll slip into a short break. When we come back, we'll get into more stock-specific news and the market action as well. Welcome back. 170 points higher on the Nifty as we speak. We have this gain coming in from Bank Nifty, which has surged in how 1.3% there. Continues to be at those levels, and the mid caps are doing well. So there are a lot of stocks which are on our radar. 0.4% higher on that one.
Absolutely right. Mid cap higher by 0.4%. The Nifty Private Banking Index, led by Kotak Bank, led by Axis Bank, ICICI, these are the names that are actually taking the markets higher. And in the broader end of the market, it's the pharma companies that are doing quite well. Some relief or some overhang that's getting lifted post the deal that Pfizer had with that Pfizer announced last evening. And you've seen a bit of a bounce back come about mainly in Sun Pharma. And the other stock that's doing quite well from the broader end of the market is Laurus Labs. Remember, they are a supplier as far as Pfizer is concerned. That stock higher by 3% today. But that is all the time we have on this edition of Mid Cap Radar. More on markets on the other side.
Hello, good afternoon. You've tuned into Your Stocks, coming live from the CNBC-TV18 Motilal Oswal studios. I'm Vinny Motiwala. Thank you so much for tuning in as always. Firstly, happy festivities to all of y'all. Hope y'all have a great festive season as well as Dashera that is there tomorrow as well. But let's start with the markets because that's celebrating the festive season as well, because after 8 days of a decline, we're seeing that the markets are back today in the green. 0.6% of gain is what we're seeing coming in for the Nifty 50 right now. Even the broader end of the markets, right, that is also managing to hold on to that green, so no complaining on that front as well. We're seeing a good move for the Nifty mid cap as well as the small cap in today's trading session. Nifty Bank, that's the one that's doing well and supporting gains as well. 1.25% gain for the Nifty Bank as of now. 55,300 above the mark is what the Nifty Bank is trading at. So no complaining today in terms of that. Broader end of the market's doing well. Advance decline ratio, let's pull that up and see clearly in the favor of advances is what we're looking at versus the decline. Look at the gap between the advances and decline. So good day coming in for the markets. No complaining in terms of the performance from the broader end or even the benchmark indices. But this is a show where we solve all your stock related queries, and we're going to be doing just that with Somil Mehta, Head of Alternate Research, Capital Market Strategy at Mirae Asset Khan, as well as Parthiv Shah, Director at Tracom Stockbrokers. Parthiv as well as Somil, good afternoon and thank you so much for joining us as always. Somil, a quick check in terms of the markets. I want to understand Nifty as well as Nifty Bank. What are we keeping an eye out on now in terms of levels? I think you're on mute, Somil.
Apologies, Vinny. Afternoon to you. Afternoon to everyone. Very exciting time right now. An ending diagonal pattern has broken on the upside, and I'm expecting this bounce to continue till the first target is 24,920. That is my first target, and the next target is 25,000. So these are the two targets for Nifty, and the support, very crucial support, is at 24,580. So this is a very crucial support in the short term. I'm expecting this bounce to continue for the Bank Nifty as well. The target for Bank Nifty is 55,840, and the support is today's low for Bank Nifty, which is going to be very crucial going forward.
Okay, keeping an eye out on those levels over there. Thanks for that, Somil. But let's get started with those stock-related queries. The first query for today is coming from Satish Kumar. He's writing to us from New Delhi. He's holding 50 shares of Sona BLW. This is at a price of 415 rupees per share, so around the buy price right now. The other one is Infibeam Avenues is what they're holding. 3,456 shares at a price of 16 rupees. Again, it's trading around the buy price. Parthiv, good afternoon. What is the prospect of both these stocks? Can they continue to hold this for the long term?
Good afternoon. See, I think firstly talking about Sona BLW, I think it's a very well-run company. The only caveat being that recently, unfortunately, we had the sad demise of the chairman emeritus, Mr. Sanjay Kapoor, post which I think we saw some sort of family feud, which did plague the sentiment. But I'm sure I think the company, which is very professionally run, will find a way out. And more importantly, I think the levels at which the investors invested is after the massive correction that we have seen in this counter. Because I think it was factoring in the Q1 underperformance. There were 4 reasons why the company didn't do well in Q1. One was delayed in some EV-related revenue recognition from some of the prominent European customers. And also there was some demand slowdown in the EV segment in the global customers. Plus, I think China's ban on the heavy rare earth magnets also created some scare for the company. And obviously, the US tariff uncertainty always creates problems for such companies which are into exports. But the good news is that the order book is at all-time high. They're sitting at almost 26,200 crores of order book, which is highest in the history of the company. And especially the EV order share is almost 75%. So we are very confident that going ahead, I think the order book execution will take place. This was one of lumpy quarter. So long-term outlook for this company, according to us, is very good. So hold on to it. I'm sorry, I don't track Infibeam revenues.
Okay, that's the word on Sona BLW on the fundamental front. Somil, on the technical, Sona BLW as well as Infibeam, and Sona BLW, given that it's seen a correction also YTD, how are you looking at it in terms of charts now?
For Sona BLW, it is in the downtrend. below 20 and 40 daily moving average. I don't see this, turning around anytime soon. I'm expecting the previous swing lows to be retested around 380. So that will be my target for Sona BLW. On the upside, the resistance will be around 430 and 440, which is 20 and 40 daily moving average. But the view remains negative. So exit would be my strategy for Sona BLW. Which one was the next stock?
Infibeam Avenue, Somil. It's a very small stock. I don't think everyone tracks it regularly. Infibeam Avenue.
Infibeam. Yes. Okay. So this stock has a little potential, I think. In the short term, in the medium term, both looking all right to me. Should hold on to this stock. Support would be around 15.60. That will be the support, but I'm expecting good rally in this stock till 19 rupees. So hold is my suggestion, but not fresh buying.
Okay, hold as a suggestion, no fresh buying right now there. But let's move on to the next query then for today. We have PN Giri, who's writing to us from Chennai. He is holding 607 shares of Yes Bank. Price is 106 rupees per share, asking whether to remain invested or switch to some other name. Parthiv, your view coming in for Yes Bank, obviously from the levels that they have bought, I think they bought just a long time ago, and now you're seeing that fall that has continued. But what is the view now for Yes Bank? Do you think that we could see some bit more of a recovery?
We need not only the levels, but I think the most important factor is the price at which the gentleman has bought. At that juncture, the equity capital was hovering somewhere around 300 to 400 crores. Currently, the equity capital is almost 6,200 crores. And that is the place where we know that there has been a massive equity dilution for all the existing shareholders because of all the troubles that the bank had gone into. And there was requirement of new capital infusion, getting the confidence back by having people like SBI, Kotak, all chip in. And I think post the dilution, currently, if we see the market cap at levels of around 2021, the market cap is 67,000 crore. Even if the gentleman were to wait to get his price back, which means that he will need to get a market cap of almost 3,35,000 crore. This is the type of market cap when Yes Bank did have during its heydays, but I think looks very, very unlikely that that will happen anytime soon. This is despite the fact that recently SMC, Sumitomo Bank from Japan has taken a stake, and they will do all the right things. And already the bank has turned around, giving good return ratios. But I think it's going to be very difficult to get back to its price. At the best, I think if the viewer has confidence in this bank's long-term prospects, one can cost average, but we prefer investing into other private sector lenders like ICICI Bank or an HDFC Bank or a Kotak Bank for long-term purpose.
Okay. Somil, your view for Yes Bank?
Yes Bank in the very short term, yes, definitely looking good in the very short term. Taken support at 20 daily moving average, high top, high bottom formations. Great setup, an inverted head and shoulder pattern is also forming. So I'll be expecting a target of 23 and 25 levels max. And I'm not suggesting to hold on for a long term or a medium term outlook. A short term trade is all right to me, but not in the medium term or long term.
But what is the level that they can keep an eye out on then in the short term? Because they bought it at around 100 levels.
In the short term, the target is not more than 25. So that's the target I have.
Okay, 25 is the target for short term only, not a long term story, according to Somil on the charts and technicals. Let's move on back to the next query then. This is from Rajat Jain, who's writing to us from New Delhi. He's holding 200 shares of Tata Motors. Price is 100 rupees per share. Wants to know if he can remain invested for the long term for Tata Motors. Parthiv, your view for Tata Motors, obviously we have that division that's coming in now for the CV and PV. The record date has also come as 14th of October. But your view, they bought it at 100. 700 is what the stock is trading at. Should they book part profits or continue to just remain invested?
No, I think he can certainly hold on to this. One, his cost price is abysmally low. He's already sitting on 7 times returns on that. And I think today only it is announced that Tata Motor again regains the second spot in the passenger vehicle segment, which is, I think, a huge achievement, beating likes of Hyundai and M&M. So they are doing fantastically well in the domestic front, especially now that they have new pipeline of products in the EV segment. I think the volume growth should come back very strong. And that is what they've guided for, and all the stimulus that the government has given, especially for the premiumization and the premium car segment. I think that should benefit likes of Tata Motors pretty well, who's focusing on that strategy. Even the JLR, I think, despite all the difficulties in terms of the business due to the tariffs, and more importantly, I think they are under a lot of cost-cutting measures. And the China market is expected to bounce back within the next 6 months. So I believe that JLR should also start contributing going ahead. And I firmly believe that the demerger move by the management, especially segregating the passenger vehicle division and the commercial vehicle division, I think it's a very good move, because that will certainly unlock a lot of value, because we know that generally the CV segment is a lot more attributed with the cyclicality and doesn't come up high premium. So I believe Tata Motors is a good buy here, and also hold on to the position for the long term.
Sure. And Saumil, your view for Tata Motors?
Tata Motors, in the very short term, yes, it has done really well, and I was not expecting Tata Motors to start making high tops, high bottom, but I think from here on, short term definitely gets a target of around 740-45 levels. But in the medium term outlook, it has been making low tops, low bottoms. So I'll be waiting till 700, close above 750. Once we get a close above 750, I think the next level on the upside would be 820.
Okay, keeping an eye out on those levels over there. But on that note, we're going to slip into a very short break, viewers. Don't go anywhere. After the break, we'll still be discussing more stock-related queries. Stay tuned in for that. Welcome back to Your Stocks on CNBC TV18. We still have with us Somil Mehta as well as Parthiv Shah to answer all those doubts. Let's move on to the next query for today. We have Lijo Jose, who's writing to us from Kuwait. And he's holding 250 shares of Bandhan Bank. The price is 500 rupees per share. Wants to know, should he continue to hold, sell, average? Parthiv, what should they be doing with Bandhan Bank, given their buy price is really high?
Very frankly, I think I'm not a big fan of a bank which is predominantly operating in the microfinance segment. And currently, Bandhan Bank, like the rest of the industry peers in the microfinance space, is navigating a very challenging environment. No doubt, I think they're making all the right moves in terms of trying to improve the collection efficiency, trying to improve the asset quality. But this is which tends to plague the valuations for such players. They have done reasonably well in the liability side, but my sense is I think the investors better off switching his money into frontline private sector players like, say, ICICI Bank or HDFC Bank. I think over a longer horizon from these valuations, I think these banks are well positioned to grow the credit growth and also I think do very well for the investors.
And Somil, your view for Bandhan Bank?
Bandhan Bank, not in the medium term, definitely. In the very short term, yes, a good run up, great setup, and ending diagonal patterns been forming. So I'll be expecting this, pattern to target at least 177. But in the medium term outlook, still in the low top, low bottom formation, till the time we do not get a close above 178 levels, I won't be going long in the medium term outlook to long term outlook. In the short term, yes, great setup.
Okay, keeping an eye out on Bandhan Bank over there. Next query for today, we have Adi Narayan, who's writing to us from New Delhi. He's holding 120 shares of Praj Industries. This is at a price of 375 rupees per share. They're making a loss on this one as of now. Wants to know, can he add more shares at the current level or if he should sell at these levels? Parthiv, your view for this one?
Certainly not comfortable to suggest adding more at this juncture because I think if you see last many quarters, the company has not been executing well. There has been massive drop in volume and delayed project executions. There has been increase in on-site expenses due to which the margins have kind of really collapsed. And also the Genex business expenses, have been inching up. So no doubt the company has not had any loss of orders of sort, and the order book is pretty healthy for long-term execution. The management was not very upbeat even for Q2, and only from H2 of this year, they were expecting better growth prospects. So what I would suggest is don't add more to your position. Rather wait till execution in Q3, Q4. If the management, whatever they've guided for, happens, I think then the investor will be able to recoup their cost and also have some upside to exit.
Okay, next query for today, we have Manoj, who's writing to us from Sweden. He's holding 75 shares of Vari Energies. Price is 2,850 rupees per share. Wants to know the prospects of the stock. Somil, what's your view in terms of levels that they should be keeping an eye out on for the long term?
Vari Energy looks good to me in the very short term, in the medium term, both trading about 20 and 40 daily moving average, trading about 200 daily moving average. Very good setup. Hold on to this stock. In the medium term outlook, I'll be expecting a target of at least 3,880. That would be my target. On the downside, the support would be around 200 daily moving average, which is 2,900 levels, close to 2,900 levels, but it's a very good opportunity to buy at this point of time because we've seen a good correction. So buy on decline should be the strategy from here.
Buy on decline should be the strategy from here for the stock right now. But Parthiv, your view for the long term for Vari Energies?
The long-term prospects looks very, very promising, despite the fact that the trail valuations are a little bit on the expensive side. What they're targeting is by FY27 to have a module capacity of almost 26 gigawatt, which is currently at 10 gigawatt. They're also looking to up the cell capacity to 16 gigawatt, which is currently at around 5.4. Even gigawatt and the wafer capacity will go up to 10 gigawatt. So I think the company is working hard in terms of trying to execute the huge order book that they have in the pipeline and also go fully backward integrated. And I think the company is guided for FY26 EBITDA guidance of around 5,000, 6,000 crore, which puts the valuation around 19 times. But based on the prospects of FY27, I think the investor can hold on to the stock and probably expect an upside of 20-25% from them.
Okay, that's the view coming in there for Wadi Energies on the fundamentals. But Somil as well as Parthiv, thank you so much for joining us on the show and, giving us those stock-related answers which everyone has sent in terms of queries. Thank you so much for joining us. But with that, a quick check in terms of what the market is doing. We'll look at it in terms of Nifty, 0.8% of gain for the Nifty 50, 24,800. Look at it in terms of Sensex, also managing to hold on to good gains. Bank Nifty, that's leading the charts, right? 1% gain you can see there, as well as the broader end of the market is too seeing good traction in today's trading session. 0.5% of gains coming in from the broader end of the market as well. So a good day that we'll be ending here this edition of Your Stocks as well. Thank you so much for tuning in, viewers. Remember, you can always send us your queries and you will, I beg your pardon, you will have the email ID of the queries flashing at the top of the screens for you all as well. Do send us your queries. Don't go anywhere. Last hour of trade is still left and you have closing bell up next.
beyond market headlines. To understand the reasons for the day's movers and shakers. And get your portfolio ready for tomorrow. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Taiwanese index, though, continues to do well for itself.
Immediate support for the Nifty is in the zone of 24,400 to 24,330.
Pfizer is going to get a 3-year relief from any tariffs.
So 0.1 to 0.18% on the Nifty Bank, 0.19 on the Nifty.
There is a fair amount of liquidity with domestic institutional investors.
The MPC voted unanimously to keep the policy repo rate unchanged at 5.5%.
So it's a good move to, create adequate demand from the bank side to lend more.
Should we understand there is space for more than one cut?
Inflation has reduced considerably since we met earlier in June.
As far as the large exposure framework is concerned, that continues on an overall systemic level.
M&M, that's the stock on our radar, beats street estimates with total September sales coming in at 1 lakh units versus estimates of 90,000 units.
Well, that is the day so far, and it really did turn out to be sort of decision time at the RBI, right? I mean, the decision has been no change, but that's hardly, I think, the right description. Lots of changes on the regulatory front, and I think the market is taking note. There is, of course, space, as you heard Lata in that recap of the day so far, asking the RBI governor essentially saying, well, there is space which is opened up. But even here and now, there is a fair bit, and all of it seems to be aimed at easing and trying to kickstart growth across a range of these measures. That's going to be the focus here. This is Closing Bell. We're coming to you live from the CNBC-TV18 Motilal Oswal studios. I'm Prashant. With me, Surabhi and Nigel. Guys, hi, afternoon.
Well, afternoon, guys. I guess the governor also decided that it's festive season to give a pataka policy. So let's get on with it. And I haven't seen this kind of a market reaction in a while after a central bank policy. And it's that, that statement, the moment that statement was made, that space has opened up for further policy support, the market took off, and then we had a whole range of regulatory measures, which we'll discuss, which are supposed to make lending a little easier to foreign acquisitions, to infrastructure projects. That seems to have caught the bull's imagination.
And after 8 sessions on Closing Bell, we are set to end in the green. In all probability, we're going to be breaking that losing streak. And it's looking good, actually. Portfolios will be feeling good, going by the breadth of the market. The Nifty Bank is the big leader today. That's crossed the 20 DMA as well, and looking quite good as we speak at the high point of the day. Well, let's tell you actually what we have on the show for you. It's an action-packed hour of trade coming up on Closing Bell. Let's tell you what we have. Good day for trade on the last trade. The Nifty inching closer to around the 24,800 mark, just crossed above that. While it's green across the sectors, the banks leading from the front. The Reserve Bank of India moves to strengthen India's banking sector. Measures unveiled ranging from much anticipated ECL framework to lending norms to aid credit flow. Shares of ICICI, HDFC Bank extend gains. Auto sales for the month of September have started trickling in. The likes of Bajaj, Mahindra & Mahindra, Escorts. We'll assess those figures with our guests in just a bit. And we have 2 new entrants on the bourses today. EPAC Prefab makes a debut with a 10% discount, while Chain Resource Recycling, well, that's listed with a big premium of around 14%, and that's doubled up to around 30% as we speak. So good times after a while. Well, how do you position yourself on the final hour of trade? Mitesh Thakkar joins us on the show from Bonanza Portfolio. Hi, Mitesh. Good afternoon. What do you think? Relief rally, or we have more to go out here? Because now the Nifty is gradually moving to around the 20 DMA. The Nifty Bank has taken off the 20 DMA, and there was a strong case to see a bounce and break that losing streak. But from here, what?
Good afternoon, Nigel. So I was talking about this fact that there is possibility for bounce back to about levels of 24,850, 900. We are practically there. I think getting past 24,900 will give me a lot of comfort that we have a genuine reversal in place. As of now, I think if people have bought at lower levels, these are the levels to take some profits off. Wait and see if there's strength to get past 24,900. But the good part is the Bank Nifty. The Bank Nifty has managed to clear 55,150, which was the immediate supply pivot, and now can even get up to about 55,650 to about 55,700. So there's space over there, about 300, 350 points on board, and that could propel the Nifty. But I'm not sure whether we'll get past 24,900 immediately. So not taking an index long trade, but we have some financial names on the buying side. So Kotak Bank is a buy. Keep a stop at 2049. Look for targets of around 2105. And the other one is Shriram Finance. I think that's also having a very good price volume action. So buy here with a stop at about 632 for targets of or just below 632 and a target of around 680.
Yeah, I mean, so much of excitement around Shriram Finance. There's the RBI policy, that's one part of it. But then all this chatter around the possibility of a large Japanese financial conglomerate, Mitsubishi, whether they're interested or not. Of course, the company denied it. But anyway, it's gotten people really excited today. Let's actually kickstart with the big story of the hour. That is the RBI announcing a whole host of measures aimed at enhancing the resilience and competitiveness of India's banking sector. Ritu is here with more details. Ritu, 22. When he said 22 measures, you and I were, almost gasping. But tell us which are the big highlights.
Well, yes, Surabhi, never before, in more than 10, 15 years of covering this policy, we heard of 20 reforms or more being announced in a single policy. But that said, these are big bang reforms that will have some far-reaching consequences and a clear U-turn in the regulatory stance from what we've seen in the previous few regimes. Starting with, let's look at, for instance, expected credit loss is now going to be implemented a little later than expected, only from April of 2027. And banks will be given a 5-year glide path until 2031 to meet the additional capital requirements to make higher provisions. Also, again, to ease the overall capital requirement, the risk weights for lending to MSMEs and for residential home loans will also be eased. More details on this important one is still awaited. This was a draft circular released last year, which had caused a lot of havoc when it comes to subsidiaries of banks like HDB Financial and so on, where RBI had said you cannot have overlapping business between the group entity and, the bank. That has now been scrapped altogether. Apart from this, a whole host of reforms when it comes to lending for capital markets. For instance, for the very first time ever, and this is perhaps one of the most significant reforms, banks will now be allowed to finance acquisitions, paving way for more buyouts and deals being financed by banks. This will also allow, of course, banks to wrestle back some of the market share from other financial entities, banks, NBFCs and private equity players that had come into this space. RBI has also removed entirely the ceiling on lending against debt securities. Lending against shares has been increased 5 times from 20 lakhs to 1 crore for IPO financing, from 10 lakh to 25 lakh per person. Apart from this, there was this proposal in 2016 which came to being in phases, where if a specified borrower had more than 10,000 crores in bank borrowings, they were discouraged from borrowing more from banks and rather meet their requirements through the capital markets. That has been scrapped altogether now. To address the concentration risk, the large exposure framework for bank individual level remains, but on a larger systemic level, RBI is going to look at other macro-prudential tools. It has not outlined what specifically, and to reduce the cost of infrastructure financing by NBFCs, risk weights for NBFC lending to them will be reduced for operational, high-quality projects.
Okay, Ritu, thank you very much for that. That's a quick run through. There are more, but we want to highlight the most important, most consequential in that sense. Harshvardhan is Senior Advisor at Bain Company, is with us. Abhijit Devanji is founder of NeoStrat Advisors. Gentlemen, good afternoon. Great to have both of you here. Prashant this side. To make this interaction as useful for viewers as possible, maybe we'll ask both of you one impact of one each, and we've got about 4 or 5 that we want to really address out of what Ritu also, so, shortening that list even further. Banks now allowed to do M&A financing, right? I think they've been out of it for the last, 10, 12, 13 years. They can do it now. How big is this? Abhijit, if I can start by asking you that, will this spark so far, as things stand right now, a buyer or seller who had to finance this via private credit, had to go outside, dollar-denominated debt, higher interest rates, etc., etc. But local banks can do this now. How significant is this, and can banks really unleash a wave of M&A? Your thoughts?
It's a great opportunity for banks. I don't know why there was a stigma of not being able to fund acquisitions earlier. And I think RBI was a little worried that sometimes it ends up building a bubble. But I think what RBI has realized, it seems to realize that we're missing out on a big opportunity for banks. Now, where lies the opportunity? One is that acquisitive corporates will now be able to access rupee funds, which are generally cheaper. Now, in general, RBI for banks made sure that we were only doing vanilla financing, and hence vanilla rates were charged. However, now with the opening up of M&A financing, various kind of structured financing products will be available. Like leverage buyouts will now be possible in India. What is a leverage buyout? Fundamentally, you're saying that you will fund the acquisition out of the cash flows of the acquirer business by setting up some intermittent financing vehicle. Now, those kind of things will be allowed by RBI, which earlier was done by either overseas investors or private credit was doing it in some form. But now you will find that banks are going to be able to do it. The other thing is private equity firms, which generally were leveraging from outside of the country and putting it as money as India and frankly taking back significant returns. Now, this is a high financing business, and that is what our banks will need to understand. The problem really is, are we going to be able to price this credit right? And that is where I think the expertise of a banker will come into play, because this is normally 15 to 18% related financing activity, which our banks are not used to because the kind of credit we get. So I think if you're able to finance it right, this is a great opportunity for Indian banks.
Okay, Abhisar and Harsh, thanks so much for joining in. Harsh, comment on this. Maybe you can add a point to what Abhisar said on this particular issue, and then moving to the next one as well, where the RBI, and I'm going back to the press release, just to quote, where they're talking about withdrawing the 2016 framework, which had disincentivized lending to specified borrowers, which had a system-wide limit of about 10,000 crores. So what does the removal of this restriction do? I mean, do you immediately see an impact on credit offtake on the corporate side?
So on the first one on M&A, I think it's an excellent step. To Abhisar's point, hi Abhisar, that I think it was a vestige of the 1980s, 1990s thinking that banks somehow should not get into this risky business and so on. We need an efficient market for corporate control. We should facilitate greater merger and acquisition so that our corporates become more efficient. And you can't do that unless funding is available. And we had extraordinarily constrained funding because the largest provider of credit were kept outside of it. So I'm saying this is an excellent step. Obviously, we'll have to wait for the detailed guidelines on this. But I think this is a very, very good step. The other point that Abhisar mentioned, I'll take it forward, that in many sectors we allow 100% foreign ownership. But if a foreign company has to buy a domestic entity out, it cannot leverage locally. Same with the private equity. So all of those concepts hopefully would go away. And I think we'll create a much more efficient market for corporate control. On the second part about the large exposure, I think that time there was systemic concern about NPAs and so on. And it was believed that you can take away these large borrowers from banking sector and move them to bond markets, for example. I think what we have probably realized is bond market, while has grown, it's very skewed. You have to be AA and above to be able to raise significant amount of money. Even single A's find it hard to raise money. And for them, there is no other choice. Anybody rated single A and below is to go back to banking sector. And so I think both these are extremely good measures. I think what they do indirectly is move the burden from regulations to governance at banks. Because to Abhisar's point about high finance and high risk and high reward, the burden that to that extent increases on the boards and the various board committees of the banks to ensure that the consequence of these regulatory changes are managed properly within the banks.
Just just to come in on the earlier point, right, which is M&A financing. This was allowed pre-2013 or something, right?
No, it was in my mind never allowed freely.
Abhisar?
Earlier than that. I think it was much earlier than that.
Much earlier.
Yeah, I think, and it was allowed in a very restricted case of things. I think.
My question is, even when it was allowed, there was not very much participation by Indian banks, right? So will that happen now? That's my.
I think, if I may, I think that those were the times when we were dominated by public sector banks. We were probably averse to this. Now we have large private banks who would be far more open and willing to do this. My expectation is.
Okay. Now just to move it along, the overlap has also been in terms of that. So banks which could not do some activity, they used to do it through subsidiaries, NBFCs, etc. And now RBI is saying, well, we don't need restrictions in terms of that, right? We'll defer to bank boards to take appropriate decisions in that sense. So that's a welcome move. My question is, in terms of practical implications, are there any implication? Does this just take away uncertainty? There are instances where in terms of there's a housing finance subsidiary of a PSU Bank. I mean, every once a couple of years, there used to be buzz whether they'll have to sell it. All that goes away because this is already happening. So does this do anything incrementally? Harsh and Abhizar, go on.
Yeah, so I think one thing is that it obviously takes away uncertainty, because if you had a subsidiary that was doing a business that departmentally could be done by the bank, then there were regulatory restrictions. This came out of the new banking licensing regime, if you remember 2013-14. I think now it will be left to the bank's board as a part of its governance to decide whether that is allowed, that should be continued through a subsidiary. I think the original concern of RBI, if I were to guess, it was some sort of regulatory arbitrage. So banks would run some businesses through subsidiaries and some directly in order to benefit from regulatory differences. I think as the differences between largely NBFCs and banks are being taken away, the perceived arbitrage being taken away, this regulation is beginning to become redundant. So I think this is the right step. Let the boards of the banks decide what they want to do in the bank and what they want to do in the subsidiary.
Abhizar, you want to add something?
No. So I think very clearly, RBI's view has always been, and now they've kind of unshackled the banks to enable that, is to say that lending businesses should be done through one entity. Ultimately, we'll get to that. Though, of course, the single point of presence remains. We have exceptions, right? There's HDFC and HDB Finance, for example. Now, some stage people are going to say that why do you need so many multiple legal entities just to do the same business? However, if regulatorily you require a separate entity for an insurance company or asset management company or anything else, that is what I think should ultimately be permitted. So what we are saying, as Harsh rightly said, that let's give the boards the flexibility to manage businesses that are available for a regulated entity to do, but let's try and remove the arbitrage and get it done in one entity. That's one. And the second thing is that I think that the regulatory oversight will only increase, because now with the boards being more empowered and managements being more empowered to encourage and do all kinds of businesses in whichever way they want to do, the supervision and the regulation, I think, will quadruple, and which it should.
Gentlemen, also want to move and talk about some of the measures, greater flexibility to lend against shares, higher limits on IPO financing. I thought that was very interesting. But before I get to the capital market related stuff, just to complete this point, the first two measures that we've discussed, allowing Indian banks to finance acquisitions and the large borrower framework as well. Now, while this is a great enabling step, does it lead to a boost in corporate credit growth in the near term, in the visible horizon? Yes, no, maybe, Abhizar?
I think credit growth will depend on the optimism that is there in India.
Yeah.
So if a Chinese manufacturing is preferred, then the Chinese manufacturer shall manufacture and India shall not build capacity.
Yeah.
But I think if we have the ability of opening things out, what the governor has done now is to say finance is available. Now we have to make projects more viable. So for infrastructure, for example, NAPFID has now said that there is partial credit enhancement available, opens up the whole pensions and the insurance sector money available. Now let's make the projects more viable. So I think corporate credit will be driven by what are more viable projects. And the boards obviously will have much more onerous responsibility of making sure that they only fund viable stuff.
And Harsh, let me add to this. There's also the measure on a bigger boost to NBFCs, specific NBFCs, which are into infrastructure financing.
Only operating assets, though.
Yeah. So again, what are the implications? And just because the framework has been eased, does it necessarily mean that we start seeing large ticket infra projects and credit growth take off around infra?
There, I'll wait for the detailed guidelines, because what they have said is operating assets, not new assets. So what it might mean is that people who are funding, running power stations and so on, credit to them through NBFCs would be supported. That's my understanding. I could be. It's not saying for new infrastructure.
For new assets. It says operational assets.
Maybe,
yes.
Risk
there are assets that are already operational, and I don't think for a running operational asset there was ever a credit issue. Because if they're running well, their credit was always available. So we'll have to wait and see the details here.
We'll have to see the definition, right? But point is, if you have to, if risk weight is lower, then maybe the impact is not on, maybe on return ratios, etc. There's a bit of a bump.
It might little bit boost growth to those operating assets, but I don't think fundamentally change. This goes back to Surabhi's earlier question. Even this acquisition, I don't think in the immediate term going to do anything to get credit growth.
Yeah.
Because number one, it will take banks some time to digest this and develop capabilities of doing this.
Correct. Absolutely.
And therefore, I think for the next year and a half, I don't see particular impact on this on industrial credit growth or business credit growth.
The other point is this current account bit, right? Where they're, I think, easing some stuff. Abhizar, did you see that point? Point number 10, basically.
So earlier there was this restriction that was put on for current accounts to say that unless you are 10% of a borrower, you should not be opening the current accounts for the same customers. I think the intent at that time was that normally banks took money from, corporates took money from PSU banks, for example, and did all their banking or the flow of transactions to another bank for two reasons. One is that the bank was slightly more efficient in terms of transaction banking. And two, of course, in a way it acted as a non-lien because the bank which lent the money did not see the flows happening through their own bank account. That is the reason why RBI said we will introduce this particular regulation. However, now what RBI says is let it be free flow. And I think which is the right thing to do because this was causing a lot of hindrance to corporate credit.
So the big, for our viewers, the big beneficiaries are essentially, your HDFC banks, maybe even something like a Yes Bank. It's the private guys essentially who are more efficient.
Yes, who are more efficient. And I think so be it. If they are more efficient, should they actually be getting the benefit of more transaction banking? They should. That will encourage some of our other banks, which are traditionally good lenders, to actually build more efficient systems in terms of transaction banking.
Okay, gentlemen, just quickly getting to the last two. I'll leave my most interesting one, the IPO bit, for the end. But before that, Basel III, are we ready? Because the implementation is now from the 1st of April 2027. So what could be the takeaways in terms of just the need for capital? Harsh?
Yeah, so I think for India, where most banks are on standardized approach, the only change would be the reduced risk weights. I think in Europe, it's making a change to banks which are on internal rating-based approach because there you could substantially reduce capital requirement. My own sense is in India, the impact is going to be somewhat marginal, depending on how much risk weights are reduced for the two segments that RBI has talked about. Beyond that, I don't see because everybody still is in a standardized approach and will remain so. So I think unless we have some brave banks moving to internal rating-based approach and RBI kind of countenances that, I don't see a very sizable impact of that.
Okay. All right, and Abhizar, quick last word with you. Very quick, 30 seconds. We've gone a little over on the discussion, but it is a big one and an interesting one. We keep discussing what's happening in the IPO market and how many 74 or 75 so far this year. Very interesting that now the limits have gone up. From 10 to I think 25 lakhs in terms of IPO financing, and borrowing against shares has gone up to 1 CR. So just quickly, your thoughts on this.
I think because our equity markets are growing the way they're growing, I think RBI possibly sees the ability to actually fund and help people leverage to get into actual buying of stocks rather than playing in the options market. So I think this is the surrogate lending is now going to come on book lending, which is good in my view.
All right, we'll leave it there, gentlemen. Quick, sorry to have rushed both of you along, but and we'll have you back for a longer chat. Thanks very much, Harsh and Abhizar, for joining us. But really useful to go point by point and get both of your views. Really veterans who've seen the space over the years. We'll take a quick commercial break here. We're going to come back. Aman Chauhan of Abacus Asset Managers is also going to be with us. There was a story flashing on Niva Bupa, and Yash will be joining us for that as well. Stay tuned.
Welcome back. Nifty up 240 points. Bottom of your screen, I think we should get CAMS, that stock up for you on the screen. They're going to be considering a stock split. So that explains why that one has spiked up in trade. It'll shortly be getting flashed for you. And the other one is NMDC. Well, they have delivered, announced their September numbers. And out there, in fact, we have a 10% volume growth on a low base. So NMDC as well, Street was sensing that. Last month or so, the stock is up, I think, 9% or thereabouts. So Street was sensing that. 10% growth, Street will take that. And if I got it correct, I think we had Ashok Leyland's numbers that were flashing for you on the screen. That should come up at some point of time. Aman Chavan, fund manager at Abacus Asset Manager, joins us on the show. Hi, Aman. Good afternoon. Good to see you in. How are you feeling about the markets? Well, some of the investors are getting a little bit, worried. Last 1 year, no returns. Many stocks down 10, 20, 30% odd. Good time to buy?
I think the reason behind last year no return and the correction that we have seen in the recent months has been the global uncertainty. That has not changed as such. So I'm not sure whether this is the right time to buy or no. Markets can drift lower if this uncertainty stays, because then monthly export numbers are getting impacted for various sectors, right? And that's not something that is what market is going to like. So while domestically things are getting better, mostly the festive demand, this festive season this year will be much better than what it was in the previous years. But till the time the global uncertainty doesn't go away, I don't think markets are going to rush in a hurry.
Okay, Aman, you took the bails off there. I thought you were going to say, yes, it's a good time to buy. But as you're highlighting, the globe is still in a bit of a flux. And that's why, you'll have to watch out on that front. But since domestic themes are something that come to mind, and there are a lot of measures being taken on ground, monetary, fiscal measures as well. And some of these quarterly, monthly updates are not looking too bad. So the street will take heart from that fact and hope that second half of the year we see that earnings recovery. Give us a couple of themes that you like.
So that's true. Second half is definitely going to be better, and not just versus the first half, even versus the last year. So clearly, discretionary consumption is something that is going to do well. We expect demand also to pick up because of various capex as well as the government infra spending, which is back on track. So that should also tend to do well. So that two segments are doing well. We are also pretty positive on metals, though it's not just local demand globally, because the dollar is weak. The way precious metals are moving, we are feeling that the rub effect of that will be on other base metals also. That could also be a good theme to look at. So broadly, this is what we are looking at. Besides that, financials continue to be something that we are positive on. 2Q might be the last quarter where we'll see margin pressure. From 3Q onwards, the NIM compression or the margin pressure will start to wane off. And with the second half growth picking up, even the credit demand should pick up. So that's broadly the theme that we are looking at the current junction.
Aman, did you like anything? And broadly the space, right? Apparels. And that's an export story, though. Look at something like a Gokuldas, 1250 to 700, completely smashed. Just using that as an example. And of course, it's been on the back of these tariffs, and we were supposed to greatly benefit by lower tariffs. It's worked out the exact opposite way. How does one work through some of this in this space? I mean, if you like, or you have a view from a longer term perspective.
Yeah. So clearly, textile is one of the worst hit sectors because of the tariff. And the earlier assumption was India's tariff will be relatively better than the peer group, say that Philippines, Taiwan, Bangladesh, Pakistan, the other competing nations on the textile front. But as things stand today, things have reversed. We are not expecting this 50% tariffs to stay for long, that is for sure. But then whatever the number is, market is sensing that number could be similar or maybe even higher than the peer group. And if that happens, then India loses the competitive advantage. And maybe that is a bit reflecting in the way INR has also depreciated in the recent months. So keeping that in mind, I don't think anybody will be in a hurry to get into this sector per se, till there's complete clarity as to what the tariffs are going to be. And if it is a competitive tariff, then maybe some of the lost ground will be regained. Otherwise, stocks can languish for long, because US is by far the largest market, and not just largest, the most profitable market for these players. And if things there are not looking clear, I don't think investors will be in any hurry to get into these names.
Aman, hi. Great to have you on this afternoon. Season's greetings, festive greetings to you and your team, and to all at home. Now, since we're talking GST and consumption, I wanted to get your sense on autos. The kind of improvement that we're seeing in the sales numbers, very heartening. I mean, at least the September data. The question is this sustainable? Is this the start of a bigger uptrend, particularly in, say, passenger vehicles or even commercial vehicles for that matter? What's your sense? Do you like anything here, auto or the entire chain, maybe auto components? How are you thinking about it?
So clearly, yeah, 10% is a large cut that has come in, and there has been a lot of push-up demand as well as staggered demand that has come in from the auto space. So for the next few months, numbers are going to be much better than what we initially thought pre-GST. Post which I think the demand should taper back to the normal thing. Last few years, demand has been very soft, low single digit. We expect that to pick up, maybe to a high single digit kind of thing. So from that perspective, yes, the sector is looking good. It's overall the feel-good factor, right? It's not just the GST cut. So that is the trigger. But if the economy has to do well, then this consumption discretionary segment should also do well. And autos definitely would benefit out of that.
All right. Aman, shorter chat today, had a bunch of more questions. Thanks very much for joining us. Have a good holiday tomorrow, and festive greetings to you and your team and your family. Really appreciate you coming on, as always. Now, a bunch of stories we want to address as well. By the way, past the 3 p.m. mark, so just under 30 minutes to go for close. Niva Bupa, another company where potentially there is a large block which is coming. Yash is here with quick details. Yash.
Well, that's correct. A large block expected as far as Niva Bupa Health Insurance is concerned. What we've been given to understand from our sources is that the private equity player, that is True North subsidiary or True North unit, which is called Fettle Tone, is expected to sell up to 5% stake which it holds in Niva Bupa Health Insurance. The total stake as of the latest shareholding which Fettleton holds is about 8%, out of which the company is looking to sell up to 5%. What we've been given to understand from our sources is that bankers have already been approached as far as managing this particular transaction of a stake sale of 5% in Niva Bupa is concerned. This, according to our sources, could happen through a block deal itself, and the timeline that has been estimated to us by our sources is that it could happen as soon as in the month of November, that is next month. Roadshows, of course, would precede that. So a big block in Niva Bupa by private equity player Fettleton is what is expected.
Okay, all right. This is True North. The fund is True North. And this is Fettleton is a subsidiary in which this stake lies. Thanks very much, Yash, for that. So a long line of early investors, promoters, stake sales, and one more to the list. We take a break. We're back. As always, we get you a check on what's happening in dealing rooms. D Street Chatter with Nimesh coming up, and some technical trading ideas as well. Stay tuned.
Welcome back. You're tuned in to Closing Bell, and we are coming to you live from the CNBC-TV18 Motilal Oswal newsroom. Well, let's hop across to Hormuz. He's here. He's putting the spotlight on all the movers of the market. Hormuz, take it away.
It's been ages since you could say that today's day belongs to the index, so can't not talk about some movers on the index today. And one stock that has been making headlines almost every single day has been Tata Motors. It's up almost 5.5% now, and we've had close to 2.5 crore shares that have already traded today. Multiple announcements that have come in with regards to this. The 20-day average here being 90 lakh shares, and of course Shriram Finance, the clarification that the management issued, Morgan Stanley too remains bullish on the stock. Here too the stock is up around 5.5%. 13 lakh shares traded here compared to a 20-day average of 3.5 lakh shares. Now when you go down to the broader markets, there is a stock called Dynacon Systems. The stock has gone up 15% in today's session, was up 3% yesterday as well, taking the 2-day tally to 18%. It snapped a 7-day losing streak in yesterday's trading session, and today's move has come on volumes that are the highest since March of last year. So almost 18 months on, we've seen volumes of such kind, and we have had 17 lakh shares that have been traded already on the stock compared to a 20-day average of just over 17,000 shares. And as a result of this move, the stock has broken above its 50-day moving average, which was at 978. The next level on the upside is the 100-day moving average, which comes at 1,036. And October generally is a positive month for the stock. In the last 12 years, the stock has gained in 10 Octobers as per what the historical data suggests. Suryodaya Small Finance Bank, the stock has been buzzing all through the morning, and at one point the stock was up 20%, and at intraday gain was the biggest since September of 21. The third straight day of gains today, and today's volumes are also the highest on record for the stock. We've had close to 2 crore shares that have been traded today. The 20-day average is only a lakh, and that's the kind of volumes you've seen on Suryodaya Small Finance Bank. But gross underperformer has still halved from its IPO price of 305 rupees. And lastly, Netweb Technologies, I wanted to mention about this yesterday as well. The stock is now up 10%, slightly off the highs of the day, extending its gains. September was the best month on record for the stock. The stock was up 65% in that month, and today's volumes are the highest since July of last year. We had more than 1 crore shares that have already been traded today compared to a 20-day average of just over 35 lakh shares. The stock listed in July of 23, a 500 rupee IPO price, and based on today's price, the stock is up 8x from those levels.
Okay, all right. Hormuz, thanks very much. Always an interesting set of stocks with Hormuz around this time. Well, time now for our D Street Chatter segment. Nimish is here with what he's picking up from dealing rooms. Nimish, afternoon.
Hi, Prashant. Afternoon. So, a good start to the new series, and that's what typically a series does. Extremely oversold levels and extreme short positions, and we've seen a bit of a short covering rally in today's market. It's largely led by financials, thanks to the RBI policy. A lot of changes there. So private banks are well bid, NBFCs and housing finance companies are well bid as well from large institutions. So after a long time, some bit of interest seems to be back in the financial space after the RBI policy. The other space which has done a bit of short covering is the rate sensitive. So real estate names have done well today. All these real estate names have corrected 20-30% from the recent peaks, and you're seeing a bit of a covering rally in that space. Technically, 24,950 is a level to watch. If that gets taken out on the upside, you can potentially see further short covering rally in the days to come. So clearly, a big move led by short covering, but a bit of buying as well as emerge in the financial stocks after the RBI policy today.
Oh yeah, I mean the policy has definitely inspired the bulls going into the the holiday, the Sera holiday. What about stocks, Nimesh? What's on the radar?
Well, so the first stock on my list is Anantraj. That's been buzzing in the last couple of weeks. It's flat today, but in general, in the last 2 weeks, if you see the chart, it's actually outperformed, and big volumes as well. The company was on a roadshow in the last couple of weeks, though non-deal. But now I understand the company might raise funds via QIP very soon. So that's the first stock and the trigger in Anantraj. Second stock is Nykaa. That's been buzzing in trade today on back of very strong buying. And interestingly, there is a Morgan Stanley note as well. They put out a tactical buy, and they expect a very strong Q2 for Nykaa. So that's the reason why Nykaa is buzzing in trade. The third name is J&K Bank. Again, stock is flat today, but in the last couple of days, I understand one large HNI investor has started accumulating the stock again. Relatively, it looks cheap on valuations, but some bit of trigger there in terms of HNI buying back in J&K Bank. And the last is Sammaan Capital. There is a board meeting scheduled tomorrow for fundraising. I understand a very large sovereign fund is going to put in money via preferential issue, and that may trigger an open offer as well. So you've seen a big outperformance in Sammaan in the last 1 week, 10 days, but looks like the big deal is on the cards with the board meeting scheduled tomorrow.
Anantraj, Nykaa, J&K Bank and Saman Capital. So a couple of sort of fundraisers, deals very soon, and others on the radar. Nimesh, thanks very much for that. Well, let's just run you through what's happening on the F&O side of things as well. So I think Nigel has walked across with that data exactly. Nigel, over to you.
Well, that's right. You know, the Nifty Bank are doing well, but in terms of levels that you're looking at, you pull up the Nifty and the 20 DMA, that's the next level of resistance, close to around 100 points away from current levels. So that's the line in the sand you're looking at on the upside. The bears will want to defend that mark. On the Nifty Bank, it's crossed the 20 DMA. Now it's on its way towards the 100 DMA. So that's very, very close right now. You'll want it to take out that 100 DMA. So that's another important mark. On, in today's trading session, look at the options data. As we mentioned earlier today, the FI is aggressively net short, 94% of the positions on the short side. And after a while, we're seeing put writing that's taken over. Just take a look at the way those put premiums have collapsed. Both on the 24,800, 24,700 put as well. Premiums down anything between 70 to around 80% in today's trade. So the bulls will feel that they've managed to defend that lower level. Now they'll want the, to drive home the advantage and get closer to around the 25,000 mark. Just looking at two stocks, keeping it snappy out here, we have a possible stock that's coming out of the F&O ban. Very, very close right now. It was at around 82%. It needs to breach the 80%. Saman Capital, big board meet tomorrow. That could be a stock that could make its way out of the F&O ban. So it's very, very close on that one. But the one that's definitely coming into the F&O ban, at least as of the last count, is RBI Bank. Massive open interest built up. That looks set to make its way back into the F&O ban, when the file comes out today. And just take a look at the intraday chart. The stock again has got bought on the dip. It was down 4-5% earlier. At around 260, it's recovered to the highs of the day as well. So keep an eye out on that one, likely to move into the F&O ban. Back to you.
All right, Nigel, thanks very much for that. So that's the individual names in focus as well. 220 points higher on the Nifty, so 24,830. Mitesh is with us with what to do today for a reverse trade day after tomorrow's market holiday. Mitesh, what do you have?
So on the stock side, BTST on ICICI GI, that's ICICI General Insurance Company, keep a stop at about 1894, look for a target of 1925, and HDFC Bank is the other one. BTST here with the stop at about 959 for a target of 974.
Okay, all right. Two names from Mitesh. Mitesh, thanks very much. The flash at the bottom of the screen, the cabinet has approved a hike in dearness allowance for government employees. I think it's a 3% hike. And typically, there are some arrears, so this would be effective from an earlier date, which we should be able to get to you. I think it was 55%, it's moved to about 58% now, and some other decisions as well. Shares of Sun TV are higher in trade, and, Elara is seeing more upside, 40-50% up from here. Vinny is here with the rationale and what the note says. Vinny, over to you.
Hi, yes, so we have Sun TV that's in focus. Obviously, yesterday we had reported saying that sources were saying that Diageo has put RCB up for sale and that there are potential buyers coming in. Valuation was at around $2 billion. Now, that is a big valuation number that's coming. What Elara is highlighting, that given this deal that may go through for RCB, that actually turns out to be a big re-rating that we could see coming in for Sun TV. Why? Because obviously they have Sunrisers Hyderabad. Now obviously Sunrisers Hyderabad as of now contributes around 45% of the market cap. This is according to Elara, and while RCB is just 7 to 8% of United Spirits market cap as of now. Now, assuming that, there is a 20% discount for SRH versus the valuation that is taken for RCB, the $2 billion valuation, still the valuation for Sunrisers Hyderabad would come in at around $1.5 to $1.6 billion. And why is RCB at a higher valuation? Because they have a higher brand presence versus in terms of the branding and marketing that they have is much higher versus other teams. So valuation for Sunrisers would be at around a 20% discount. Still, a re-rating that could turn out to be for Sunrisers Hyderabad in turn for this. Currently, when you're looking at it, valuation contribution that comes in is at around 8,700 crores. Currently would go up now to 13,000 crores. That's the word coming in from Elara. And obviously a potential upside in terms of the market price that they see coming in for the stock price would be still 40 to 50% upside from these current levels as well.
Okay. By the way, volumes are the highest in the last 4 years on Sun TV. Highest since May of 2021. So this is not, the 16% pop is not back it's not on thin volumes at all. It's a very, very large volume, some 1.1 crore shares or so on the NSE.
Just 1 point, 23,000 crores of market cap. You have cash of 7.5 to 8,000 crores. I went through the annual report and got that number out. If you even value this IPL franchise at around 9-10,000 crores, or you're getting the core business at around 5,500 crores for a company that's doing a core EBITDA of around 2,000 crores. So valuation argument has been there. That got a little bit stronger. We'll have to see what plays out from here. But just, putting in the numbers together, the core valuation, made it a little bit attractive. So we'll have to see, first of all, what RCB gets sold at and what Sun TV does from here on.
Yeah, absolutely. Well, we want to focus on the other story, right, which is insurance. And this is important because insurers looks like they're effecting a very large cut in distribution, commissions. Much larger than what I think we thought. This is all source-based information. Yash is back with us with exactly that. Yash, take it away.
Well, Prashant, just last week we had reported, quoting sources, that general as well as health insurance companies together were discussing how to pass on the additional cost which their books were incurring because of the GST changes. At that time, the indication which was given to us by our sources in the industry is that the industry was looking to pass on about 5 to 8% of the cost to distributors like banks, like agents, like web aggregators, case in point Policy Bazaar. Now, what we've been given to understand from our sources is that the final cut which has been passed on to distributors is much larger than what was anticipated. As I said, what we were being indicated was about a 5 to 8% cut. But what has been passed on to distributors is a 18% cut in commission. What we've been given to understand is that the letters have been sent to various distributors communicating this particular pass on of the cost on their books. We've also accessed these letters which have been sent to distributors. And according to that, with an example, it's been specified very clearly that if we are paying you 1,000 rupees as commission on the sale of a particular product, now we would be paying you about 847 rupees as commission on the sale of same product, which means a reduction of about 18% when it comes to commissions being paid by general and health insurance companies to these distributors. Additionally to that, what we've been given to understand is that life insurance companies are also very close to making a decision on passing on the cost to distributors. So that will be additional, a cost burden which would come on the distributors. And, just on the day GST changes were announced, Yashish Dahya of Policy Bazaar was on our channel, and he had indicated that about 20% of the revenue for Policy Bazaar and 60% of the value comes from health insurance business. This is the same business where the letters for the cut in commission of about 18% has already been sent to distributors.
And that explains why the stock, PB Fintech, it's down about 8-9% in the last 1 month, as the market has been digesting this possibility, which has now become a reality, that perhaps this burden of zero GST, that has to be borne by both the insurer as well as the insurance distributor, in this case, PB Fintech. Yash, got that. Thanks very much for getting us that story. And even now, the stock has reacted quite negatively, as Yash has put out the specifics of the magnitude of these cuts. Let's take a quick break, come back on the other side, and we'll get you more on the markets in just a bit. Welcome back. We are in the last leg of today's trading action. I think we've got Gurmeet with us for some quick thoughts. Gurmeet, hi. Festive greetings to you. This one's going to be a quick fire. We've had to digest so much, starting with the RBI policy. First, on banks and NBFCs, that's been the big trade of the day. Any thoughts, any new purchase decisions you may want to make because of what the RBI said today?
So, Sylvie, you will see, obviously, the limit have gone up on loan against shares. The group level cap has gone from 10,000 crores. So it will enhance corporate credit, includes more securities against which you can lend. So overall positive, both on yield and on credit demand. Also, we are seeing a lot of heightened interest by the Japanese firms like Mitsubishi and Sumitomo. Mitsubishi is now in talks, talking of Shriram. I think there were news of RBL Bank doing a fundraise of 3,500 crore, which could mean an equity stake of more than 20%. So you will see a lot of serious money now chasing NBFCs, and I think even MFIs are coming back after a bit of a slump. So it's looking very good for NBFCs and tier 2 banks. And we've added RBL Bank, we've increased weightage to Bajaj Finance, we have Poonawalla, FinCorp and Chola in the portfolio.
Okay, all right. Quick word, Gurmeet. I remember you all were very bullish on CSK earlier, and you all got it much. I mean, I think at very depressed valuations. Now, suddenly hope that there's going to be some monetization of an IPL franchise, RCB. How do you read this, and what are you bullish on right now?
So, Nigel, we're evaluating United Spirits if the valuation goes through. Also, if you see their prestige and above segment has been growing volume-wise at 11% and values-wise 16% versus popular. Then you have festive season ahead. And this is a very branded business. And I think a lot of cleanup, a lot of other stuff has happened. So that is something which could do well. CSK on the unlisted side, right now, if you see, it's available at about $180 or something. That's about 7,000 crore market cap, which is 800 billion. Now, if the deal happens at 2 billion, and I'm not recommending people to buy CSK, they could be re-rating on other franchises also. So Torrent recently bought I think Gujarat Titans at 7,300 crore. So there could be a bit of an uptick across the clubs, and then we'll have to see the linkages with the listed entities. But I think sports as a business, Nigel, will do well. Look at clubs across the globe, NBA leagues, soccer leagues, globally, they trade at 5 to 10 billion. So I'm not surprised if IPL franchising is finally touching $2 or $3 billion.
Okay, all right. Thanks a lot, Gurmeet, for giving us those quick thoughts. We'll have to wind down the markets now. Well, on the Nifty, good day, 230 points. It's been a while. It's been so long since we said something like that. The Nifty going home with gains. We had 8 sessions on a trot where we saw red. Today, green is the color and bright green. What did well in today's trading session? You had Tata Motors fueling up the engine, Shriram Finance as well. That was up and about. And from the banking space, Kotak Mahindra Bank did very, very well. Axis Bank as well did put on some good weight. Trent finding its feet yet again, and Sun Pharma, all of them went home with good gains. What was the problem pocket? Bajaj Finance was down. Ultratech Cement did see some profit taking. From the broader markets, what did well? Sun TV, after a long time, the sun rose in trade today because there's hope that there is enough value for shareholders out there, and that's why, in fact, that stock was up and about in today's trading session. Vodafone Idea as well was up close to 5%. Nykaa, maybe some shopping going to take place this Diwali, so that one was up 4.5% in trade today. IRDA as well was up 2.5%. So all in all, a good trading session. Nifty goes home with 250 points. The one that was really raising its bat was the Nifty Bank. That was up 750 points. That led the way, and the advanced decline ratio looking absolutely beautiful. 3 stocks advancing for every 1 stock that was declining. Well, we're going to wrap up on this edition of Closing Bell, but you don't go anywhere. The team of Markets Forward takes over.
Dalal Street snaps its 8-day losing streak to end the days at the day's high. The Nifty ends above the 24,800 mark, led by banking and auto stocks. The Nifty Bank outperforms the blue chips.
RBI keeps the policy rate unchanged, waiting for greater clarity from upcoming data, but sees inflation easing even as growth perks up but remains below target. The ECL framework for banks and capital adequacy requirements as per Basel III will both kick in from April 1st, 2027, thus allowing banks more time to adjust.
Select pharma stocks perk up in trade as the Trump administration strikes a deal with Pfizer. Now, under this deal, the drug maker will lower the prescription drug prices in the Medicaid program. Analysts read this agreement as a positive for Sun Pharma.
Hello and welcome to Markets Forward, your go-to show where we aim to get you all the key data points to gear up for the next trading day. I'm Sonal Bhutra and with me is my colleague Hormus Fatakia. Hey Hormus, tomorrow is the holiday but we have a lot to watch out for Friday's trading session. And what a stellar rally today.
Finally, a day you can call that belonged to the benchmark indices, and it was the credit to the Nifty Bank that led this up move. An 8-day losing streak coming to an end. The Nifty Bank 700 points higher today, leading the charge and taking the Nifty higher with it as well, and as a result of which it had an impact on a lot of the index movers as well. The 24,850, the important level where the Nifty has closed at. We go into a holiday tomorrow. Of course, we need to keep in mind the fact that we started off the series with record FII shorts. So there's some bit of short covering also coming into play today.
Oh yes, it did. But you know, there have been a lot of stocks on our radar today. So let's get across to the first segment of the day. Vivek is joining us now from the big wall with the top movers and shakers of the day. Vivek.
Well, thank you so much for that. A day where you won't complain at all, given the kind of green that you see on the screen throughout the trading session, especially the kind of rally that we saw in financials post the RBI policy outcome. It was the private banks that led the rally. Kotak Mahindra Bank almost 3.5% higher. Axis, ICICI, HDFC, all of these stocks supported the up move as far as the Nifty Bank was concerned. Along with that, the overnight deal that was announced by Pfizer was something that led to quite a bit of a relief rally as far as the entire pharma pack was concerned. Remember, a few Indian companies supply to Pfizer. Not only that, there was the overhang of drugs coming under the Medicare basket as well. These concerns dissipated overnight. The entire pharma pack saw a bit of relief rally. Piramal, Laurus, all of these stocks significantly higher in the session today. The NBFC pack rallied, especially after the RBI policy. Look at Aditya Birla Capital, 2.5% higher. Samman Capital, this stellar rally that the stock seeing continues. Shriram, L&T Finance, all of these stocks higher anywhere between 2.5% to 6% today. Within the broad end of the markets, our media stock, one that doesn't move too often, that was significantly, one was Sun TV. When you look at this particular name, it was the rub off of all of the news flow that you're seeing across value unlocking as far as the IPL franchises are concerned, higher by 15%, very strong volumes. And Tata Motors, good numbers, but there was a significant catch-up rally that this particular name saw. Relief rally seen, some positive news flow coming in as far as the JLR woes are concerned. Negative stocks, very few and far between. One stock from the broad end of the markets that stood out was Delivery, over 3.5% in this particular name. OMCs today saw a bit of selling pressure, HPCL down over 2%, and NLC India, Select Utilities, NLC, one of the top laggards as far as the broad end of the markets, NSE 500, one of the top laggards today.
Vivek, thank you for taking us through the top movers of the day. We are now being joined by Sudeep Bandopadhyay, the Group Chairman at IndiTrade Capital, and Ruchit Jain of Motilal Oswal Financial Services. Ruchit, to you first. Despite this move that we have had today, you still use this as a bounce to cut out your positions on the index? Or do you believe that this has still more legs to go once we resume on Friday?
Yeah, hi, very good afternoon. Well, if you go by the data, then we believe that post the recent correction, the risk-reward ratio has in fact turned favorable to create fresh longs. Primarily, if you look at last 9 trading sessions, markets had ended on a negative note, which had led to quite oversold momentum readings. And historically, there have been such 4 to 5 occasions where on consecutive 9 sessions, markets ended in the red. But after then, for next 5 or 6 trading sessions, we have seen a good positivity because of the oversold setups. Secondly, if you're also combining with the the rollover that we have seen yesterday, FIs have long short ratio only of about 5 to 6%, which means that almost 94% positions are there on the short side. So this leaves very less room to create more shorts. So in absence of that room to create more shorts is less. So, and the momentum readings are old, so markets have already corrected. 24,400 we have seen in last couple of months have acted as a good support. So the risk reward ratio, I think, is favorable for an up move over here. So a relief rally definitely, but we believe that this could extend towards 25,200, 25,250 in the short term.
We take that point, and Sudeep, we'll just come to you in a bit, but because we want to understand what transpired at RBI's policy meet today, because the Monetary Policy Committee left key policy rates unchanged as expected. The forecast for GDP growth was hiked by 30 basis points to 6.8% for this fiscal. The inflation forecast was cut by 50 basis points to 2.6%. But what stole the limelight were a slew of measures by the central bank to shore up lending. A total of more than 20 measures have been announced. Ritu Singh is here with the key highlights. Ritu?
Well, yes, the Reserve Bank of India has unveiled sweeping, reforms across the banking sector, measures that will reshape credit flow, boost competitiveness, and open new avenues of growth, especially for banks. First up, the expected credit loss framework. It's not going to bite immediately. Implementation only starts from April of 2027, with banks getting time until 2031 to fully absorb the higher provisioning impact. Basel III capital adequacy guidelines are going to kick in from 2027 as well. Alongside, draft norms on credit risk propose, lower risk weights for MSMEs and home loans. That again is going to make capital requirement for banks lower. Now, in another huge relief, RBI has scrapped its earlier draft on business overlaps between banks and their group entities, leaving that call to individual bank boards. This is especially important for lenders with multiple subsidiaries like HDFC Bank and ICICI Bank. But perhaps the most striking shift of all of these has been that banks can now finally finance mergers and acquisitions, which is a complete U-turn from earlier RBI regulations. This has, of course, been a long-standing demand from banks, and it will now let them enter the M&A space, an area which had increasingly been dominated by private credit. So expect more buyouts and consolidation deals as well. Now, capital market rules are being eased for bank lending as well. There's going to be no ceiling anymore on lending against debt securities. Banks can lend against shares, REITs, InvITs. The limit on loan against shares has been raised fivefold from 20 lakh rupees all the way to 1 crore rupees. And similarly, IPO funding limits per person have been bumped up from 10 lakh rupees to 25 lakh rupees. Now, for large borrowers, there's huge relief. The 2016 rules that discouraged bank lending to corporates that had more than 10,000 crores in bank loans, that is gone. This marks a significant shift. The large exposure framework, though, for individual bank-level risk management remains, but the system-level concentration risk is now going to be managed through separate tools that are yet to be announced. Now, for infrastructure, again, risk weights for NBFC lending to operational and high-quality projects is going to be cut down. That will again bring down the financing cost for them. And finally, deposit insurance premiums are going to turn risk-based. That means banks with better rating pay less, the riskier ones pay more. So this is some sort of an incentive for better governance as well. So overall, big bang reforms, more than 20 announced in this policy with some far-reaching consequences.
Far-reaching consequences indeed, and it shows with the number of announcements that were made. Ritu, thank you for that. Sudeep, much needed for the banking sector, especially considering there were some concerns in the previous quarter with regards to pressures on their margins, their asset quality and so on?
Absolutely. I think some of the measures, Harmas, if you look at it, they were long-standing demand, and these were the regulations were framed many years back when the world was different, the volume of credit was different, the transaction used to happen in a different manner. Look at M&A. I think there is more rationale for not letting banks to participate, and because of that, all corporates were using foreign sources or private credit for M&A. I mean, banks were denied this opportunity of credit growth. Similarly, look at IPO funding, and also look at lending against shares. I think these limits were set long back, and they warranted an increase. I'll also mention one point that, look, the government, SEBI, RBI, all of them are worried about FNO, particularly unbridled speculation and speculative position taking through FNO. Now, that can be countered by facilitating delivery-based buying, which can be done if you lend more against stocks. I think that's another way of helping the cause.
Take that point, Sudeep. In fact, banking experts feel banks need to understand the nature of high financing business and that this can be a big opportunity for Indian banks. Listen into some of the experts we spoke to as well.
This is a high financing business, and that is what our banks will need to understand. The problem really is, are we going to be able to price this credit right? And that is where I think the expertise of a banker will come into play, because this is normally 15 to 18% related financing activity, which our banks are not used to because the kind of credit we get. So I think if we are able to finance it right, this is a great opportunity for Indian banks. So I think credit growth will depend on the optimism that is there in India, first of all. So if a Chinese manufacturing is preferred, then the Chinese manufacturer shall manufacture and India shall not build capacity. But I think if we have the ability of opening things out, what the governor has done now is to say finance is available. Now we have to make projects more viable. So for infrastructure, for example, NAPFID has now said that there is partial credit enhancement available, opens up the whole pensions and the insurance sector money available. Now let's make the projects more viable. So I think corporate credit will be driven by what are more viable projects.
We need an efficient market for corporate control. We should facilitate greater merger and acquisition so that our corporates become more efficient. And you can't do that unless funding is available. And we had extraordinarily constrained funding because the largest provider of credit were kept outside of it. So I'm saying this is an excellent step. Obviously, we'll have to wait for the detailed guidelines on this. But I think this is a very, very good step. That time there was systemic concern about NPAs and so on. And it was believed that you can take away these large borrowers from banking sector and move them to bond markets, for example. I think what we have probably realized is bond market, while has grown, it's very skewed.
All right, that's about the banking space and a slew of reforms. But even select pharma stocks rallied in trade after Trump's administration struck a deal with Pfizer to reduce prices for Medicaid patients in line with most favored nation pricing. Ekta Batra is here with the details and the stocks that tend to get impacted because of that. Ekta?
Well, yes, the news overnight is that Pfizer has signed a deal with the Trump administration, so they will be reducing prices for Medicaid patients in line with the most favored nation pricing policy and also offering steep discounts to patients while they sell directly. In lieu of this, Pfizer will get a 3-year relief from tariffs. The impact is a positive read-through for Indian pharma companies. Sun Pharma, for example, is in focus as it has a specialty portfolio or a branded portfolio which comprises of around 19% of their sales. Citi, in fact, has written on this. They have a buy and a target price of 2180. According to them, the most favored nation pricing overhang is removed with the Pfizer deal. Existing drug prices in Medicare and commercial segments haven't been touched, removing a key overhang on Sun Pharma's key drug, Ilumya, from their specialty portfolio. Additionally, besides Sun Pharma, the other CDMO companies seem to be rejoicing a bit in today's trading session as well. There is relief for CDMO players if in case formulation companies now do not have to redirect capital towards US capacity, hence reducing the threat of offshore outsourcing eventually being under the scanner as well.
Ekta, thank you for that. Sudeep, you take this rally within the pharma names with a pinch of salt, or do you believe that, okay, there is some relief forthcoming for them now?
Well, I will take it with a pinch of salt. I think, things are too volatile at this stage. And I'm more worried about the CDMO players because, they don't get directly impacted, but secondary or tertiary impact may come on CDMO players as well, because people may start moving, these activities to US to show investment in US, and these players may not get incremental business and incremental contracts. So I'm a little worried about this entire CDMO space, as well as, of course, the guys having patented drugs. Of course, there can be way outs and there can be via media of handling things for the time being, but it's too volatile a scenario. I rather focus on pharma companies focused on domestic market and non-US markets.
All right, take that point. That's for the pharma space. Let's also quickly take a look at what's happening in autos, because Nifty Auto was in the fast lane. We got the September auto sales numbers. And if we start with the big players, for instance, Tata Motors surged in trade today. Most of them have reported numbers which were better than what the street was working with. Tata Motors at 94,681. Nomura estimates at 80,500. Total sales were up 12.3%, and it was led by the PV business. So passenger vehicles, that's where they saw growth of 47%. The CV sales, they were decent growth. 16% higher on that one. Tata Motors was one of the big gainers in trade today. Bajaj Auto total sales at 5.1 lakh units, which compares with Nomura estimates of around 5 lakh units. Total sales were up 9%. Total domestic sales were up 4%. But this was led by exports for Bajaj Auto, which was up around 18%. For M&M, both autos and tractor sales did well. Total sales in the auto space came in at 1 lakh units, which is a growth of 16%. Their tractor sales were very high, 49%, which was higher than the estimates as well. So the estimates that Nomura had was of around 50,000 units. I think tractor business did well across the industry. For instance, Escorts Kubota tractor sales were up 48% on a YOY basis to come in at 18,267 units. If we talk about Hyundai, even they did really well. Units sold were 70,347, higher than the poll. And some of the categories saw highest ever sales in the month of September as well. VST tillers, where total sales were up 35%. So a lot of these agricultural related sales, they did really well, and that is something that showed in the stock price as well.
Yeah, even Escorts and M&M tractor sales were really robust as well. Ruchit, on the charts though, Tata Motors is one that I wanted to ask you about. 5% higher today, crossing levels of 700 again. Do you believe that there is some more upside left here?
Yes, certainly it seems. No, firstly, if you look at the sectoral index, then definitely the sectoral index, Nifty Auto Index itself is in an uptrend. And after some consolidation, it seems that the index should resume its positive momentum now. And Tata Motors so far has been a laggard, but today's price volume action seems quite positive. The stock has ended above its 200-day exponential moving average, and that too with very high volumes compared to its daily average. So I think at least in the near term, it leaves a room to rally towards 750 kind of levels over next few trading sessions. So price volume action looks positive. So 750 can be anticipated from current levels in next few days.
All right. And Sudeep, any word on the auto space?
Well, I do like M&M, and we have been liking M&M for quite some time, and I will continue to recommend M&M. I think the numbers, as far as tractor sales are concerned, we were expecting that, from the second quarter, third quarter, things will start improving, and that's what has started happening. As far as other automobile companies are concerned, Maruti is what we like. I think the lower end of the market, they were losing out for quite some time. I think things have turned now, and there has been amazing amount of demand, which the company talked about. And I think, this is going to be the beginning of a rejuvenation for Maruti. So from a long-term investment point of view, Maruti does look good.
Sudeep, Ruchit, thank you so much for sparing time and joining us today with your views on specific stocks. Take a short break. On the other side, we get you some top corporate voices and, of course, the key events to watch out for on the other side. Stay tuned.
Welcome back. You're still tuned into Markets Forward. Let's take a look at the big corporate voices of the day. JN Resources made a strong debut on Dalal Street. The company's management told CNBC-TV18 that it was sitting on 20% of free capacity, which can be used for growth. They also added that while it did not export to the USA, its focus remained on Southeast Asian markets. The company has been growing at 30% and expects to maintain this momentum going forward as well. They also said that margins would improve as operating leverage plays out.
Mahindra & Mahindra up next as the company saw a 10% rise in its utility vehicle sales and an 18% growth in its CV sales. It also saw a 60% surge during the first 9 days of Navratri. Pent-up demand and GST benefits have strengthened the market sentiment. Now, the company said that it is working to boost dispatches through rail and logistic channels. The upcoming wedding season is also expected to further drive demand. The sales are evenly split between the rural and urban markets, with Bolero and Bolero Neo leading in the rural areas, while electric vehicle bookings have increased to about 8%.
And last week, we spoke to LG's management. They told us that the value was the right time to launch an initial public offering. Remember, it comes up next week. While the firm's focus remains on the performance of its Indian subsidiary, LG also stated that reinvestments will be made in India as part of its third plant being inaugurated in the city. Production on the first line of this new plant is expected to commence by end of 2026. The company is doubling down on its capabilities while investing in new technology. The company added that scaling up the B2B business is a key priority. With all components being produced in-house, air conditioners are expected to drive business margins. They also noted that the decision to shut down its mobile business in 2021 was a global move aimed at focusing on the company's core strengths.
Now, Nilesh Shah, the managing director at Kotak Mahindra AMC, says that a barrage of IPOs has raised concerns over the quality and hence has not applied for any recent ones. Listen in.
With the barrage of IPOs, undoubtedly, there is no worry on the quality side. SEBI has done a fantastic job on ensuring that only quality IPOs come. Institutional investors also have done a reasonably good job in ensuring that they invest in reasonably valued IPOs. Many of the IPOs which have opened at a discount had virtually no institutional participation. So my recommendation to investors, please don't make mistake on your own. Learn from our experience and go for those IPOs where you believe there is a reasonable institutional participation.
All right, with that, it's a wrap on this edition of Markets Forward. We'll be back with more news and updates on the other side of the short break.
Hello and welcome to Business 360. I'm Archana Solanki. Here are the headlines we're tracking this evening. Monetary Policy Committee holds key policy rates as expected, but signals that inflation undershooting earlier expectation opens up for space for more cuts later. Economists factor in a cut in the December policy. In a first, RBI allows banks to finance mergers and acquisitions, removes lending restrictions on large borrowers with more than 10,000 crore rupees of exposure, also eases rules to allow more infra financing by non-banking financial companies. RBI announces a 4-year glide path for banks to implement expected credit loss framework by March 2031. Move will smoothen the impact of higher one-time provisions. Also proposes to ease capital adequacy rules, especially for MSMEs and mortgages. Removes overlap restrictions on businesses of banks and their group entities. Capital markets get an unexpected bonanza. RBI hikes the limit on lending against shares from 20 lakh to 1 crore rupees. IPO financing limit more than doubled to 25 lakh per person. Removes the ceiling on lending against listed debt securities like REITs and InvITs. Bank stocks lead the rally on the last street as Sensex and Nifty snap an 8-day losing streak. Rupee gains strength against the dollar. 10-year bond yields rise. Gold prices hit another record high as the demand for safe havens remains strong. Weak dollar and expectations of more Fed rate cuts boost sentiment. Prices of silver and other precious metals also rally. Union Cabinet hikes the minimum support price for 6 Rabi crops by 4% to 10%. MSP on wheat hiked by over 6%. Also hikes dearness allowance for central government employees and pensioners by 3% with an outlay of over 10,000 crore rupees. The US government shuts down for the first time in nearly 7 years. The Senate fails to pass a bill to extend federal funding. National parks, museums and select federal agencies to shut down. Thousands of federal workers face furlough. Pharma giant Pfizer strikes a deal with the Trump administration to cut costs for some prescription drugs by up to 85% in the US. Offers the most favored nation pricing and earns a tariff reprieve for 3 years. The deal also includes a $70 billion investment commitment. US President Donald Trump gives Hamas a 4-day ultimatum to accept his 20-point peace plan for Gaza. Plan includes an immediate end to military operations in Gaza and the release of all Israeli hostages, but it's vague on statehood for Palestine. All right, the top story this evening. In an expected move, the RBI Monetary Policy Committee has decided to keep the repo rate steady at 5.5%. All 6 MPC members voted to pause the rates. However, the decision to retain a neutral policy stance was not unanimous. The RBI has increased the growth forecast for FY26 from 6.5% earlier to 6.8%. However, Governor Sanjay Malhotra said that the tariff and trade uncertainty may lower external demand, posing downside risks to growth. Meanwhile, the inflation forecast for FY26 has been lowered from 3.1% earlier to 2.6%. Inflation forecast for the first quarter of FY27 has also been lowered to 4.5%. The governor said this opens up space for policy action, hinting at a rate cut in the future. Governor Malhotra said the GST rate cuts will have a sobering impact on inflation and will push consumption. However, he warned that the outlook remains clouded due to external uncertainties. The governor also addressed the rupee depreciation, saying that the RBI is keeping a close watch on the currency and will take appropriate steps as warranted. Here's the governor on the room for future rate cuts.
There has been a significant moderation in inflation. Moreover, the prevailing global uncertainties and tariff-related developments are likely to decelerate growth in H2 this year and beyond. The current macroeconomic conditions and the outlook has opened up policy space for further supporting growth.
Well, apart from the monetary policy, what stole the limelight were a slew of measures by the central bank to shore up lending. A total of more than 20 measures have been announced by the RBI. Ritu Singh is here with the key highlights. Ritu.
Well, yes, the Reserve Bank of India has unveiled sweeping, reforms across the banking sector, measures that will reshape credit flow, boost competitiveness, and open new avenues of growth, especially for banks. First up, the expected credit loss framework. It's not going to bite immediately. Implementation only starts from April of 2027, with banks getting time until 2031 to fully absorb the higher provisioning impact. Basel III capital adequacy guidelines are going to kick in from 2027 as well. Alongside, draft norms on credit risk propose, lower risk weights for MSMEs and home loans. That again is going to make capital requirement for banks lower. Now, in another huge relief, RBI has scrapped its earlier draft on business overlaps between banks and their group entities, leaving that call to individual bank boards. This is especially important for lenders with multiple subsidiaries like HDFC Bank and ICICI Bank. But perhaps the most striking shift of all of these has been that banks can now finally finance mergers and acquisitions, which is a complete U-turn from earlier RBI regulations. This has, of course, been a long-standing demand from banks, and it will now let them enter the M&A space, an area which had increasingly been dominated by private credit. So expect more buyouts and consolidation deals as well. Now, capital market rules are being eased for bank lending as well. There's going to be no ceiling anymore on lending against debt securities. Banks can lend against shares, REITs, InvITs. The limit on loan against shares has been raised fivefold from 20 lakh rupees all the way to 1 crore rupees. And similarly, IPO funding limits per person have been bumped up from 10 lakh rupees to 25 lakh rupees. Now, for large borrowers, there's huge relief. The 2016 rules that discouraged bank lending to corporates that had more than 10,000 crores in bank loans, that is gone. This marks a significant shift. The large exposure framework, though, for individual bank-level risk management remains, but the system-level concentration risk is now going to be managed through separate tools that are yet to be announced. Now, for infrastructure, again, risk weights for NBFC lending to operational and high-quality projects is going to be cut down. That will again bring down the financing cost for them. And finally, deposit insurance premiums are going to turn risk-based. That means banks with better rating pay less, the riskier ones pay more. So this is some sort of an incentive for better governance as well. So overall, big bang reforms, more than 20 announced in this policy with some far-reaching consequences.
I don't think, that you should see these measures as any kind of a relaxation or kind of letting go our sight, from financial stability. Stability is foremost for us. Whether it is price stability, whether it is financial stability, that is foremost not only for us, I think for the country as a whole, it's very, very important.
Lata Venkatesh is here with more on the monetary policy and the slew of banking measures unleashed by the RBI. Lata, please take us through what you made of the policy and the sweeping banking package.
Well, it was a no-action policy, no rate cut policy, but there was a very clear guidance that one cut is coming, at least. Look at the words he said. He said the lower than expected inflation and the GST cuts give us space to support growth. On a previous occasion, he had said leaves very limited space to support growth. Now, they've removed the word limited and just said space to support growth. There are some economists who interpret that as not just one, but maybe even two cuts. But of course, that's a debate. No one is debating that there is space, that the governor is hinting at a cut probably as early as December. So that's the positive that's come from the monetary policy side. But as is now very clear, this is more a banking policy. It's a credit policy rather than a monetary policy. Look at the slew of steps. The big one is banks allowed to do acquisition finance. Until now, from the last 3 decades, the Reserve Bank's view was banks should give loans to grow the economy, not to just change the owner. One big man takes out one small man. You don't waste credit on that. Now they've allowed acquisition finance because, yes, there is enough money for growth, perhaps. But more importantly, the chances are there will be a huge consolidation in India Inc. because you're getting money to buy up smaller companies. Think cement, think paints, think all these places where there is multiple competition. I think consolidation is on the way, driven by bank finance. Then system-wide loans to large groups was curtailed because of overexposure. That also goes, this can push up capex because it's only the large groups which are really into capex. Then lower risk weights because of these Basel III norms. You will have lower capital to be set aside for MSME loans and for residential real estate, which means mortgage home loans will go down those who build homes will also get cheaper money. That again is a big positive. These are proposals. Okay, they're not yet implemented, but they will be. And therefore, banks are now they've made it cheaper, hold less capital to give loans. But the whole point that cannot be answered by Reserve Bank is there demand for credit? That will depend on growth. Reserve Bank doesn't have the weapons to create demand for growth. They can only facilitate easier lending. The animal spirits have to be driven by government. So there is that if. But otherwise, they've really smoothed the way to lending by banks.
Right. Thank you so much, Lata, for that comprehensive explanation. Here's how the markets reacted to the RBI policy. Bond yields rose today after RBI's status quo policy. The rupee gained some strength against the dollar, which has been weakening in the last few days. $1 now costs nearly 89 rupees. From money market to stock markets, Dalal Street snapped its 8-day losing streak and ended at day's high. Nifty closed above the 24,800 mark, led by banks and auto stocks. Nifty Bank cheered the central bank's banking regulations, ending the day over 1%. Now on to the commodities market. The gold bull run continues with the yellow metal hitting another record high. Silver prices are also rallying along with all the precious metals. Manisha Gupta joins us now with the details. Manisha.
Well, thank you so much for that. Well, absolutely. It has been an all-time high and a string of that when you look at 2025. And September, the month, clearly has seen more days where you have seen more all-time highs coming in for the gold and silver prices there. This is what we've done in the international markets. 38.95 is done. Remember, we started this year with $26.50 an ounce, and we are trading at 38.95, not too far away from 3,900 or for that matter, 4,000 as well. 48% of gains is what we've done in 2025 till time. And this is the best yearly gain that you are looking at in sense of gold prices since 1979. For the Indian markets as well, it's trading at around 1,18,000 rupees per 10 grams. So strong gains continuing for gold. Silver not too far away. The international markets are trading at a 14-year highs, but the Indian markets are trading at an all-time highs. For silver, it has seen an outperformance on gold. Silver has gained up by 64% in this year until time. And this is the best yearly gain that we are looking at in 10 years when it comes to silver as well. Not too far away is platinum, because here as well we are trading at around 12-year highs, 78% of gains. So platinum clearly has outperformed gold and silver both. For platinum as well, this is the best yearly gain that we are looking at since 1979. These commodities clearly have outperformed various other asset classes, including equities, including bonds, including real estate as well. Not too far away is copper, and that is being touted as the next gold. Copper is trading at a 2-month highs right now. We have seen 21% of gains come in for copper in this year, and this is the best gains that you've seen in the last 5 years come in for copper as well. So everything that says tangible commodities has seen gains in 2025. There is just so much uncertainty, and that really seems to be supporting many of these commodities. So as I said, investors really seem to be moving towards tangible commodities. And then there are expectations of further rate cuts coming in from US. That rate cut cycle perhaps has just started. Markets are working with 2 more rate cuts in this year and then 1 more in 2026 in sense of first quarter. So when it comes to gold, really, it has been also about the dollar index, which has declined by 9% in this year until now. You also are looking at very strong investment demand coming in for gold, silver, platinum, copper. The ETF buying has been on the stronger side as well. For gold, it has been very strong central bank buying, nearly 80 tons per month, and that clearly has been a multi-year highs there. Deficit concerns when it comes to many of these industrial commodities also seems to be keeping these commodity prices higher, with an expectation that we might be overbought on charts, but under-owned when it comes to retail and institutions. So further gains for many of those still not ruled out.
All right. Thank you, Manisha, for that update. Shifting focus now, GST collections in September rose 9.1% to 1.89 lakh crore rupees on an annual basis. Collections between the April to September period also rose over 9%. Net revenue in the first 5 months stood at 8.78 lakh crore, an increase of 8.8% from a year ago. The cabinet has hiked the minimum support price for 6 rabi crops by 4% to 10%. Here's the breakdown. Now, MSP on wheat has been hiked by over 6% to 2,585 rupees, while MSP on barley has been hiked by over 8% to 2,150 rupees. Safflower has seen the highest hike of over 10% to 6,540 rupees. The Union Cabinet has also increased dearness allowance for central government employees and pensioners by 3%. This move is expected to benefit nearly 50 lakh employees and over 68 lakh pensioners. The total outlay for this scheme stands at more than 10,000 crore rupees. And it's time for a short break. Coming up next, US President Donald Trump gives Hamas a 4-day ultimatum to accept his 20-point peace plan for Gaza. That and more when we return. Welcome back. The National Crime Records Bureau has released its much-delayed crime report for 2023. The crime rate saw a sharp rise across India, with Manipur standing out as the state where cases increased six-fold over 2022. The rise is attributed to the prolonged ethnic violence in the state. Crimes against children, cybercrime and economic offences registered significant growth, while crimes against women also rose. Santya Gora has the details. Santya.
The National Crime Records Bureau, the NCRB, has released the crime report for 2023. According to the report, 62,41,569 cases were recorded across India in 2023. The national crime rate, measured as cases per lakh population, stood at 448.3, a 26.1% increase over 2022. Among states and union territories, Uttar Pradesh recorded the highest number of cases under IPC in 2023 at 4,28,794, followed by Maharashtra at 3,85,623 and Delhi at 3,24,257. One of the most striking figures come from Manipur. The state registered 19,192 cases in 2023, up from 3,029 in 2022. A six-fold increase, which is attributed to the ethnic violence between the majority Metis community and the tribal Kuki community during 2023 and 2024. In terms of crime rate, Delhi topped the list at 1508.9, followed by Kerala at 721.7. Manipur ranked third with a crime rate of 594. Looking at the metropolitan cities, Delhi city had the highest crime rate at 1983, followed by Kochi at 1167 and Jaipur at 975.3. At the other end of the spectrum, Kolkata recorded the lowest crime rate of 77.5, followed by Chennai at 180.5. Crimes against children saw a 9.2% increase in 2023 compared to 2022. Crimes against women rose by 5.4% in metropolitan cities and 0.7% across states and UTs. Cybercrime also witnessed a sharp surge. A total of 86,420 cybercrime cases were registered in India in 2023. Among states and UTs, Telangana had the highest cybercrime rate at 47.8, followed by Karnataka at 32.3 and the Andaman and Nicobar Islands at 11.7. Among metropolitan cities, Bengaluru recorded the highest cybercrime rate at 207.4, followed by Hyderabad at 62.7 and Lucknow at 50.1. Overall, cybercrime cases rose by 31.2% across states and UTs and by 39% in metropolitan cities in 2023 compared to 2022.
All right, thank you, Santya, for that comprehensive update. Shifting focus to international news now. Israeli forces continue to bombard Gaza, killing at least 23 Palestinians since dawn. Two missiles struck a school which had been converted into a shelter for hundreds of displaced people in East Gaza City. Israel has expanded its ground invasion alongside heavy aerial bombardment in the region. Meanwhile, US President Donald Trump has said that Hamas has 3 or 4 days to respond to his proposed peace plan to end the war in Gaza. Russian forces have claimed to have captured a village in Ukraine's Donetsk region. The International Atomic Energy Agency is engaging with Russia and Ukraine to restore off-site power and Ukrainian nuclear power plant. Ukrainian President Zelensky has said that Russia's shelling around the nuclear plant is a threat to everyone. In his address, Zelensky added that no terrorist in the world has ever dared to do with a nuclear power plant what Russia is doing now. Over 90 children remain trapped under building rubble after a school collapsed in Indonesia earlier this week. Search and rescue operations are still underway. Officials have confirmed that 3 students were killed and several were taken to the hospital. Over 69 people were killed after a 6.9 magnitude earthquake struck the Philippines. Rescue operations are underway as many people are still feared to be trapped under the wreckage. More towns and cities have now declared a state of calamity. The earthquake comes a week after back-to-back typhoons killed over a dozen people. And with that, it's a wrap on this edition of Business 360. More news and updates continue right here on CNBC-TV18.
Welcome to our monetary policy special. Well, the Reserve Bank today did not cut rates, but it clearly said that because of the sharper than expected fall in inflation, it gives them more space to cut rates going forward. Bond yields actually rose after the policy, obviously because there was no cut. But there are still two views on whether the RBI is likely to cut more than once, because the RBI very clearly said that it has, the lower than expected inflation allows space. It didn't say limited space. So there are those interpretations. More importantly, there were a bunch of steps that the RBI announced to remove constraints on banks in the process of giving loans. They can fund acquisitions, they can lend more to large groups, they can lend more to capital market players and against shares. But, let's first discuss the monetary policy issues. I have with me two economists, Samiran Chakrabarti of Citi and Mridul Sagar, a former MPC member and, of course, formerly ED with RBI. I also have with me Shailendra Jingan, who heads the Treasury at ICICI Bank, a bond expert today. Gentlemen, thank you very much indeed for joining me. Samiran, first up, I repeatedly asked the governor, you're not saying limited space to support growth, you're saying space to support growth. Should we interpret that there is more than one cut in the offing?
So I think in our view, we are now firmly in a wait and watch mode. Whether the space is going to be available in the December meeting also will depend upon a lot of macro and external factors which can play out between now and December. We have to see how the GST cut is going to play out in the festive season, how it's going to play out over the next couple of inflation prints. And then we have to also see how the growth numbers are responding to the tariff-related issues. So that way, when RBI goes into December, it will probably have a better idea of whether that space still exists, because as the governor and deputy governor has repeatedly mentioned that monetary policy is forward-looking. So in December, when RBI will be looking at 1 year ahead inflation forecast, that's for December quarter 2026, their current forecast is of CPI at 5.1%. It's partly due to base effect, but to communicate a rate cut based on real rates argument in December might become more challenging. So in some sense, one can argue that unless there is space for at least 50 basis point of rate cuts, or unless the growth shock is more significant, the RBI might have to go for a more longish pause at a relatively low interest rate and extend the cycle rather than going for deepening the cycle.
So at the moment, you're not expecting a cut in December?
We are on a wait and watch mode.
Okay, fair enough. My experience so far, and it would be yours as well, that the MPR, monetary policy report forecasts have less significance. When they enter the monetary policy statement, they become more significant. In the past, those forecasts are there, but they are not given that much importance. Mridul, would you agree? And if you want to take the MPR forecast for the fourth quarter is 3%. I mean, 3.9 or something, below the 4% mark. So, Mridul, again, same question, rate cut expectation?
So Lata, for a 1 year horizon, the MPR forecast match the MPC forecast. So there is no question that the two are different. It's only when it gives a 2 year forecast, obviously the uncertainty is so high that you have to give a lesser weight to that. But whatever the numbers they have put out, whether on the 1 year basis or a 2 year basis, the real policy rate looks very much in alignment with the neutral rate. Now, basically, this doesn't rule out a cut because if obviously growth falls and there is downside risk to growth, but the baseline looks pretty solid, we don't have it still in the data. I think Poonam Gupta beautifully put it in communication in the press conference when she acknowledged that Q1 growth surprised on the up, but recent weakness is there and inflation is giving some headroom for further cuts if it becomes necessary. I think we should take it on the face value of it and not try to firmly predict whether there would be a rate cut in December or not. There are lots of things coming up to December. The situation will
okay,
become
not
clearer.
Not December, but surely you see one rate cut ahead?
At best, one is with the high probability, but suppose we all mistake it and there is some global headwinds which are there. And if it percolates more globally, forget India. India can manage the shocks it is receiving with some downside on the growth. But if the whole things get pretty complicated in terms of asset bubbles forming and getting burst and putting growth down, you can have more than one rate cut. Nothing is stopping that.
Fair point. Okay, Shailendra, the market sulked. You saw the 10-year go almost to 6.6%. What are you all taking home?
So the market, Lata, was sulking till the time the RBI press conference started. I mean, post the RBI press conference, I mean, market, took a signal that, RBI is looking at bond deals. I think till now, the understanding in the bond market or the thinking in the bond market was that, the transmission is working well through the banking channel and, through the cuts in the EBLR rates, etc. And, GSEC market previously, when, RBI was asked, I mean, there were other factors which were highlighted in terms of demand and supply. And today, I think there was some hint given by the governor that, bond yields could be somewhat lower. So I think that was, and they are considering certain things. I mean, of course, he spoke about, about the auction calendar, etc., and the state loan supply. So I think that is where the bond market started taking a positive signal. Till the time, even when, in the policy, there were hints that one more cut, a cut could be coming in the future. But that didn't move the needle for the bond market. So I think the bond market was looking at specific action to, address the demand-supply gap. And that came in the press conference. And since then, I mean, the yields are down by about 5 or 6 basis points.
Okay. Well, what did you make of the comment on the rupee, Shailendra? Normally, the RBI says, we only control volatility. This time, he seemed to show more concern and intent to intervene. Any takeaways?
So, no, our sense is that RBI is still, the data at least we have, since December 24, RBI has been more tolerant in terms of, the movement of the currency. And we think that that is likely to continue. But I agree with you that today was probably the first time that, we got a signal that, probably they won't tolerate too much of depreciation from here on. Because, I mean, if you look at even, some of the valuation metrics like RER, I think this is the lowest level. So we have come below 99 on RER. And this is the lowest level, I think, in the last 3-4 years. So in a way, I think probably they feel that, a lot has happened on the rupee. But, if the capital outflows continue, I mean, we are seeing continuous outflows on the equity side. So I don't think they will stand in the way of some depreciation, but probably they don't want rupee to fall too much. I mean, that's the sense we.
That was the take home. Samiran, what did you make of you referred to the inflation forecast. The Reserve Bank has been seriously overestimating inflation, which they themselves admitted. From 3.7, they have come down all the way to 2.6. And when I took a poll, the market is actually sitting at 2.4 or 2.5. That was the average I got in terms of this year's CPI. Going forward as well, 4.5% for the April, May, June quarter. There are still people on the street who are giving me a lower number. Do you think that we will continue to see actual inflation undershooting RBI forecast?
Just first answering the last bit of your question, which is a more technical one, is about this the Jan-March quarter forecast being suddenly up to 4% versus the 1.8% in the October-December quarter. I think it's because the market might be anticipating a similar drop in seasonal food prices that happens in the winter months. But this time, since the vegetable prices did not go up as much during the summer months, the decline might be much lower. And maybe RBI has factored that into their forecast, and that's why getting a slightly higher inflation number for that quarter compared to the street. But I think the bigger question is about this sustained over estimation of the inflation numbers in the last few years, vis-a-vis a sustained underestimation of inflation during the COVID and the Ukraine war periods. So one possibility is that there is always this adjustment bias that forecasters have, and RBI might now be adjusting a bit more on the downside. So what I'm hinting at is that this year, particularly, we have seen globally, particularly in Asia, a significant lowering of inflation numbers across countries. So next year, if on that low base, if inflation starts picking up everywhere else, then we could also be impacted by that. And similarly, all the stimulus that we have given this year, if the stimulus, they have their intended result in boosting demand, then one can obviously expect that to some extent the inflation momentum will pick up also. And on top of it, we have this very peculiar situation where next year we're going to have a completely new inflation index.
Exactly.
So because of all this, forecasting inflation so far ahead now is becoming notoriously difficult. So I have full sympathy with that view. But yes, it is going to be a challenge for RBI, even in the December policy, that how much emphasis do they put on this 1 year ahead inflation forecast vis-a-vis looking at more near-term inflation dynamics, and then take a call on the real rate.
Got it. Actually, out of time, the SBI chairman will be joining in shortly. Mridul, a very quick question. Do you think the Reserve Bank will also be conscious that the real GDP looks good because of technical factors like, you're deflating 60% of the inflation with WPI? So actually growth is not so good. Do you think there is an underlying admission there, but they can't say that I don't trust the GDP?
So obviously everyone knows where the problems of statistics lie. And by maybe January or February next year, we'll have clarity on these numbers when new series for GDP and IIP following that would come in. But on the inflation, let me say that the RBI has reduced the Q4 forecast from 4.4 to 4%. So in a sense, they're also sort of correcting that bias upward, which existed earlier. Now, we don't know exactly how much confidence to give, but they have given confidence interval bands for the last quarter.
Yes.
And that really shows that there is uncertainty about that inflation. Now, the issue is, do we factor it into policy right away? And RBI clearly communicated with 2 cuts in June that they have done what they needed to do. And they're standing by that. And probably a reassessment could come in December. Yes, between the GDP and GVA, there is discrepancy. So that's well known. But even the GVA growth is not so bad.
Yeah, that's true. No, that's true. That's true. I mean, I'm not saying it's bad at all. In fact, it's very good. They have advanced capex plans, the government, they have advanced exports. So the number is good. It is just that, is it 7.8? That was the question, really. Okay, gentlemen.
In addition, it's the financial regulation side. They have supported growth in lots of fashion.
Absolutely, and that's what I'm going to discuss.
And in fact, I'm worried whether our supervision of the RBI will rise to the occasion to see that the new system works well.
Okay, well, actually, let us ask the SBI chairman those questions. Samiran, Mridul, Shailendra, thank you very much for joining me. It had to be quick because this is really a credit policy. It's a banking policy and probably less a monetary policy. So those questions to the SBI chairman in a minute after the break. Thank you, gentlemen. Welcome back. Today's was more a credit or a banking policy than a monetary policy. Reserve Bank has allowed banks to fund acquisitions, something it never allowed before, lend more to large conglomerates, which was capped, has proposed to reduce the capital to be set aside for MSME loans and mortgages. It has also eased loans against shares, loans against debentures, loans for IPO financing. I mean, a whole host of controls removed. To understand how life changes for bankers and how it might help markets and macros, I have with me the biggest banker of the country, SBI Chairman Challa Srinivasulu Sethi. Mr. Sethi, thank you very much, sir, for finding time for us on what must be a terribly busy day. Would you say that the Reserve Bank's overall attitude has changed? Two policies ago, they gave that big CRR cut. Now they're removing even more constraints. Is it that they've now decided to make banking market-oriented and commercial entities rather than a bit of a handmaiden to social policies?
Thank you, Radha, first of all, for having me on your show. We cannot miss your show anyway on the MPC day. I think most of the regulatory actions all across the globe are dependent on the current environment, the situations which are prevailing. I'm sure RBI has a greater confidence in the robustness of the banking system today. And some of the measures what you have mentioned, particularly in relation to 22 different measures what the governor has announced, are far-reaching, and some of them have been a long-standing request from the industry, the measures also have removed some of the overhangs, particularly on the ECL side, forms of business side. I think there's a greater amount of clarity in terms of what is to expect from the RBI now. And in my view, I shared with you also separately that this is one policy measures we can say that is a kind of banking reforms which have been awaited for a long time.
Yes.
But as I mentioned, I think it is also enabled by the environment, the strengthening of the banking system, what we are witnessing, benign asset quality. And also some of the measures have been there for quite some time. What you mentioned about specified borrower, for example, 10,000 for the banking system. It was issued in 2016. Ever since, the credit to credit by the banks has almost 2.5 times has increased. Obviously, these are the measures I believe are very, very important, and they will increase the credit flow, number one, and consumer protection is something what the governor again spoke about. Ease of doing by the exporters.
All those are important. Okay, from an economy, say, capex point of view or from a banker point of view, pick out the one which is going to make a big difference to you.
I think for me, for the banking system as a whole, allowing financing M&A activity is a greater confidence which is reposed in the banking system today, Indian banking system. While the overseas banks were permitted to be financing the M&A activity by the Indian corporates for acquiring Indian companies, for a very long time, almost 2 decades, I think Indian banks have never been participating in this. So I think it is also important to understand that the corporates today some of the corporates have very good cash balances. Obviously, they all will be looking for an opportunity to acquire companies which strategic to them. And such acquisitions were off bounds for the Indian bank.
That's right. So, I'll tell you, I remember, I think it was Dr. Reddy, it was 2004, if I remember right, that this bar on acquisition finance came. And at that time, the Reserve Bank had explained that, in India, capital and savings are limited and we need growth. So let banks finance growth rather than helping one promoter get another promoter's, assets. Let's use this scarce capital more for growth. That was their intent. But separately, I wanted to ask you, will it spur M&A activity in India? Are we going to see a lot of consolidation? Because we are seeing new groups, we are seeing a lot of industries where there are, for instance, cement. There are a lot of cement companies. There are multiple paint companies. Do you think M&A activity is going to just take off?
The M&A activity is already robust. If you see the numbers, in the calendar year 24 itself, the overall M&A activity in India has been almost $120 billion worth M&As. And in the current year, in calendar year 25 itself, the M&A deals aggregated to $42 billion. And none of the Indian banks, even assuming that some of them are funded by partly debt, we have not been there. More than whether the Indian banks' participation will spur the M&A, for the simple reason that this one particular activity was not accessible by the Indian banks, that anomaly is removed now. I think we have to see from that angle. And from a capital perspective, today, the Indian banks' capital ratios are robust. And both the corporate balance sheets as well as bank balance sheets are in a good shape. I think we'll have to wait for the framework to come. There could be some guardrails, obviously. I think we'll have to see that what comes out. But it's definitely a good move in my view.
Yeah, best of times, perhaps, to start this process. So what about the reduction? The Basel III standardized capital norms will come. And that Reserve Bank clearly said that it will mean lower capital requirements or risk weights for MSME loans and residential real estate. Do you see that
that's
a
very
spur to macros?
Yeah, that's very positive. Particularly, I think MSMEs also are being funded by mainstream banks in a big way today because of the data availability. There's a good amount of confidence in lending to MSMEs. And capital should not be a constraint now with some rationalization on the risk weights would definitely help. As far as home loans, which is the fastest growing area again, and today it is a high performing asset ratios in the home loan sector. I think that also is giving a confidence, and Basel III implementation aligning the global practices to Indian context is a good move on that. And one more, I think, thing which I would like to mention from these measures, Lata, is about the DICGC premium. I think we have been asking for quite some time that the risk-based DICGC premium is something what banking industry has been asking. Again, I must thank RBI and Governor to have a fresh look at this. I'll tell you the backdrop of this. Today, the largest overhead in any bank book is the DICGC premium.
Okay.
And for instance, SBI alone has paid in last year 5,400 crores DICGC premium.
Ooh, okay.
So, and you're not distinguishing between one bank and another. Obviously, there is a need to do that, and it's a quite important measure in my view.
Okay. Well, just for those of us who don't know the abbreviation, what the chairman is referring to is the deposit that banks pay on insuring deposits. The premium that they pay to insure deposits. Now it will be risk-based. That is, strong banks will have to pay lower insurance. It will become market-based. So that's very good for strong banks and banks perceived to be strong. Mr. Sethi, have to wind up, but I want to finally ask you, do you want to give a higher, loan growth forecast, given the fact that so many avenues have been opened up for you and demand also has been spurred by GST cuts, etc.? Do you want to raise, or do you think that, they have smoothed the rules for you, but ultimately, who is to say that growth will come?
Well, it's not only about smoothing the rules for the banks. I think this host of measures which were taken in the past also, for example, the CRR card and the GST, we have to see it as a holistic measure. And all these measures, I believe that, are going to spur the credit growth. If not, I can't venture on the SBI growth rate because we're on the silent period. But from the system perspective, definitely, from 11 to 12% growth rate, what we were looking forward to, at least 1 to 2% uptick will be there.
Okay, that's a very big headline you're giving us, Mr. Sethi, when a person who has over 25% of the banking sector says that the sector will grow by 1 or 2 percentage points more in terms of loan growth. That's a very big positive for the macro. Thank you very much, Mr. Sethi, for joining us and parsing so many of the steps announced by the Reserve Bank. Really, what Mr. Sethi says should hit home. This is a banking reform policy, and we should see the impact in the days to come. Wrap up on this very special broadcast, but stay tuned. More news and updates are lined up for you.
Hello, welcome to News Center. I'm Parikshit Luthra. It's the eve of Dussehra. Markets across the country are full of people. The government is betting on the GST cut, giving a boost to consumption. Automobile companies have reported a big surge in inquiries and bookings in the last week after the GST cuts took effect. E-commerce companies are also reporting bumper sales. Amazon, Flipkart seeing a 30% surge this year compared to last year. Gold prices have hit a record high, but that's not stopping people from thronging jewelry stores across the country. In fact, prices of all precious metals, including silver, platinum, have rallied in the last few days. So can this festive season provide the much-needed fillip to consumption? Let me now introduce our guest this evening. We're joined by Vinkesh Gulati, Director at United Automobiles, former President of the Automobile Dealers Association of FADA. Also joining us are Varun Mishra of Counterpoint Research and Manan Shah, MD at Man Infrastructure and Joint Secretary at Credai as well. Manan Shah, if I can begin with you, could you give us a sense of what's been the sentiment in the real estate sector over the last 9 days of Navratri? What's the pipeline looking like ahead of Diwali?
So basically now the sentiments post GST, everywhere people are seeing some sort of a cost saving which has been happening, whether it's the consumer sector, whether it's the automobile, whether it's the real estate side. The cement thing has gone down like from 28%, now the GST is at 18%. So we are seeing that kind of a saving. And the overall sentiments usually during the festive season has been always more positive. And people are seeing a good lineup. In fact, the weekends have always been a flooding of and pool of people at our sales offices because, you know, it's auspicious time of the year to probably, buy an apartment. And at the same time, they are seeing that before, the sentiments change, let me make the best out of it. So in the real estate sector, we are seeing a good boost coming in overall, whether it's the affordable side or whether it's the luxury market. Luxury was doing probably well earlier as well. But the affordable is also now slowly picking up because they are seeing an overall surplus of cash flow in their savings in the things which they used to buy earlier.
Right. Manan, what I would also like to understand, the markets were anticipating a 25 basis point cut today. The RBI has decided to hold the repo rate steady at 5.5%. How do you think this is going to impact buying decisions? And if we were to ask you for an outlook for the entire festive period till Diwali, what kind of offtake or growth do you expect over last year?
See, on an overall basis, the housing loan is which mainly gets impacted by these cuts. But we have not seen any sentimental change, to be honest, from consumers in terms of their decision-making process. And it's not really a very, very high number which impacts your, the interest rate much. So overall, I don't see any sentimental change of not getting converted in this festive season. And I would still see a momentum getting continued in our industry.
All right. Let me go across to Mr. Vinkesh Gulati. Mr. Gulati, how has the day been for automotive dealers all across the country? It's Ram Navami, tomorrow's Dussehra. 9 days of Navratri are over. How have things been? And is there real interest in coming to showrooms after these GST cuts?
Hi, Parikshit. Thanks for calling me over. I feel it's the best 9 days which have gone and still a day left to complete for the Navratri thing. Today is one of the most auspicious occasion and all the showrooms in India are actually jam-packed today for the deliveries of the vehicles. We should consider that the new price effective happened on 22nd and there are a lot of companies which actually gave better schemes than what the price was cut. So price and the schemes was a big bonanza for the customers and it took us some 3, 4, 5 days for the finance process and the registration process. And for the past 2, 3 days, we are seeing huge deliveries across the market. And practically speaking, these 9 days, if I compare with the last year, overall the auto industry is seeing a good double-digit growth in all the segments, two-wheelers and the passenger vehicle also. So the GST reform has really helped us out this time to have such a phenomenal growth.
Mr. Gulati, what I would also like to ask you, as we are seeing in consumer electronics, many of the customers who were probably buying mid-range items Now, because the GST cuts, are looking to buy higher end or premium products. So are you seeing this trend also with regard to cars and SUVs, people looking to buy bigger cars or maybe higher variants?
So it's right. See, post-COVID, we had already seen that people were wanting to buy better featured car. But with this cut, it has been a double-pronged mixed reaction what we are seeing. The customers who were already interested in the entry-level cars or an entry plus one variant, they are sticking to their choices. But the customers who were buying a middle-level car, with this price cut, they are easily able to upgrade one step further. So that is happening. We have seen a lot of customers upgrading their choices. But also there was one constraint because the price came in, the inventory issue of which variant was how much stock was there, and the vehicle was allocated to them what they had already booked. So wherever there was an option with the dealer of the inventory, the customers have upgraded it. Because even if a 50,000 or a lakh rupees was the difference because of the GST reform, and that's a nominal difference between one variant and an other variant. So a lot of interest happening there. I'm not sure if everybody got what they wanted, but most of the people did upgrade themselves during this period.
Okay, so let me also go across to Varun Mishra, Senior Analyst at Counterpoint Research. How do you see the sale of consumer durables, this product? Counterpoint Research tracks the mobile phone market very closely. What do you think have been the biggest trends this Navratri, Varun?
Thanks, Parikshit, for inviting me. So obviously, I think there's a double-digit growth. So this is what our channel checks indicate. And this is happening across key segments, for example, TVs and smartphones and overall market as well. So this is a combination of factors here. Number one is obviously the GST cut has boosted the demand. But I think the timing of the GST cut is also very, very important. So just doing it just before the festive season has instilled an overall positive sentiment across consumer segments. So we are seeing growth in segments where there is no GST cut happened as well. So this is the positive sentiment which is driving the market across some of these categories. And then we are also seeing discounts being more aggressive this year as compared to last year's. For some of the categories, we have seen discounts going as high as almost 50% of the price. And the third factor is obviously the EMIs. So we are seeing the premiumization trend happening across these segments. So we are seeing consumers in the premium segment opting for EMIs to buy their devices. So this has also increased the overall addressable market. So if you look at the data, almost 2 in 3 purchases within the premium segment is happening through EMIs. So a combination of all of these 3 factors has to a double-digit rise in the overall value of the market across these categories.
Right. What I would also like to ask you that among the key gainers, which would be the companies which are seeing the biggest sales or volume at this point?
I think Apple obviously is the biggest gainer, or anyone going within the premium segment is obviously gaining across categories, be it TVs or be it smartphones. So the premium segment and the premium players are gaining more than the overall market across segment is what we are looking at.
Right. Let me go back to Manan Shah once again. So Manan, in terms of the buying sentiment and total sales of real estate in this festive season, any forecast that you have in mind?
Like I said earlier, what we had anticipated, if I talk about my specific company, we had anticipated to launch a couple of projects this quarter. In fact, with this GST thing coming in, the way the positive sentiments have been flowing across the country regarding all the sectors, we've in fact preponed the launch of one of our projects. In fact, by next week, we are launching one of the projects at BKC, and we've already got a great lineup coming in from the people over there. So I think we were anticipating at least a 20-25% boost on the overall inventory conversion rather than just walk-ins coming in. Usually the festive seasons have a lot of walk-ins, but the booking sometimes dries down because there's too much of supply sometimes or too much of competition inventory being offered. But I feel everyone will be benefited out of it. Especially I see this in the luxury sector because there the savings is always definitely a lot more.
All right. Mr. Gulati, do you see that certain models are now flying off the shelves? Will there be a scenario where customers will go to showrooms and they may not get certain models?
Yeah, Parikshit, that always happens whenever a spike in the sales is happening. And we should consider that people have been waiting after Modi ji announced on 15th August about this reform. And a retail which is pan out in some days, some months, if it has to be skewed in 9 days, it was always a problem. So most of the fast-selling models and majorly the premium, the top-end variant of all the models is the most wanted or the customer's demanded model, and it had always been in a bit of a short supply, and this time obviously it's the similar thing. One thing more, Parikshit, which we added is that with the current prices of the cutting down of entry-level segment, we are seeing a huge jump also there. The inquiry level at all the OEMs which are selling products below 8 lakh rupees, and specifically Maruti, because now Maruti has 4 products which are less than 5 lakh rupees. It started 3.5. And that's where the major jump of inquiries I am seeing. And most of the Maruti dealers are very happy with this price cut, and they are expecting to do great numbers this time. Full festive. I'm not saying Navratra because the price came very late. So now going up to October end, which is Diwali, they are expecting a huge jump happening.
All right. Thank you very much, Varun Mishra, Vinkesh Gulati, Manan Shah for joining us. We're taking a short break here on Festive Centimeter, but when we return, we look at some of the big stories from today. The Union Cabinet has hiked the minimum support price for 6 Rabi crops and dearness allowance for central government employees. That and much more also on the India-EFTA agreement, which comes into effect from today. Welcome back. You're watching News Center. India's trade agreement with the European Free Trade Association kicks in from today. Under the deal, a slew of products are set to get cheaper. Abhimanyu Sharma joins us with the details.
Swiss chocolates are savoured across the world and they are all set to get cheaper in India as India's free trade agreement with the European Free Trade Association is coming into force today. The European Free Trade Association, commonly known as the EFTA bloc, comprises of the countries Switzerland, Norway, Liechtenstein and Iceland. It's a full-fledged free trade agreement which has been signed between India and the EFTA bloc, and for the first time an FTA has an explicit investment commitment of $100 billion over the period of next 15 years, which would be invested by businesses within the EFTA bloc into India. It's expected to generate around 1 million jobs over the course of next 15 years. Speaking about the services aspect, Indian professionals, working professionals will get an increased access into the EFTA bloc. There would be a certain certainty of stay as far as working professionals and certain personnel are concerned. There also would be mutual recognition of qualifications, degrees, particularly in areas pertaining to services like architecture, accountancy and nursing. Speaking about several goods, there would be an increased access into both the sides, both into India as well as into the EFTA bloc. Now, there has been a significant reduction in duties which has been announced in a phased manner over the span of the next few years, and several products which are made within the EFTA bloc, which includes not just Swiss chocolates but also watches, cookies, biscuits, industrial equipment, medical equipment, wines, they will become cheaper in the Indian market. On the other hand, India's labor-intensive exporters of textiles, leather and gems and jewelry will get an increased access into the EFTA market. Also, India's several other exports of agri-products like tea, coffee and several other processed foods will get an increased access into the EFTA market. Now, it remains to be seen what kind of a response this FTA is going to generate, and more importantly, whether this is going to serve as a template for India's potential FTA with the European Union, which is currently being negotiated.
And speaking of the trade deal with the European Free Trade Association, I caught up with the Norwegian envoy to India, Mai-Eline Stena, on the contours of the deal and how it could benefit all countries.
Well, it is certainly a milestone for us as EFTA countries to enter into this trade agreement with India. India is becoming the biggest market for consumers in the world. India is the fastest growing economy, now the fourth biggest in the world. So for us, this is a crucial agreement, and we're very happy that it's now entering into force. And we also see that our companies are very interested in the treaty and in India.
Right. If I would ask you a follow-up question, in the backdrop of the European Free Trade Agreement being signed with India, could you give us a sense of what's the interest in European companies, especially Norwegian companies, in investing more with India, trading more, having closer business ties?
Well, I said India is the biggest market in the world. It will be the biggest consumer market. We are smaller markets comparatively. So of course, it's a disparity in one way. But all EFTA countries, they have very clear technologies, cutting-edge technologies in different areas. That means that there is complementarity between India and the EFTA countries. And for Norway, they are particularly in the field of energy and green energy in the maritime space.
All right, ma'am, if I were to also ask you about the product lines which would be traded between the two countries, how many product lines would literally come down to zero or negligible tariffs?
When it comes to product lines, about 80% of the product lines from EFTA countries to India have been waived tariffs, meaning that about 95% of the export from Norway, for example, to India will be without tariffs in the next few years.
All right. When we speak about the average Indian viewer, could you give us a sense which would be the top 3 or 4 items which would immediately become cheaper for an Indian consumer? Those which we have been getting from Europe for decades, but will now start to get cheaper.
Well, the very good news is that Norwegian salmon will become much cheaper already now from October. It is one of the products that will, in frozen form, come down to zero immediately. So for the Indian consumer, there will be more salmon, and we also see that the seafood exporters from Norway are really looking to India, because also other seafood products will gradually come down when it comes to tariffs, and then hopefully be cheaper here in India. There are also, of course, other products from other EFTA countries, like watches from Switzerland, for example. And then there are a lot of products that we don't see as consumers that go into machinery in factories and different production.
Moving on, the Union Cabinet hiked the minimum support price for 6 Rabi crops by 4% to 10%. The MSP on wheat has been hiked by over 6%. The Cabinet also hiked dearness allowance of central government employees and pensioners by 3%. Ashwin Kumar has more.
Right, so important takeaway is that, and in terms of the outlays that we're looking at some massive figures. As far as the MSP is concerned, bear in mind that the total MSP that the Cabinet has approved, the outlay that has been approved, is over 84,000 crore rupees. The government says that this is an annual exercise in terms of increasing the margins on offer as far as the farmer community is concerned, going on to say that the government is looking at procuring nearly 300 lakh metric tons. That's the volume of procurement that the government is looking at. But that's only one part of the story. That's the first big slice of the pie. That's over 84,000 crore rupees. The other, of course, is that the Cabinet approval has been granted for an outlay of 11,400 crore rupees, and that is essentially for more Atmanirbharta as far as the farm sector is concerned. Here, what the government is looking at is increasing the yield per hectare. The government is also looking to increase the total acreage in terms of the total productivity that we're talking about. It is also looking to, in fact, introduce fresher seeds, have more R&D. There are 1,000 labs that the government is hoping to initiate, to commission, which would allow for greater R&D in the farm sector. The total outlay for that is 11,400 crore rupees. And here's the third key takeaway, and this will be a big boost for government employees. What we're given to understand is that the Cabinet has granted approval for over 10,000 crore rupee outlay. This will essentially be an increase of DA of 3%. This will directly impact as many as 50 lakh central government employees and over 67 lakh pensioners. So a big boost coming in for central government employees as well.
All right. Thank you very much, Ashmit, for joining us. Moving on to a very important story. GST collections in September rose 9.1% to 1.89 lakh crore rupees on an annual basis. Collections between the April to September period also rose over 9%. Timsi Japuria joins us now with the biggest takeaways. Timsi, over to you.
Well, if you look at the numbers closely, the gross GST collection data, that is the gross GST number for this particular month, has shown a rise of 9.1% year-on-year, that is for September, to 1.89 lakh crore rupees. First up, let me clarify for our viewers that the September numbers corresponding to the transactions that were carried out in August and are reported last month. So it has nothing to do with the post-GST rate cut performance when it comes to the screen right now. So as of now, that particular data will actually be visible in the numbers next month. And now coming back to the numbers for September that were reported today by the government, well, this comes on the back of 1.73 lakh crore rupees that was collected in the same month last year. That is for business activities conducted in August, reported in September, and officially released on 1st of October last year. Meanwhile, what experts see through these numbers, they say that the increase in gross GST collections to 1.89 lakh crore rupees for this particular month indicates that there has not been any significant slowdown in the economic activity, which was the anticipation that the government had and even the experts had, given which there was the entire exercise of GST rate cuts that was being announced by the government. So during the month of August, the data did not show any such hints, or to be precise, the data did not reflect that there was any slowdown, because of which the GST rate cuts were needed. On the other hand, when you look at the overall performance so far, that is of this fiscal between April to September this year period, the gross collections reached 12.1 lakh crore rupees, up at 9.8% from 11 lakh crore rupees during the same period a year ago, accounting for around 55% of full year collections that were expected in FY24. When it comes to the net GST revenue during the 6 months, it stood at 10.4 lakh crore rupees, marking an increase of 8.8% from the corresponding period in the last year. Now, what will we watch out for in the upcoming GST numbers will be how the numbers actually reflect the performance of the country in terms of consumption boost. Will these numbers be able to capture the initial hiccups that were there till the rate cuts were announced? And yes, post 22nd September analysis that will be there in terms of is there a pickup in the consumption or not. That is something that we'll have to watch out for in the numbers that will be reflected next month. Whether they'll be healthy or not, that is something that the expectations are that they are likely to come back to a growth range of double digit, something that we'll have to watch out for.
All right. Thank you very much, Timsi Japuria, for explaining us the GST numbers for September and the outlook going forward. With that, it's a wrap on this edition of News Center. More news and updates continue right here.
Let's talk money.
Hello and welcome to a brand new edition of Let's Talk Money. Well, the festive season is here, and let me start by wishing all of our viewers a very prosperous and happy season filled with celebration, laughter, and good wishes and good vibes. So here's a big shout out going from the entire team that puts this show together to all of our viewers. Now, this is that time of the year when we really feel like rewarding ourselves and our families. And why not? We've all worked hard through the course of the year. But the tricky part is, how do we do this without breaking the bank or without breaking our PF plan and entirely tearing it apart? When helping us perform this very tough and delicate balancing act this season is Harshvardhan Rungta, who's of course a certified financial planner himself. Harsh, thank you so much for joining in. Looking great. Greetings of the festive season to you as well.
Thank you so much, Surbhi, and greetings to you and all our viewers for that.
Thank you so much. So the season has only begun with the whole Navratra and Dussehra excitement, and it's all the way up to Diwali, right? And let's face it, when we all want to, this is what we try and save up for or reward ourselves for. And this year you have the GST cuts, etc. So generally there's a feel-good factor in the air.
Absolutely, and in fact, the primary purpose of earning is to support your family, to spoil them, to spoil yourself. So if it's well within reasonable range, I mean, why should you not spoil yourself and spend for yourself? I mean, what else are you earning for otherwise?
This is where it's tricky. When you talk to planners, they say, of course you should go and spend, of course you should enjoy yourself, but within the rules and within the reasonable limits. So okay, let's start with this, what are these reasonable rules of spending that you adhere to?
So see, very simply, Surbhi, I mean, there has to be, when you're planning, okay, when you're creating your financial plan for that matter, you keep some spoil me fund, okay?
A spoil me fund.
Yeah, of course. I mean, why not? I mean, every individual has aspirations to own something that they like. It could be watches, it could be shoes, it could be pens, it could be cars, bikes, it could be anything for that matter, right? And if you're going to put in so much of effort to earn, there are a lot of sacrifices that an individual makes, right? Now, if you're not going to be able to do or rather spoil yourself during your earning years, then it doesn't make sense, right? The level of dissatisfaction is going to always be there. Now, the trick is what? You should also know one fact for sure. There are some things that you can do when you're in 20s. There's something you can do in 30s. If you postpone that for 60s, it's not going to help you. Right.
So you're sounding very encouraging. I like this idea that spend. You should spoil yourself to an extent. But what is the spoil me fund? I mean, you have an emergency fund, you have the investment corpus, and you have the retirement fund. Now, where is the money then? What to put in the spoil me fund?
Exactly. Now, this is where early planning comes into play. So take an individual. Okay, so we're talking about people who are just getting into workforce, for example. So they are like, say, 20s. They're in the mid 20s. And at that point in time, if you instill a good discipline, which to say that whatever you get in your hand is net of TDS, like tax is already deducted and you get in your hand. You deduct another 20% out of it to say that this money is not coming into my hands.
Okay.
And that 20% is essentially for all your plans. So it could be short-term emergency, it could be your short-term goals, long-term spoil me fund, holiday fund. It could be anything.
Okay.
Now, if you started early and you started in the right manner, then you will be able to achieve all of this all throughout your life.
So 20% of your take-home salary needs to be completely set aside for a proper PF plan.
Yes.
Which will include a lot of these factors: retirement, short-term goals, spoil me fund, if I got you right.
Absolutely. So, in fact, that's the whole idea, because if you cannot save 20% of what you're earning today, imagine a time when you have no income. Then how are you going to fund yourself? So if you can't even set aside 20% today, it's going to be a big disaster going further when you have no income coming your way.
It's a very reasonable ask. I must say that compared to, and we have so many experts and planners coming on the show, some really scare us. But I think saving 20% from your income every month and then investing it right, saving it right, putting it in an emergency corpus, etc. I think that's a very reasonable ask. So it's a good place to
Just
start.
one correction here. 20% is for those who are in the 20 to 30 years bracket.
Oops. Okay.
So
there's the catch.
So if you miss that bus, or rather if you've already missed that bus and you're in your 30s, then the percentage saving has to go up.
Okay.
Because you missed that 10 years of the golden period of compounding as well. If you get into your 40s and 50s, then the percentage saving has to go up. So that's the price you pay for delay, is what we will talk about.
For those who lived the good life throughout their 20s, didn't adhere to your 20% savings rule, in the 30s, how much do they have to set aside?
Probably 30 to 40%. But that's the price you pay for not starting early, right?
For not starting early. Fair enough. So start early, start saving, start investing, and then you are allowed to spoil yourself, says our expert. So we have something very interesting that we're going to do on the show today. They say that, charity begins at home. For us here at CNBC-TV18 on Let's Talk Money, financial planning also begins at home. So what we've done is that we usually take a lot of questions from our viewers, but for the purpose of this show and this season, we had a fair amount of in-house queries coming in, Harshvardhan, on how do I decide whether I can afford this festive season. So we have a couple of my colleagues, and they were kind enough to, actually let it out.
Oh, great.
But I really want to get to the questions. With your permission, should we start?
Yes, of course.
Okay.
I'd love to hear what they want to do, because I'll be meeting them off the camera.
Absolutely,
and
yeah.
this time, yeah.
Then you can grill them more. So, okay, let's kick it off. Parag, who's the force behind our ticker team, he's joining in as he's planning his festive shopping and his festive splurging spree. Parag, what do you have in mind?
Hi, Surbi. Just the festive season is coming, so I'm looking to buy some jewelry, platinum jewelry in specific. It will cost me around 80,000 bucks. So,
wow, lucky, the lucky lady in the life. I don't know whether it's a special someone.
Currently,
whoever.
it's just my sister, Surbi, but soon I can give you another good news soon.
Oh, wonderful, wonderful.
Yeah.
So platinum jewelry worth 80,000. But I'm very sure Harshvardhan will want more details. Some idea of your annual income. It could be salary, interest, whatever, all your income sources put together, and some idea of your expenses and current investments or savings as well.
Certainly, I'll give you a little bit of an idea. So my annual income is around 16 lakhs. Monthly expenses comes around 10,000 bucks. And other than that, I have at least 6-month coverage in case something awry happens. So these are my specifics, if you have any suggestions regarding that.
What a good boy, Parag, huh? Managing to limit your monthly expenses to 10,000.
Yeah,
I want to run away. I want to hide under this table right now, but Harsh, you heard him. He's looking for, spending 80,000 rupees on jewelry this year.
So, well, Parag, congratulations to you. I mean, I'm surprised myself that you can sustain with a monthly expenditure of 10,000 rupees.
I try my best.
I think Parag should take a session on how to live
within your means, how to live frugal,
So there are two elements to this. One, of course, it's a gift that he wants to give to his sister. So I think that's a good emotion. That's a good gesture for that matter. Considering looking at platinum, I think he's smart again. Because had it been
he's not chasing gold.
He's not chasing gold. Because gold has, I think, just gone through the roof and through affordability quotient of many people. So I think platinum is a good idea. And if you look at the numbers, okay, so earning an X amount, spending Y, that he's already mentioned, I think there's enough room for him to at least take this plunge for something like this. Platinum again. Okay, let's put it into two different categories again. You would have some purchases that would be depreciating assets.
Yeah.
Okay, some would be appreciating in that context. So platinum also falls in that category where over a period of time you're expected to have an appreciation in the value as well.
But this is not an investment, right? We need to make that distinction that since this is a gift and that to jewelry, it is not looking at precious metals like platinum from an investment angle.
No, so we're talking about the sensibility that goes behind buying something. So if you're buying into, say, platinum jewelry, for example, so one, of course, it serves that emotional quotient that we're talking about. I mean, it's a gift to sister, of course. I mean, great thing to do. The other is it's also not a highly depreciating asset. So in case tomorrow, in future, for that matter, if his sister wants to liquidate, there is free liquidity to that extent. So I think, given the income expenditure, given what he's buying, the quantum, the size of the purchase, which is 80,000 rupees, Parag, please go ahead. I mean, you've all the liberty to go ahead and spoil yourself and your sister for that matter.
Wow, well done, Parag. You're getting a full thumbs up, and our planning expert is telling you, giving you the green flag. Go ahead and enjoy the festive season. Thank you so much for joining in. I'll let you get back to work. Okay, I think we've got Ishita joining in as well. Okay, Ishita will join us in just a bit. She's got some ideas. Now, I just want to ask you here that appreciating assets are very few. I mean, you'll come down to gold, silver, maybe someone wants to book a house, fine. But largely, otherwise, festive spends are all depreciating in nature. Whether it's a car, whether it is a pair of new shoes, whether it's, a fancy new 60-inch TV. So then how do you, look at the expense versus the return?
So, Surbi, there is a cost-benefit analysis. The value is, if you're spending something, what is the value that you're getting? Okay, so if you're buying into a very large television set, as you mentioned, why are you buying that large television set? Okay, and if you're buying it for say some sound quality, or you're looking at some the quality of the picture, etc., then you might want to go in for a branded, a high value item for that matter. I'm not taking names of the brands because we don't want to get into that zone. But if you're looking for a large TV which does not have a top end feature kind of a thing, then you may possibly look at something which is reasonably available at a lower price. With the same size. If you're a gaming enthusiast, then you might want something else in that television. So I think most of the buyers miss that point as to what are you paying for and what are you getting.
Ask for the specifics. Why do you really want it?
So
and whether it's worth the price.
There's something called features, benefits, and advantages. So every feature will have certain benefits, but do those benefits really are advantages to me?
Now I think our next participant will really want to talk to you about this. I have an inkling that she's looking at a phone, but let's find out more. Ishita, who's such a vibrant member of our production team, our desk, which puts all the amazing market content for you together through the course of the day. Ishita, go on. Welcome to Let's Talk Money. Great to have you as a participant. What do you want to buy this season?
Well, thank you so much for having me, Surbhi. I am actually, as you mentioned, looking to buy a phone, specifically an iPhone. I'm planning to upgrade my phone to the new iPhone 17 Pro Max. My salary is in the range of 12 to 15 lakhs, and my monthly expenses come up to 40 to 50,000 with the rent and all the other expenses. I do have some SIPs and a few savings, and I don't have any EMIs, but given how expensive the iPhone is, I was wondering how I can go about it.
Yeah, good point. Ishita, just wondering, your SIPs and whatever you manage to put in as monthly investments, roughly what would that amount be? 5,000, 10,000? How much are you able to invest every month?
I think between 5 to 10,000, that's a good range.
That's what you do every month. Okay, all right. Thanks. Let me ask Harshvardhan what the right approach is. Now, what we were just discussing, Harsh, the cost-benefit analysis. For someone my age, I mean, I'm still on an Android, and you can convince me, saying you really need it, and it's okay, phone to phone hai. I mean, how much do you need? But Ishita is from a very different generation, right? So iPhone 17 Pro Max.
So, well, I'm on Android myself, and
we're outdated.
We're outdated, I guess. And see, again, with Ishita's specific case, I mean, understand a few things. The income is, between 12 to 15 lakhs. The phone that we're talking about is the top-end model of the new launch. Okay, so that's about 1.5 to 2 lakh rupees. Now, if you compare it from the expenses that she incurs every month, it's almost 5 months' expense. If you're going to buy this phone, it's equivalent to 5 months of your monthly expenditure. And she says she wants to upgrade. So the real questions to ask would be, why do you want to upgrade? Is your existing phone not serving the purpose? Is it that you like the new design, color, or you just want a latest phone in your hand? Well, all in all, I would want to disappoint her a little bit to say that doesn't sound like a very fine advice. I mean, decision to make. I mean, she should avoid this kind of a purchase at this stage, because if you also notice, we discussed the quantum of SIP, which is 5 to 10,000 rupees. Well, there is really a lot of scope to increase that. If we talked about 20% of the income take home should be investments. Now, if she's taking home, say, about 1 lakh a month, the investments are only to the extent of 5 to 10,000 rupees. Now, that has to go up to 25,000 rupees at least. So if you spend this kind of money on a phone, then you're squeezing yourself and depriving your own self of future needs that you may have.
Here, just a quick follow-up question, because I'm very sure Ishita has already done the search, but a lot of these, high-ticket electronic items are available on financing as well. And financing offers tend to be very lucrative right now, zero-cost EMI or, bare minimum, take the phone for 2,000 rupees a month and things like that. Could that be a way of not disappointing yourself and somehow managing that EMI along with your SIP?
Not really, because, I'll tell you this, the loop of EMIs and buying high-ticket items on loan and equating your purchasing ability with EMI capabilities. I think that's the wrong thing to do. So we usually see people doing this for even cars. They'll go in for a mid-size car and then say it's a 3-year loan and your EMI is 50,000, for example. Now, the salesman has understood that you can pay 50,000 a month. So he said, why don't you take a 7-year loan with 50,000 rupees, but upgrade your car? So the buyer is always thinking that, okay, I have to pay 50,000, which I can afford.
Yeah.
But in the bargain, you're extending your loan tenure from 3 years to say possibly 7 years.
Yeah.
So eventually over 7 years, you're going to pay more.
Yeah.
So I think, you should respect your money very well. Very seriously, you should take what you earn because you spend a lot of your effort behind that.
Let me ask Ishita if she's convinced. Ishita, sorry, but the advice from the expert here is that maybe not right now. What do you say? Are you convinced?
Oh, well, it's a very sound advice, and I'd love to even take in their words into consideration. So definitely I'll take their advice into consideration.
Okay, so more on the SIP, less on the iPhones, the other eye. More on the investments. All right, thank you so much, Ishita, for taking out the time for us. We'll take a very quick break. One more colleague joining up on the other side with another interesting purchase idea. We're doing in-house planning 101, and remember, these are all lessons for all our viewers out there. These are internal case studies, but they apply to each and every one of us so we can make smarter budgeting and spending decisions this festive season. Back after the break.
Let's talk money.
Welcome back. You are with the festive special edition of Let's Talk Money. And this week, we are gearing up all our viewers to make smarter spending decisions this festive season as we get set for Diwali. So the next 20 days promise to be really, really exciting. You've been hearing from a couple of our colleagues. And now it's Gaurav's turn. Gaurav, of course, is no stranger to financing or financial institutions. He's part of our research team and he tracks that sector so closely. But Gaurav, I completely hear you, because when it comes to our own money, our investment and spending decisions, then we can do with some guidance, right? Myself included. So you tell us, what's on your mind? What are you buying this Diwali?
Well, Surbi, yes, I always had an aspiration to buy a 650cc sports bike, and it is going to be a bit heavy on my pocket because it's cost around 7 to 8 lakhs. So definitely, I need some kind of advice how to go about it, because it's going to be a bit heavy on my pocket, to be honest.
Yeah, absolutely. So you already know what's happening with interest rates, Gaurav. I don't need to tell you that. Hopefully, they're all going lower. But yeah, just help our expert out. Harshvardhan is here in the studio. Just help him out with your current expenses, overall, income, lifestyle, and some idea about your current safety corpus or your current investments as well, so he can do the plan.
So currently, when we look at my total income, it is somewhere between 15 to 20 lakhs, and the total expenses, when we go about it, it is somewhere around 60 to 80,000, because it also includes my rent and other expenses. I have an EMI, which is a small portion of it, which is around 20 to 25,000. And apart from that, I need a safety margin of around 6 months of my income, which is around 3 to 4 lakhs is what I'm aspiring to keep. And when we look at the investments, I do my SIP somewhere in the range of 3 to 4 lakhs per annum. So definitely, that is all what I'm doing right now with my finances.
Okay, so hang on. So assuming that the annual income is, let's say, 20 lakhs, you are now looking to create that safety corpus, right? That, worth 6 months' salary. You're looking to build that. In addition, you have an existing EMI also running.
Right.
So total monthly expense is how much?
Monthly expense
all of
goes
this
somewhere in the
together?
range of 60 to 80,000.
Including your SIP?
Yeah.
Okay, all right. Harsh, now help him out. Big, fancy bike.
Yeah,
7 lakhs, 8 lakhs.
Yeah, so, if you look at the numbers, I mean, given the annual income, given the expenditure, including EMIs and your savings, I think it's a healthy savings rate that he enjoys today. There's only one area that needs some bit of attention, is that he wants to create the emergency corpus.
Yeah.
So, and he's conscious about it, and I'm hoping that he would work very actively towards it. Now, given these parameters, I mean, and also, the aspiration to own a luxury bike, also, okay, there's another rule that we try and follow when it comes to buying vehicles, okay? So cars, particularly, if you are somebody who holds your cars and keeps it for up to 10 years, then you can consider buying something worth equivalent to 1 year's income. 1 year's
annual income.
Annually.
So the car you want to buy is not necessarily the one that James Bond was driving, but affordability is one year's annual income.
Yeah, so in this case, if Gaurav was buying a car, for example, he could go up to, and if he's intending to keep the car for 10 years, then he could buy something in the range of 18 to 20 lakhs.
Okay.
Now, if you're somebody who keeps a car only for 5 years and then you keep switching, then you should target to buy a car equivalent to 50% of your annual income. So in this case, it would be 10 lakhs.
10 lakhs.
I'll tell you
and
why.
what are bikes? And does the same rule apply to bikes?
So bikes, usually come, don't really cost 7 to 8 lakhs, right? So
in his case?
In his case, it is because, it's like an aspirational luxury purchase kind of a thing. Now, keeping everything else in mind, I mean, I think he can go ahead with the purchase if he wishes to. Just one condition, and it's a luxury bike. So I don't think he's going to flip it over in 5 years. So he's going to keep it for longer, I believe.
Let's ask him, Gaurav, are you going to keep it at least for 5? I wonder, where will you ride it? On Mumbai city roads.
You're absolutely right, but this is just an aspiration. And being a man-child myself, I think it is going to be something that I'll keep forever.
Oh, lovely.
So, so in vehicle purchase, there is something called a total cost of ownership concept.
Yeah.
So what you buy is not your total cost. I mean, it's going to be what you're going to spend over a period of time.
Absolutely.
And so I think given all circumstances, I think, Gaurav, you can most certainly go ahead with this purchase. Just ensure it's a double seat at least. I mean, you
we want to ride as well. We're coming. You want to see which one it is.
Definitely, I'll make sure of that.
Good luck with those plans, Gaurav, and treat. Make sure the day the bike is booked, we need party in the office. So yeah.
Sure, I'll do it. Yeah.
Absolutely. Thank you so much for joining us.
Surbi, you plugged yourself into the double seat. It was probably somebody else that he had in mind.
वो तो होगा. It's okay. We also need one ride, na? Some
Absolutely.
fancy set of wheels that he's going to get. But coming down to final thoughts. So you mentioned this rule of 2 in the break, Harsh. It helps us decide whether we can afford something or not. Just explain, what is this rule of 2?
So, Surbi, whenever you're looking to buy something which is in the luxury segment, it is in the aspirational purchase segment, you should always apply the rule of 2. Now, what is that? So, suppose you, like for example, if Ishita is planning to buy an iPhone, the question she should ask herself, can I afford 2 iPhones right now?
How you're struggling to figure out financing for one?
Exactly. So, if you cannot afford 2 at one time, then you can't even buy one.
Oh.
So, like for example, if you're buying a luxury car, so we had somebody come up to us and say that, look, I want to buy a top-end BMW. So I said, can you buy 2 of it right now? So he said, no. I said, luxury items, if you cannot buy 2 at one time, then you should not even buy one.
Oh.
I'm not saying if you can afford 2, which means you go and buy 2. How do you equate yourself? How do you ask yourself that kind of question, that is it a right purchase, whether I can afford it or not? So the rule of 2.
Okay.
So if you're aspiring to buy a large television for that matter, it's not for only just viewing news channels, it's more for having fun. You ask, can I buy 2 of it right now? If you can, then go ahead. If you can't, then please don't go ahead. So that's the rule of 2, just trying to give you some sense whether you can afford that luxury that you're looking at or not.
I need to go back and recheck my entire math for my festive spending now with this whole new rule of 2 that you've brought in. But a great session. Harshvardhan, thank you so much for joining in. This was fun, but it was also very informative. It helps us think right when it comes to our indulgences, our shopping spree this season. So thank you very much for joining in.
My pleasure. Thank you.
Well, viewers, hope this has been helpful. Hopefully it gives you some sort of a thought framework when you look at how to spend your money, hard-earned money, wisely, and have lots of fun this season. Once again, wish you season's greetings, and we'll be back with more on Let's Talk Money next week.
Let's Talk Money.
Hello and welcome to Business 360. I'm Archana Solanki. Here are the headlines we're tracking this evening. Monetary Policy Committee holds key policy rates as expected, but signals that inflation undershooting earlier expectation opens up for space for more cuts. Later, economists factor in a cut in the December policy. In a first, RBI allows banks to finance mergers and acquisitions, removes lending restrictions on large borrowers with more than 10,000 crore rupees of exposure, also eases rules to allow more infra financing by non-banking financial companies. RBI announces a 4-year glide path for banks to implement expected credit loss framework by March 2031. Move will smoothen the impact of higher one-time provisions. Also proposes to ease capital adequacy rules, especially for MSMEs and mortgages. Removes overlap restrictions on businesses of banks and their group entities. Capital markets get an unexpected bonanza. RBI hikes the limit on lending against shares from 20 lakh to 1 crore rupees. IPO financing limit more than doubled to 25 lakh per person. Removes the ceiling on lending against listed debt securities like REITs and InvITs. Bank stocks lead the rally on the last street as Sensex and Nifty snap an 8-day losing streak. Rupee gains strength against the dollar. 10-year bond yields rise. Gold prices hit another record high as the demand for safe havens remains strong. Weak dollar and expectations of more Fed rate cuts boost sentiment. Prices of silver and other precious metals also rally. Union Cabinet hikes the minimum support price for 6 Rabi crops by 4% to 10%. MSP on wheat hiked by over 6%. Also hikes dearness allowance for central government employees and pensioners by 3% with an outlay of over 10,000 crore rupees. The US government shuts down for the first time in nearly 7 years. The Senate fails to pass a bill to extend federal funding. National parks, museums and select federal agencies to shut down. Thousands of federal workers face furlough. Pharma giant Pfizer strikes a deal with the Trump administration to cut costs for some prescription drugs by up to 85% in the US. Offers the most favored nation pricing and earns a tariff reprieve for 3 years. The deal also includes a $70 billion investment commitment. US President Donald Trump gives Hamas a 4-day ultimatum to accept his 20-point peace plan for Gaza. Plan includes an immediate end to military operations in Gaza and the release of all Israeli hostages, but it's vague on statehood for Palestine. All right, the top story this evening. In an expected move, the RBI Monetary Policy Committee has decided to keep the repo rate steady at 5.5%. All 6 MPC members voted to pause the rates. However, the decision to retain a neutral policy stance was not unanimous. The RBI has increased the growth forecast for FY26 from 6.5% earlier to 6.8%. However, Governor Sanjay Malhotra said that the tariff and trade uncertainty may lower external demand, posing downside risks to growth. Meanwhile, the inflation forecast for FY26 has been lowered from 3.1% earlier to 2.6%. Inflation forecast for the first quarter of FY27 has also been lowered to 4.5%. The governor said this opens up space for policy action, hinting at a rate cut in the future. Governor Malhotra said the GST rate cuts will have a sobering impact on inflation and will push consumption. However, he warned that the outlook remains clouded due to external uncertainties. The governor also addressed the rupee depreciation, saying that the RBI is keeping a close watch on the currency and will take appropriate steps as warranted. Here's the governor on the room for future rate cuts.
There has been a significant moderation in inflation. Moreover, the prevailing global uncertainties and tariff-related developments are likely to decelerate growth in H2 this year and beyond. The current macroeconomic
Welcome to our monetary policy special. Well, the Reserve Bank today did not cut rates, but it clearly said that because of the sharper than expected fall in inflation, it gives them more space to cut rates going forward. Bond yields actually rose after the policy, obviously because there was no cut. But there are still two views on whether the RBI is likely to cut more than once, because the RBI very clearly said that it has, the lower than expected inflation allows space. It didn't say limited space. So there are those interpretations. More importantly, there were a bunch of steps that the RBI announced to remove constraints on banks in the process of giving loans. They can fund acquisitions, they can lend more to large groups, they can lend more to capital market players and against shares. But, let's first discuss the monetary policy issues. I have with me two economists, Samiran Chakrabarti of Citi and Mridul Sagar, a former MPC member and, of course, formerly ED with RBI. I also have with me Shailendra Jingan, who heads the Treasury at ICICI Bank, our bond expert today. Gentlemen, thank you very much indeed for joining me. Samiran, first up, I repeatedly asked the governor, you're not saying limited space to support growth, you're saying space to support growth. Should we interpret that there is more than one cut in the offing?
So I think in our view, we are now firmly in a wait and watch mode. Whether the space is going to be available in the December meeting also will depend upon a lot of macro and external factors which can play out between now and December. We have to see how the GST cut is going to play out in the festive season, how it's going to play out over the next couple of inflation prints. And then we have to also see how the growth numbers are responding to the tariff-related issues. So that way, when RBI goes into December, it will probably have a better idea of whether that space still exists. Because as the governor and deputy governor has repeatedly mentioned, that monetary policy is forward-looking. So in December, when RBI will be looking at 1 year ahead inflation forecast, that's for December quarter 2026, their current forecast is of CPI at 5.1%. It's partly due to base effect, but to communicate a rate cut based on real rates argument in December might become more challenging. So in some sense, one can argue that unless there is space for at least 50 basis point of rate cuts, or unless the growth shock is more significant, the RBI might have to go for a more longish pause at a relatively low interest rate and extend the cycle rather than going for deepening the cycle.
So at the moment, you're not expecting a cut in December?
We are on a wait and watch mode.
Okay, fair enough. My experience so far, and it would be yours as well, that the MPR, Monetary Policy Report forecasts have less significance. When they enter the monetary policy statement, they become more significant. In the past, those forecasts are there, but they are not given that much importance. Mridul, would you agree? And if you want to take the MPR forecast for the fourth quarter is 3%. I mean, 3.9 or something, below the 4% mark. So, Mridul, again, same question, rate cut expectation?
So Lata, for a 1 year horizon, the MPR forecast match the MPC forecast. So there is no question that the two are different. It's only when it gives a 2 year forecast, obviously the uncertainty is so high that you have to give a lesser weight to that. But whatever the numbers they have put out, whether on the 1 year basis or a 2 year basis, the real policy rate looks very much in alignment with the neutral rate. Now, basically, this doesn't rule out a cut because if obviously growth falls and there is downside risk to growth, but the baseline looks pretty solid, we don't have it still in the data. I think Poonam Gupta beautifully put it in communication in the press conference when she acknowledged that Q1 growth surprised on the up, but recent weakness is there and inflation is giving some headroom for further cuts if it becomes necessary. I think we should take it on the face value of it and not try to firmly predict whether there would be a rate cut in December or not. There are lots of things coming up to December. The situation will
okay,
become
not
clearer.
Not December, but surely you see one rate cut ahead?
At best, one is with a high probability, but suppose we all mistake it and there is some global headwinds which are there. And if it percolates more globally, forget India. India can manage the shocks it is receiving with some downside on the growth. But if the whole things get pretty complicated in terms of asset bubbles forming and getting burst and putting growth down, you can have more than one rate cut. Nothing is stopping that.
Fair point. Okay, Shailendra, the market sulked. You saw the 10-year go almost to 6.6%. What are you all taking home?
So the market, Lata, was sulking till the time the RBI press conference started. I mean, post the RBI press conference, I mean, market, took a signal that, RBI is looking at bond deals. I think till now, the understanding in the bond market or the thinking in the bond market was that, the transmission is working well through the banking channel and, through the cuts in the EBLR rates, etc. And, GSEC market previously, when, RBI was asked, I mean, there were other factors which were highlighted in terms of demand and supply. And today, I think there was some hint given by the governor that, bond yields could be somewhat lower. So I think that was, and they are considering certain things. I mean, of course, he spoke about, about the auction calendar, etc., and the state loan supply. So I think that is where the bond market started taking a positive signal. Till the time, even when, in the policy, there were hints that one more cut, a cut could be coming in the future. But that didn't move the needle for the bond market. So I think the bond market was looking at specific action to, address the demand supply gap. And that came in the press conference. And since then, I mean, the yields are down by about 5 or 6 basis points.
Okay. Well, what did you make of the comment on the rupee, Shailendra? Normally, the RBI says, we only control volatility. This time, he seemed to show more concern and intent to intervene. Any takeaways?
So, no, our sense is that RBI is still, the data at least we have, since December 24, RBI has been more tolerant in terms of, the movement of the currency. And we think that that is likely to continue. But I agree with you that today was probably the first time that, we got a signal that, probably they won't tolerate too much of depreciation from here on. Because, I mean, if you look at even, some of the valuation metrics like RER, I think this is the lowest level. So we have come below 99 on RER. And this is the lowest level, I think, in the last 3-4 years. So in a way, I think probably they feel that, a lot has happened on the rupee. But, if the capital outflows continue, I mean, we are seeing continuous outflows on the equity side. So I don't think they will stand in the way of some depreciation, but probably they don't want rupee to fall too much. I mean, that's the sense we.
That was the take home. Samiran, what did you make of you referred to the inflation forecast. The Reserve Bank has been seriously overestimating inflation, which they themselves admitted. From 3.7, they have come down all the way to 2.6. And when I took a poll, the market is actually sitting at 2.4 or 2.5. That was the average I got in terms of this year's CPI. Going forward as well, 4.5% for the April, May, June quarter. There are still people on the street who are giving me a lower number. Do you think that we will continue to see actual inflation undershooting RBI forecast?
Just first answering the last bit of your question, which is a more technical one, is about this the Jan-March quarter forecast being suddenly up to 4% versus the 1.8% in the October-December quarter. I think it's because the market might be anticipating a similar drop in seasonal food prices that happens in the winter months. But this time, since the vegetable prices did not go up as much during the summer months, the decline might be much lower. And maybe RBI has factored that into their forecast, and that's why getting a slightly higher inflation number for that quarter compared to the street. But I think the bigger question is about this sustained over estimation of the inflation numbers in the last few years, vis-a-vis a sustained underestimation of inflation during the COVID and the Ukraine war periods. So one possibility is that there is always this adjustment bias that forecasters have, and RBI might now be adjusting a bit more on the downside. So what I'm hinting at is that this year, particularly, we have seen globally, particularly in Asia, a significant lowering of inflation numbers across countries. So next year, if on that low base, if inflation starts picking up everywhere else, then we could also be impacted by that. And similarly, all the stimulus that we have given this year, if the stimulus, they have their intended result in boosting demand, then one can obviously expect that to some extent the inflation momentum will pick up also. And on top of it, we have this very peculiar situation where next year we're going to have a completely new inflation index.
Exactly.
So because of all this, forecasting inflation so far ahead now is becoming notoriously difficult. So I have full sympathy with that view. But yes, it is going to be a challenge for RBI, even in the December policy, that how much emphasis do they put on this 1 year ahead inflation forecast vis-a-vis looking at more near-term inflation dynamics, and then take a call on the real rate.
Got it. Actually, out of time, the SBI chairman will be joining in shortly. Mridul, a very quick question. Do you think the Reserve Bank will also be conscious that the real GDP looks good because of technical factors like, you're deflating 60% of the inflation with WPI? So actually growth is not so good. Do you think there is an underlying admission there, but they can't say that I don't trust the GDP?
So obviously everyone knows where the problems of statistics lie. And by maybe January or February next year, we'll have clarity on these numbers when new series for GDP and IIP following that would come in. But on the inflation, let me say that the RBI has reduced the Q4 forecast from 4.4 to 4%. So in a sense, they're also sort of correcting that bias upward, which existed earlier. Now, we don't know exactly how much confidence to give, but they have given confidence interval bands for the last quarter.
Yes.
And that really shows that there is uncertainty about that inflation. Now, the issue is, do we factor it into policy right away? And RBI clearly communicated with 2 cuts in June that they have done what they needed to do. And they're standing by that. And probably a reassessment could come in December. Yes, between the GDP and GVA, there is discrepancy. So that's well known. But even the GVA growth is not so bad.
That's true. No, that's true. That's true. I mean, I'm not saying it's bad at all. In fact, it's very good. They have advanced capex plans, the government, they have advanced exports. So the number is good. It is just that, is it 7.8? That was the question, really. Okay, gentlemen.
In addition, it's the financial regulation side. They have supported growth in lots of fashion.
Absolutely. And that's what I'm going to discuss.
And in fact, I'm worried whether our supervision of the RBI will rise to the occasion to see that the new system works well.
Okay, well, actually, let us ask the SBI chairman those questions. Samiran, Mridul, Shailendra, thank you very much for joining me. It had to be quick because this is really a credit policy. It's a banking policy and probably less a monetary policy. So those questions to the SBI chairman in a minute after the break. Thank you, gentlemen.
Hello and welcome to Startup Street. I'm Shruti Mishra. These are the top headlines from the startup space. Axel Bagged Infra Market has filed for an IPO worth 5,000 crore rupees through the confidential filing route. The issue is expected to be split evenly between fresh equity and an offer for sale by existing investors. Grow XCD Finance, a startup lender to small businesses, has raised 200 crore rupees from Blue Earth Capital and Process Ventures. Blue Earth Capital led the round with 105 crore rupees, while Process invested 70 crore rupees. This funding will support the next 12 to 18 months of business. Mishmash Naturals, an Ayurvedic beauty and self-care brand focused on children aged 3 to 14, has raised 2.4 crore rupees in a pre-seed funding round led by Inflection Point Ventures, IIT Delhi Angels Network and others. The funding will be used to expand their portfolio, invest in R&D and venture into UAE and other GCC markets. A federal judge has denied Apple, Google and Meta Platforms' requests to dismiss lawsuits claiming they promoted illegal gambling by hosting and accepting commissions from casino-style apps that addict users. Dozens of plaintiffs contended that Apple's App Store, Google's Play Store and Meta's Facebook promoted an authentic Vegas-style experience of slot machine gambling through an illegal racketeering conspiracy. Spotify founder CEO Daniel Ek will step down to become executive chairman in January, the Swedish streaming company said, as it adopts a new co-CEO structure in its strategy to fend off rivals and shore up its profit margin. Ek will focus on capital allocation and long-term strategy as executive chairman in what the company called a European-style role. Well, those were the headlines we've been tracking for you this evening on What's Brewing Today. Global SaaS company Wingify, the maker of its flagship experimentation and personalization platform visual website Optimizer, or VWO, today powers over 3,000 brands across 90 countries, including Disney, Decathlon and UNICEF. Now, with revenues crossing $60 million ARR in 2025 and profitable growth that drew the attention of Everstone Capital, which picked up a majority stake earlier this year for about $200 million, Wingify is now doubling down on global expansion, most recently entering the Middle East and Africa. Joining me now is Sparsh Gupta, the co-founder and CEO of Wingify. Sparsh, welcome to Startup Street. And let's start with VWO. It began as an A/B testing tool, but today powers large-scale experimentation, personalization, and AI-driven insights. Now, with features like, VWO Copilot, how do you see Wingify standing out in an increasingly crowded global SaaS market?
Thanks, Shruti, for having me here. First of all, I think VWO started off as one of the first self-service A/B testing software almost 15 years back. And in this last 15 years, I think what we have really focused on is on our product. And I think to stand out in the SaaS market, our product is going to be the key differentiator. There are two key areas where we are focusing on from a product standpoint. One is the breadth of our capabilities. And I'm very proud to announce that, we are the only A/B testing software, experience management software, which take care of the experience of a user online on websites and mobile apps end to end. And number two is the intelligence. There's a lot of focus on AI, that we are adding up, which means that VWO is no longer going to be just a tool which helps customers meet an end, but it's going to deliver the end outcome. I think these are the two differentiations largely. On top of it, our world-class support, which is going to make a difference in the market for us.
All right. Earlier this year, Everstone Capital acquired a majority stake in Wingify for $200 million. Sparsh, how has that partnership reshaped your growth playbook?
First of all, the team that built the Wingify for the last 5-7 years is exactly the team that's going forward. So there's absolutely no change in the team that built Wingify. What we have got is a lot more confidence and a lot more fuel to think bigger and move faster. There's a global expansion. We're just going out, expanding globally. There's a lot of enterprise play that we're building out. And then we also started exploring some inorganic opportunities. So I think largely, while the organic business has been taken care by the same team that built it, there are more avenues of going after enterprises and inorganic. That's really the playbook that we are following right now with Everstone Capital.
All right, Sparsh, like I mentioned earlier, Wingify today is a $60 million ARR company, and you've set your sights now on the $100 million mark. How soon do you expect to get there? And importantly, unlike many SaaS peers chasing top-line growth at any cost, Wingify has remained profitable while scaling. What's been the key to that balance?
So, while 100 million, we're looking at in next couple of years, we should be there. We are fairly confident about that. I think what gave us the profitability, what we built Wingify on is a lot of discipline. And last 15 years, every single time we took a decision, there was a lot of discipline around it. We built it in a way that it can be a very long-term play. And I think it's the same discipline which gives me confidence now that the investments that we're making right now across the globe in different verticals on product, on GTM, and everything else, I think it's all coming together that the growth is accelerating. The demand of digital experience optimization platforms is also going up quite significantly globally, and I think we're very well positioned, very well fueled, have a very well capable team out there to deliver on this promise. And along with that, there are some inorganic opportunities also that we actively are exploring. And if that happens, I think we're fairly certain that that 100 million next 2 years is fairly achievable for us.
Okay. Picking up from what you said earlier, you've just expanded into the Middle East and Africa. What is the big opportunity you see in these markets, and how do they differ from your more mature bases in the US and Europe?
So, Middle East and Africa is a very exciting market because the digital adoption is just happening at a remarkable pace. Enterprises are leapfrogging and want very modern stacks. And there's hunger to get some world-class experimentation and personalization suite. I think unlike the West that we saw in last 10 years, now they want end-to-end outcome. And I think it's no longer just demand for tools. It's also about that they want the experiences of every single person coming on their website and mobile apps to be highly optimized. And our Copilot, our VWO Copilot, along with the entire tool stack that we have, are very well positioned to deliver to that promise in the Middle East and Africa market.
Okay. Well, on that note, it's time for me to wrap up our conversation. But many thanks, Sparsh, for joining us on Startup Street, and wish you the very best.
Thanks a lot. Thank you, Shruti.
Moving on, in a big boost to India's MSME lending space, Chennai-based GrowXCD Finance has raised about 200 crore rupees, nearly $23 million in fresh funding. The round was led by global investors Blue Earth Capital and Process Ventures, with existing investors backing Low Capital and UC Empower also participating. Founded just 3 years ago, GrowXCD has already built a loan book of over 300 crore rupees and operates 60 branches across southern India. The company says the new capital will help expand its portfolio and deepen access to credit for underserved small businesses. Joining me now to discuss this further is Arjun Muralidharan, founder, MD and CEO of GrowXCD Finance. Arjun, welcome to Startup Street. How does this fundraise position GrowXCD in the highly competitive MSME lending landscape, especially against larger NBFCs and fintech leaders? Arjun, if you could take us through the gap you're trying to address here.
Sure. Thank you so much. First of all, thank you so much for having me here. First, we are talking about a very large MSME gap that is there in India, and the number of players that is required to address it, and especially aided with more technology and having a more customer-centric focus, that is really the space that we are trying to address. We are focusing on making sure that we can enable a very customer-focused, technology-first approach towards being able to address this gap that is there. Now, the MSME gap that is there right now is actually quite large in India. And if we are able to bridge this gap, that really enables faster growth and acceleration for all the small businesses, which will also aid in the growth of overall the economy as well. So this is something that we believe very strongly, that I think we have a very good, strong position and be able to also address this gap, which takes us to much more deeper markets as well.
All right. Arjun, what will be the key focus areas for the company as it deploys the fresh 200 crore rupees raised? How do you plan to use the funds?
No, I think first thing will be in terms of branch expansion. So we're currently at about 60 branches. We're planning to increase the number of branches. So it will be branch expansion and deployment of this and leveraging this capital, which will basically be able to access more customers. Currently, we have about 6,000 odd customers, and with this capital, we'll be able to reach a much larger number of customers across much deeper areas and across larger geographies as well. So it'll be branch expansion and also in terms of increasing the loan book through leveraging the capital that we have.
Okay. Arjun, given the company's rapid growth to a loan book of 300 crore rupees in just 2.5 years, what is the roadmap for scaling operations while maintaining asset quality? Also, what role will technology and data-driven lending play in GrowXCD's strategy to bridge the MSME credit gap in India?
Sure. First of all, in terms of our growth plan, we basically are currently at about 300 crores of assets under management right now. By the end of this March, we are looking to get to about 500 crores of assets under management. And by the next year, we are looking to, again, take that to, we have a 12-month to 18-month roadmap, before which we want to try and take this to about 1,000 crores is the numbers that we are looking to get to. So with that, with expanding to about another 40 or 50 odd branches, which will basically take us to a good number of branches across the southern states. What we will also be doing is, using technology and data and analytics to be able to understand how we can do the same, reach out to the customers, be able to assess the customers in a much more faster and a more efficient manner. At the same time, not losing the focus on making sure that we understand the customer segment, which basically may not have too much data points with them. So we are basically trying to create a model which will be able to use technology at the same time, keep our roots at the feet on the ground, and make sure that we can do the same.
All right. Arjun, with over 60 branches across southern India, what are GrowXCD's immediate expansion plans in terms of geography and customer segments?
So we will be expanding, deepening ourselves within the existing geographies. We are currently present in Tamil Nadu, Karnataka, Andhra Pradesh, Telangana, and also in Pondicherry. So our immediate focus will be in expanding within the existing markets. And in future, probably we'll be also looking at expanding to other states as well.
All right. On that note, it's time for me to wrap up our conversation. Many thanks, Arjun, for joining us on Startup Street, and wish you the very best with your aggressive growth plans.
Thank you. Thank you so much.
With that, it's time for us to head into a short break. But coming up next, jewelry brand Lucira secures $5.5 million in seed funding. And that's not all. It opens its first retail store in Mumbai this month and sets sight on omni-channel expansion. We're joined by co-founder Rupesh Jain to discuss the company's aggressive expansion plan. On the other side, stay tuned. Welcome back to Startup Street. India's fine jewelry market has a new disruptor. Lucira Jewelry, founded by ex-Candia entrepreneur Rupesh Jain, has raised $5.5 million in seed funding, the largest ever for a jewelry startup in the country. The round was led by Bloom Ventures and Spring Marketing Capital, with backing from Series 1 Capital Fund and Market D2C founders. Lucira, which launches its first retail store in Mumbai this month, is betting big on sustainable luxury with lab-grown diamonds, recycled gold, and an aggressive omni-channel expansion strategy. Joining me now to discuss this further is Rupesh Jain, the co-founder of Lucira. Rupesh, welcome to Startup Street. Before we get into the fundraise, talk to us about Lucira's plans to differentiate itself from the traditional players and establish digital-first jewelry brands. It's a highly crowded market.
So thank you so much for inviting me. So Lucira differentiates itself very clearly in terms of designs, the affordability part, and the omni-channel piece. We are very clear that we are a digital first brand where a lot of discovery will happen online and the customers will then transact either online or offline, whatever is convenient for them. We really stand for lighter ticket value, day-to-day, everyday jewelry with very different approach in terms of comfort, designs, and different kind of cuts and colors in the entire jewelry. So we want to focus on the modern India, the new Bharat that we are catering to. It's a massive population that we really want to cater. And since gold rates are also going very, very high, I think the new segment that we are catering is going to really become large for us. So that is how we are differentiating ourselves.
All right. You also, your first retail store is opening in Mumbai this month. What role will physical retail play in your omni-channel growth strategy?
So we are very fortunate that we are on the live show, and our store opening is happening on the same day. So today morning only we had opening of our first store in Bombay, and we have seen very good response from customers. A lot of people liked our collection. They gave us feedback that they have not seen such large collection in any of the other lab-grown diamond jewelry players, and the price points that we are catering to. In terms of our physical strategy, I think physical retail is going to be a big part of our journey in terms of distribution. A lot of discovery will happen online, but a lot of our transactions will keep happening in the offline world, since people would want to try and check the jewelry. So we have big plans for the offline. Yeah.
Rupesh, lab-grown diamonds and recycled gold are central to Lucira's pitch. How are Indian consumers responding to the idea of sustainable luxury?
So I think people are really getting educated a lot in terms of what are they consuming, and in terms of luxury, what are they using. So I think people are really liking the entire sustainable angle. They are understanding that there is no damage that we are creating on this earth, and we are wearing something which is sustainable, which is luxury, and which is really for long term. So I think people are really liking the entire concept.
Rupesh, you claim to have over 1,000 customized designs already. How important is personalization and technology shaping in the next phase of jewelry buying?
I think people now have a very different taste in terms of their day-to-day. Every single customer for us is very differentiated. So they will have their own choice of designs, their colors, their cuts, and they would want to really wear their own personality whenever they are carrying themselves. So I think in terms of designs, we would really want to be the first brand in the mind of the consumers. And in terms of tech, since we really understand the tech part of it, the entire automation part of it, the discovery part of it, the content part of it. So I think the tech and design are really close to our heart. And earlier also we have built something in the past at Candia. So we know that customers really like the tech and the design piece. Yeah.
All right. You've said that Lucira is entering an aggressive growth phase with retail expansion and a design-first portfolio. So, Rupesh, tell us what kind of revenue targets or growth trajectory are you working towards, let's say, over the next 2 to 3 years?
So, I think in next 2-3 years, we are aiming the top line of almost 100 crores. This year, we plan to reach to first 10 crores with 3 to 4 retail stores this financial year, and then from there, taking a lot of feedback and then changing our gears to more aggressive strategy. Okay. So that's our plan for online and offline retail. Yeah.
Okay, one final question before I let you go. You've described Lucira as your second innings after building Candia. What lessons, Rupesh, from that journey are you applying here?
So I think top 3 lessons that we have been applying from Candier journey to Lucira is build a world-class team so that they can handle the long-term growth for the company. Second is build good systems so that they can really support and they can ease your work. And the last part is keep focusing on your product so much that your customer really fall in love with your product. So I think these are top 3 mantras for us in Lucira.
All right, with that, it's time for me to wrap up our conversation. Many thanks, Rupesh, for joining us on Startup Street, and wish you the very best.
Thank you so much. Thanks, Shruti.
Well, moving on, WhatsApp is no longer just a messaging app in India. It's powering small businesses, payments and public services. CNBC-TV18's Rachna Dhanrajani reports that Sandhya Devnathan, Meta's head for India, is busy trying to change that. Take a look.
WhatsApp Business has become an integral part of India's digital economy, with about 10 million users in 2022 to 15 million users by 2024 and about 175 million daily interactions. MSMEs are the largest users by far and the fastest growing category, with WhatsApp being used to collect orders, collect payments, connect with customers in faster and a more efficient manner.
I think the journey that we've been on WhatsApp really has been for businesses has been one, finding out what customers and users want in how they talk to business. Just recently, we published some, Kantar, I think, shared these numbers. 91% of, online adults that they surveyed talk to a business on WhatsApp. So it's a pretty, big trend. Whether we are there or not in terms of enabling a structured way to do it, customers and users are talking to businesses.
It's not just businesses, even governments and institutions have found WhatsApp to be an effective tool in their hunt for efficient information dissemination and even document distribution.
Around 7 million tickets on metros are sold every month. So, in fact, I think we're hitting close to 100 million ticket run rate now annually on metro tickets sold on WhatsApp. And if you remember, this was a small pilot that started in Bangalore 3-4 years ago. So you can already see the scale at which this has happened. And we were so encouraged by that we worked with the Andhra government to launch Manamitra, which is 700 services, citizen services that are available on that chatbot, which you can access, by messaging one phone number on WhatsApp. And what you see there is, the usage has, and, the feedback we've gotten has been so encouraging. There's 4 million people that have already used it. And one of the big use cases we're seeing is education. So during the 12th board exams, 91% of the hall tickets that were given to 12th board students were on WhatsApp. So this is not things that we'd have imagined were possible like 4 years ago, but are happening because Indian businesses, Indian state governments, are all innovating in terms of how they will use WhatsApp. What also excites me is the use of AI on WhatsApp. So I think as chatbots will get more and more powerful with voice, with AI-enabled services, you'll start to see truly that becoming, something where you're not just having a two-way dialogue with text, but you're able to have a conversation and get what you want right on WhatsApp.
How do they drive up revenue in the country for Meta?
So we don't publish, the India breakout numbers, but again, we're very happy to see the kind of growth that we've seen on revenue in India. And I think what makes us happier is that businesses are finding real value, and that's why they're putting their rupees with us. The global number that we've shared is that paid messaging overall on WhatsApp is expected to touch $1 billion run rate this year, and India powers a lot of that number. Is that we've sort of really taken a customer first mindset in terms of what does the consumer want and how will we enable that, and which is why if you see our payments functionality itself on WhatsApp is not just about WhatsApp Pay. You can pay using any UPI provider.
WhatsApp Pay is slowly carving out a place for itself in India's digital payments market. Following the lifting of the 100 million user cap in December 2024, monthly UPI transactions doubled to 61 million by January 2025. However, its share of India's UPI volumes remains under 0.4%, far behind leaders like PhonePe and Google Pay, which together account for over 85% of transactions. But WhatsApp is not giving up. But as businesses scale, they are starting to hit roadblocks. Criticism includes broadcast messaging being capped at 256 contacts per list, limited multi-agent workflows, and weak native automation. People also worry that with cloud storage outside India, the service lacks enterprise-grade audit trails or guaranteed compliance with India's Digital Personal Data Protection Act. For regulated sectors like finance and healthcare, this is a serious limitation. But WhatsApp says these are issues it is working to address on a war footing. Experts say it will have to work quickly given the rising threat from rivals like Telegram and Gupshup and even the newly launched Zoho Aratai. In Mumbai, I'm Rachna Dhanrajani.
Well, with that, it's a wrap on this edition of Startup Street. More news and updates coming up on the other side.
The Indian rupee has fallen to record lows this week. Interestingly, keeping the rupee company in terms of depreciation in 2025 are Argentina and Turkey, where inflation is more than 30%, but both have fared worse compared to the rupee. The rupee is also declining at a time when the dollar index is weakening. The dollar index is down nearly 10% so far this year, and the rupee is down over 3% in the same period. Now, one of the key reasons for the fall in the rupee is the rapid outflow of foreign funds from India. More than $21 billion have been pulled out in the last 12 months, making India the least favored emerging market for foreign flows. Indian stocks have underperformed global peers so far in 2025 with just 2% returns, but other asset classes are booming, with commodities like gold and silver in particular seeing a spectacular rally. Now, weak rupee is not necessarily all bad. It can help exporters offset some of the impact of the 50% US tariffs. It could also bolster remittances from abroad. So how low will the rupee go? The government does not seem overly concerned at this point in time. Before I bring in our team of editors, here's the Chief Economic Advisor, Anantha Nageshwaran, on the weakness in the rupee. As I pointed out, he doesn't see the current levels as a key risk. Take a look.
I'm not too concerned about the rupee's current sort of recent weakness or the current levels per se. It's all right. Obviously, we have ample foreign exchange reserves and we have very low external debt. So it's not that the rupee is vulnerable in any particular manner. It is just maybe the current demand for dollars or the reduction in the inflows on the portfolio side may have contributed to this weakness. So I'm not worried about the wider.
And does it actually also help offset some of the, at least as far as the exporters are concerned?
To a limited extent, it's actually a good thing because if the Indian rupee is depreciating on the back of a depreciating dollar, it does impart a certain competitiveness in the near term. But of course, anything that is overdone will be a challenge. But that is not something we are facing right now.
Well, that is the Chief Economic Advisor saying don't see the decline in the rupee as a key risk at this point in time. And we'll get to the competitiveness aspect in just a second as well. But let me welcome on the editor's playbook, Latha, Prashant, Nimesh, Surbhi and Sriram. But first up, our in-house governor. Latha, what's going on as far as the rupee is concerned? And the big question on the street, how low will the rupee go?
Well, if you only want a poll of what economists believe, most of them think that 89 is a good level. It's a round figure which the Reserve Bank will protect. And perhaps you will hear the odd 89.50. But most of them are telling you that the bad news is already in the price. There isn't much to go. Even those who speak about 89 or 89.50 will normally tell you that by March, that is fiscal year end, you may see it appreciate back to about 88. The broad range in the market is 87 to 89.
Yeah, and imagine this kind of... No, I was just saying, Shireen.
No, I was just going to say that at the CII town hall yesterday, and we had 80 plus CEOs, that was pretty much the consensus there. Even when I polled CEOs on where they expect the currency to be in the current band is what the majority voted even at that CII town hall that we did yesterday. But Lata, we took our viewers and the audience through what the chief economic advisor had to say. But really, what do you attribute the decline, one of the key reasons for the decline that we are seeing at this point in time? As I pointed out, it's Turkey and Argentina, but they're sitting on inflation at 30%. We don't have an inflation problem at this point in time. Okay, we've seen foreign outflows, but what really is weighing on the currency?
Well, first of all, there is the near flow problem. As you pointed out, record outflows in terms of, foreign capital. We have seen outflows of this, nature or even higher during the taper tantrum and before that during the Lehman crisis. So we should not forget that this is nothing like that as far as our macros are concerned. During the taper tantrum, our current account deficit was 5%. In fact, the last quarter, it was even more than that, the Jan-March quarter. We have now a current account deficit which is less than 1%, a historic low. So probably that is the point. It was too good to be true. For the last 30 years that I can remember, when the rupee became a marketable, a marketized currency, the current account deficit has been 2 to 2.5%. This 1 year, it was 0.5%. So clearly, all over the world, governments are worried that too much is being outsourced. So we should expect some kind of a mean reversion. I wouldn't worry till the current account deficit is 2%.
Shireen, I was just adding, what I was saying was that imagine we're talking about levels of 89 and some predicting 89.50, as Lata is saying, at a time when A, she's pointing out our macros have been solid, and B, look at the dollar index. I mean, it's not as if the dollar has skyrocketed and therefore currencies are falling and the rupee is falling. The dollar index, the DXY is down 10%.
Exactly.
I mean, from January, the DXY was at about 110 and today it's at 97. And, then we have this depreciation.
That's what most analysts will point out, that we are at bigger historic lows compared to the euro versus several other currencies. And by the way, we are at a historic low versus the renminbi. Until very recently, it used to be 10 rupees or 11 rupees to buy a renminbi. Today, it is 12 rupees 48 paise. So, some of this is, as the CEA pointed out, working to our advantage because, that makes Chinese imports expensive. Forget about exports. We always tend to mistake that, it makes our exports attractive. That is the least of the problem. The advantage is that it's a natural tariff barrier for the domestic industry.
For example, the steel.
Steel, absolutely. Why did steel stocks go up yesterday, day before? Primarily because there is an advantage. But I don't think you'll catch the governor saying that he's okay with the rupee depreciation. You don't say that because it becomes self-fulfilling.
On that point, on what the governor may or may not say publicly, let me go across to Prashant because he's been putting this data together. And there seems to be a change in stance, in position, as far as the RBI's intervention in the rupee market is concerned. And we were just looking at that. Prashant, in the Shaktikanta Das era, the RBI was much more aggressive in its intervention, was it not?
It was, Shireen. And so I just looked at these two periods and forgive me if I'm picking out extremes of both periods just to kind of sort of contrast and make a point. But I think it still makes sense because I think the contrast is very much there. Although I think, the current governor is he's only taken charge in December 2024.
10 months old.
And Governor Das, was at the helm of things for 6 years, right? So, under Governor Das, the dollar index went from 96 to 106. Now, this is point to point. I think 2022, we also saw 113, 114 kind of levels. So, but this is just point to point. So, but you got to live through this point to point, right? And that's what we're doing right now. The policy was clear: maintain low volatility in the rupee. And of course, the RBI used to aggressively intervene to curb rupee fall during periods of dollar appreciation and vice versa as well, on both sides. Now, this policy of maintaining stability in the rupee actually reached its peak, if you remember, during October to December 2024. This is when US elections, etc. were taking place. The dollar index saw a 10% jump, October to December 2024. And that is the period when RBI intervened, sold dollars heavily, and the headline reserves at the RBI declined $110 billion during this period. And this is both spot and forward positions combined, $110 billion in this period, right? But as a consequence of that, money market rates moved about 200 basis points above policy rates. That essentially, I mean, it was like a follow-on effect. It tightened credit conditions, and all of us have sort of spoken to companies during that period. And of course, it led to the cyclical slowdown, which some would say we are kind of sort of still unwinding as of now. Now let's come to Governor Malhotra, and I think right as Lata and we've spoken about this as well. As soon as he took over, there was this. One of the first things was, will he kind of sort of, is there going to be a change in policy with regards to the rupee, right? So far, if you look at point to point again, right? Governor Das left off at $106 index. All that has happened in the last 10 months, from 106, we've just come down to 98. In that 6-year period, we moved from 98 to 106. In 10 months, we've come off from 106 to 90, back to about 98 where we are right now. The philosophy seems to be that, I mean, India, you mentioned Turkey, etc., right? The philosophy is India attracts growth capital, and it's not interest rate sensitive money, carry money which comes in. So it is so the focus very much is growth, and looks like the philosophy is let's not sacrifice growth for the sake of forex stability. And maybe that makes sense, right? External debt here makes sense. It is local consumption, which is the majority of the economy. And of course, consequently, RBI has done a lot. 100 basis point in rate cuts, injected a lot of liquidity into the system. But they've also been very tactical with sort of forex intervention. So I picked out a couple of things, and Lata can corroborate because I think she talks to more traders and dealers than I do in a year. In a day, she talks to more. But what I picked up is, they are, for example, in February, the RBI was in the market heavily, selling dollars. That is around the, I think, Liberation Day, etc., right? Then they went on the other side. So they've been very tactical. It's not as if they're not in the market. And even now they're there.
They were there yesterday, today.
Correct. They're there every day. And maybe large sums of money as well. But they're also coming in slightly at a wider level. Earlier it used to be, say, 10 paisa. Right now it's 40 paisa, 50 paisa. I mean, the threshold for them to allow the move in currency has also become larger in that sense. So I think it's interesting that that is what they're doing, and I think
sorry. I want to do this thing. So one is that the dollar index that we keep talking about, and Lata ma'am, can you please correct me if I'm wrong? But in the last few years, the correlation between a dollar index and EM currencies, while directionally it's the same, but they have decoupled quite a bit. It doesn't. If dollar index falls 10%, doesn't mean that our currency will also fall 10%.
No, absolutely. No, absolutely. On the contrary, all Asian currencies are up 7-8%.
Correct, exactly.
Versus the dollar. Yeah. Just a little bit in terms of trying to correlate regimes. The Shaktikanta regime held currency only for those 3 months, September, October, November types. Because in October, the Indian inflation was 6.8%, above the 6% mark. You don't want imports to become expensive at that time. So the same Shaktikanta regime 2 years ago in 22 had allowed 11% depreciation of the currency in a year. So, it's different. When inflation is very low, you don't mind the currency depreciating.
Also,
and in October, we had $10 billion of FPI outflows along with...
They had to be a little different.
And Governor Malhotra
Short point is, I think, much will depend on the RBI's forecast. It's not today's flows. If they are okay with the rupee depreciation now because they believe that this is temporary, trade, even the CEA said he expects a trade resolution.
I think that's the only thing to try. I mean, for going forward, track the whereabouts of our Commerce Minister, Shireen. He's in the
still in the US. Still in the US. He's very much there.
And if there is a deal which comes, I think that is squarely what people are focusing on.
Check social media every day.
No, that's
every
she
hour.
said it. She
every hour, check social media.
Don't check anywhere. Just check.
Just check social handles every.
I just want to make one more point about
handle.
the dollar index, right? Sriram, you made that point. 60% of the dollar index is the euro, right? Euro is appreciated. So actually, we're talking about the rupee against the dollar being down 3.5% year to date. I checked out numbers because the euro has gone up against the dollar. I checked out INR euro. You know how much it is? Rupees down against the euro? 17% this year. 1.7. So against the GBP, British pound is down 11%. So it's actually the euro which has strengthened substantially, and that is the reason why you've got these.
Funnily, it is worse for euro that it has strengthened so much, and for Japan, than our weakness.
Don't take a holiday in Europe.
It's the hit. I mean, they folded too soon with Trump, and they will pay the price for it over a very long time. It was a deal with the devil.
But Shireen and everybody, the advantages of all this is up until 22, immediately after COVID, there was this burst of revenge travel. At that time, the amount of dollars we spent because Indians were holidaying abroad were huge because the euro and pound were not that expensive.
Yes.
So now there is another natural tariff barrier for Indians traveling abroad. Let's take a holiday in Sikkim.
I'm not so sure it's going to curb foreign travel. I'm not so sure it's going to curb foreign travel and get people to spend on travel.
On a more serious note, education outflows have definitely dwindled.
So you know how much is
because of other reasons.
I'll have to confirm this. UK, the outflow on education from Indian students is $20 billion. $20 billion a year. That's UK. US will be much higher, right? We'll have to look at the numbers. I've heard. So I think all of that, because of what's happening, I mean, people are going to stay here. People are going to, and there are opportunities here in India for students to do that. It's a huge bill, actually. So yeah, you're absolutely right, Lata.
I think the Reserve Bank's and the government's policy after the 1991 liberalization is markets find their level. They don't angst over the rupee that much because at a level, at 89 or 90, rupee will be attractive, and so will the stocks be.
Exactly.
Both will be cheaper. So I think we are not at all at the taper tantrum or any angsting level where we have to take a capital account, step of restricting.
As people have said, macro-wise, I mean, actually just sheer numbers, I mean, a pretty strong
Exactly. It doesn't actually get better as far as the macros are concerned.
Yes, absolutely.
No, it does. It does.
But let's just move away from the rupee for just a second because I want to get Nimesh into the conversation and look at what's happening in the equity market versus other asset classes. I mean, we've all been looking at the mouth-watering, jaw-dropping rally in gold and silver as well, which continues. But Nimesh, let's look at what's happening as far as the equities versus other asset classes are concerned. How do we stack up?
So, Shireen, it's very clear. A good macro doesn't mean a good market, right? I mean, that's been the old proverb, and that's how it proved to be. Look at what happened
China as an example for 20 years, right?
Exactly. No, and that's the point for India as well. Look at this year. Y2D, Nifty and Sensex are both flat. If you look at the US indices, they are up between 14 to 16%. So, double-digit kind of gains for European indices, more than 20 to 30% gains for Asian indices. And even the European indices are up between 15 to 30%. So that's the kind of move we've seen across all the other emerging market, not only emerging market equities, but the global equities as well, as far as Indian performance is concerned. And this is even more shocking when you look at equity performance versus the commodities. The gold is up almost 42%, and this is Y2D dollar returns, right? 42%, 42% YTD in dollar terms.
Yes.
Okay. If
उसमें से 10% तो dollar का exchange rate है.
You know what?
No, that is in dollars.
That's what I'm saying.
How much gold?
Okay, you're saying.
If that's the case, how much is silver up? 52%. Silver is a 52% Y2D in dollar terms. Forget that. Even copper, which is not a very tradable
This show was supposed to be about gold.
Still, even copper is up 17% Y2D in dollar terms. Yeah. So whether you look at commodities, whether you look at equities, global, local, Asia, India is relatively underperforming. That maybe explains the reason why it's not the favored destination as far as FI flows are concerned. It's very visible, right?
Shireen, with your permission, therefore, that question, yes. How will the earnings growth look like? Ultimately, people will come for earnings growth.
Absolutely.
And we have had 5 quarters of single digit, at least if you look at the Nifty EPS growth. What's your sense about end of the year? People are predicting 13%.
14%. If
that looks legit?
That looks achievable, Lata. If FMCG and all contribute, it's achievable. And if that has to happen, maybe this is the last phase of massive FI selling, because the rupee will also, as you rightly pointed out, so that will help them. And plus, if macros improve, in terms of macro, I mean earnings improve, you're going to see a bit of FI money coming back. But at this point in time, they have enough opportunity globally, everywhere else to make money.
I just want to get Surabhi into this as well, because she's been looking at the FI flows also, and that's something that we've been talking about. In fact, it takes me back to the conversation that we had with the DPAM secretary, where he virtually thanked domestic institutions and retail investors for coming to the rescue of the Indian stock markets. And we've been talking about the Atmanirbhar angle playing out for the stock markets as well, driven by DII and retail investors. But Surabhi, what is going on really there as far as FI flows are concerned? And to Lata's point, the return, so to speak.
Shireen, it's very simple. FII money is finding better homes, even if they're temporary homes elsewhere. Markets which are relatively cheaper, which are showing better earnings potential, and which have a AI/tech story. It's as simple as that. Now, those are the reasons, and then therefore, here are the numbers. And frankly, numbers as of now, last 2-3 months aren't even that bad. Let's just jog memory here. I'm first talking about the India depository data, and then we'll compare it with other emerging markets. When the year started, it was on a really bad note. I mean, we had $9 billion, $10 billion kind of outflows in January. February, it came down. Then it got a little better. Actually, when the tariffs hit us, those months were positive. If you look at April and May and June, those months were positive. Why? Because the hope was, India is a local-driven economy, and we have a great relationship with the US, and we'll be the first in the queue to get a deal. None of that played out, and as that became clear, the outflow started again. Because here earnings were not picking up, there was no deal happening, and the FBIs knew that they had to head back to other markets like Taiwan, South Korea, and of course mainland China. Now the outflows, July $2 billion, August $4 billion, September so far only $1.3 billion. But the fact is the market is absolutely range-bound, and that's where the point on domestic money comes in. Retail money, family offices, and all this money is absorbing so much supply. We've discussed this on the show earlier, but if it was not for the local flow, this market would have had a very different texture and nature. Now, let me just quickly contrast this with some data that Nimesh and I were discussing in terms of how do we stack up against other emerging markets. Really bad, actually. The next big EM, or one of the BRICS, which comes close is South Africa. South Africa has seen an outflow of about, this is 12 months data, about $12 billion. We've seen a $21 billion outflow. We've digested it. If you want the silver lining, thanks to domestic flows, we've digested these outflows really well.
Is minus 20.
And South Korea is also minus 20. Yes, South Korea and South Africa.
Guys, coming back to the rupee because we are out of time. Sriram, let's talk about the big C, competitiveness, and we alluded to that, but you put the data together on what this actually means or how it helps India's competitiveness in this challenging environment with that 50% tariff hit.
No, so yes, you already said it, right? I mean, the rupee weakness offsets some of the tariff blow. Even on competitive terms, so for example, let's take the example of South Africa. They had a 20% advantage over us in terms of tariff. Their tariff was 30%, ours is 50%. But their currency has appreciated 10%. So they have already lost half the advantage. And we have lost another 3-4%. So the net effect is much lesser.
Yeah, instead of 30% disadvantage, it's a 15%.
It's a much lesser. In fact, instead of 20, it's about 5 or 6. In the case of Brazil, both are at 50% tariff. Their currency is appreciated 16-17%, which means we are more competitive than Brazil in many product segments. Now, how much of that overlap will differ from one country to another? But the part of the correction was overdue. At the end of November last year, rupee was considered overvalued. And so a 4% correction from there, some would say that it was par for the course, right? That is one. Yes, at the current level, the 89.90 sounds scary. But, and it also helps us with the negotiations to a certain extent. I know Lata ma'am and I had this conversation yesterday about this. And I think that what happens is if Trump wants us to appreciate our currency, it's better to start at 89 or 90 than to start at 84 or 85. So by the time the appreciation, whatever we reach, we are still competitive in the market. But Lata ma'am thinks that,
all said and done, I really want to say that we shouldn't concentrate on exports. It's a very small part of our GDP. The real advantage of a weak rupee is that domestic industry gets a huge tariff wall. I expect growth with a weak rupee because of domestic industry, not because of our export industry. Because Indian exporters don't have that, rare earth advantage. If you will not bring down your garment price down, Vietnam will do. Contracts are set, prices are set ahead of the delivery. So we must not make too much of an export advantage for our currency because it is all contracted.
So
the real advantage clearly is for domestic industry. If domestic industry is gung-ho today, it is in areas where import competition is
there.
Lessened.
The point is that
Sriram, very quickly, we're totally out of time in exactly 5 seconds.
Yeah. The point is that the exports are the most vulnerable segment.
Yes.
So therefore they need the focus, not because exports growth is necessary. They need to be protected. Let the currency protect them.
Shirin, just 5 seconds. I'll just But I want to say that for new money, right, new foreign money which comes in, if the rupee goes down a little bit more, a foreign investor coming in now is starting with a 3.5-4% advantage. Cheaper. Because when you take the dollar out, right, you're starting with that easily. So I just want to give a slightly pause. आपके 5 seconds.
No. मेरा 5 seconds यही था. Because it's a show on rupee. A word from internal governor. What to expect, ma'am, on the next policy?
Actually, the street is split down the middle, and I think a rate cut
only
is...
because the rupee is...
Because of the rupee, you wonder. But, you know, as Prashant said from the start, we are not a country which attracts money for interest rate differential. Sure. Therefore, I would think that he will give the market a leg up and go ahead and cut. The market is equally divided.
This should be the...
I would tilt. I would tilt in favor of...
That's the consensus. That was the consensus in industry as well, that we will see the MPC deliver with another rate cut. Mere 5 seconds, I'm only ruining the fact that I possess no gold, and mere kismat mein to Paytm gold coin bhi nahi aaya. That's my 5 seconds off.
Go out and spend.
Gold is passé, now it is silver.
Silver is the new gold. So,
and my 5 seconds are
new gold. Maybe I stand a chance with that. But guys, it's been fun talking rupee rates and relations. But thanks very, very much for joining us here on the Editor's Playbook. To all our viewers, we'd love to hear from you. Send us your feedback, suggestions, comments. Till next week, from all of us here, goodbye and many thanks for watching.
Since the RBI MPC's August meeting, so much has changed. 50% tariffs imposed by President Trump, a giant GST cut by Indian governments, a massive fee hike on H-1B visas by the US, and now a threatened 100% tariff on branded pharma. These steps are large enough to change the entire growth inflation dynamics since the August policy. This makes the deliberations of the CNBC-TV18's Citizens Monetary Policy Committee that much more important. Let me welcome Chairman Pranab Sen and our members, Dr. Soumya Kanti Ghosh, Dr. Sajid Chinoy, Samiran Chakrabarti, and Sonal Verma. Gentlemen and Sonal, good morning and thank you very much for joining me. Well, Soumya, as the Finance Commission member, as where I'm going to begin with you. Last policy was branded hawkish by the market because the Reserve Bank said that the 1 year ahead inflation that is second quarter FY27 will be 4.9%. So market thought no more cuts. What's your assessment of the inflation trajectory now after the GST cuts and the huge Asian deflation?
Yeah, thank you, Lata. No, I think you have asked a very pertinent question in terms of the inflation trajectory. Since the last time the policy, in August, the policy was announced, I think there has been a plethora of changes, as you correctly pointed out. There has been a lot of developments on the global front, but most importantly on the Indian front also, there has been this GST rate rationalization. And of course, there are reports that, as you said, there has been serious Asian disinflation. In fact, if you look into the all Asian countries, the inflation is lower than the band of which it is prevailing. If we extend the case to India, I think in India also, the impact of GST is going to be more pronounced. If you look into the trajectory last time when the GST was cut in 2019, I think there was a significant impact on the inflation trajectory on a one-time basis, and then it declined. In the current scenario, there are a couple of points to note. The first thing is that apart from the fact that food inflation has continued to surprise on the downside, the GST rate rationalization actually translates into around 16% weightage in the CPI commodity basket, if I just take a rough approximation. So that actually should translate into 114 basis point impact. But even if I assuming that the pass-through is only 50 to 60%, which is the most plausible and rational assumption, the overall CPI decline could be in the range of 60 to 70 basis points. I take it as 60 basis points. This apart, there is also the likely impact of a new CPI base which is coming into effect from February 2026, where in all probabilities the food weightage should be reduced. So if I take into account all these technicalities and also the fact that core inflation has been running significantly below par, if I take out the gold inflation, I think inflation for this year average will be close to 2.5% with a downward bias. And the most importantly, RBI has been citing this as a forward-looking central bank, that the next year inflation, when the policy it is announced in June, it was 4.9%. Now it is tracking decisively below 4%. So my sense is that with an inflation rate which is going to be below 2% in September and October could be the lowest ever. And most importantly, 2.5% inflation average this year, less than 4% next year. I think there is enough arsenal in the room to suggest that the inflation trajectory will be significantly benign in the next couple of months and even in the next 1 year or so. So basically the projections of the central bank or anywise could have changed significantly, could possibly change significantly when the policy is announced on October 1.
Fair point. So 4.9 will definitely be reduced for the plethora of reasons you say. But, Sonal, on the point of that inflation number being revised by everybody for the current year to 2.4, I did a poll, and actually, if you compare to the Economist's August forecast and current forecast, GDP has been raised by 30 basis points. And inflation has been lowered by everyone by about 40 basis points. That's the average I got, and that table will play. So given that, how can you at all justify a cut?